On the rise in France, but we are asking questions about where politics goes in France and what that means for Europe.
And it's interesting that you talk about the windfall taxes as well, because I read about the UK as well, and this is your area of expertise when it comes to the windfall tax as well, when it comes to things like big oil, etc. Did we see a market reaction yesterday?
I mean, there was kind of in the mix, wasn't it?
Yeah.
The FTSE 100 by the close, where we were around the European equity markets. So European equity markets just yesterday we saw some underperformance coming through, and the US, by contrast, closed, with another record high under its belt. So we have got some contrast there. In terms of where we are in European stocks, then this morning, just opening up for Friday's trading session, we're flat on the FTSE 100. The DAX is up by 1/10%. The FTSE now up 1/10%. Not great moves. Waiting for the CAC 40 to open. We will see how the politics plays out once again, because of course we've seen the latest news lines around France, and I'll get to this later this hour, is that the left in French politics has kind of come to an agreement and decided to unite, which could form the second bloc, pushing Macron's side of the parliament into third position. If we did see Le Pen and that party, that party on the far right of politics, if we did see those to the fore.
Yeah, and we've seen the banking sector, of course, as you mentioned, take the biggest brunt in terms of direct market reaction to some of these changes or potential changes that you're seeing. But I'm curious what that means from a more broad perspective. For at least this morning's market open, you're actually seeing banks seeing some real leadership here, higher by 1/10%, still green on the screen. Construction stocks as well. But if you look at the kind of downside, it seems to be a lot of commodity names as well. I'm looking at some of your heavy hitters. Rio Tinto, for example, on the FTSE is one that we're keeping a very close eye on. When it comes to the Stock 600, though, it's your heavyweights, for example, that are really changing the game. On the downside, it's LVMH. On the upside, it's Novo Nordisk and ASML.
Yeah. So as we wait for these European equity markets to settle down into what could be a fairly quiet trading day, we don't have a great deal of individual corporate news. We have a lot of geopolitics to deal with this week. I'm just looking at what commodities are doing, because sometimes that helps with where we are on certainly the London market. The FTSE is up 0.2, as we mentioned. The oil price is down just a fraction, but still with an 82 handle, so 82.54. And looking at other commodities on the move, iron ore a little bit stronger. So we're kind of mixed on the commodities front this morning.
Yeah, and it's interesting, as we're seeing, again, I'm going to bring it right back to the point that you made. I'm piggybacking on you all morning, Anna, when we're talking about some of the big moves, because BNP is one of your major downside movers this morning, not just in the French index, but in the Stock 600 as well. It's one of your biggest index weights that you are seeing. I'm curious what reassures the market that banks are now attractive. We're going to ask our next guest that in a moment, but let's start big picture here first when it comes to the stock market. Citigroup, for example, expecting the Stock 600 to reach 580 by mid-2025. We're going to get right to it. There's no point in waiting. The head of European equity strategy, Beata Manthi, joins us this morning. Before we get into the French story, let's talk about this price target here. Why? Explain to our audience why.
So that's around 12% upside from the current levels. By year end, it's over 12 months out, right? And it is actually underpinned by conservative assumptions of no re-rating. So we are seeing some constructive signs that EPS not only is going to be delivered as analysts are expecting, actually we think they might be too bearish. So what we've done in our road ahead from the start of the week, we've actually upgraded this year's top-down EPS forecast for this year from +6 to +8. Now we are above the analyst forecast of 7. Actually, I don't remember. I've been doing this job since 2007. I don't remember ever top-down model telling me a better story than the analyst forecast, right? And for next year we have 10%, which really means returns can be justified if this EPS is delivered.
We got to hold that thought because we're getting a red line crossing the Bloomberg terminal. Of course, we're watching the BOJ this morning as well. Governor Ueda saying it is possible to raise the rate in July depending on data. So very specifically giving that timeline of July, although perhaps that was in line with some of the market consensus that they are indeed watching for that hike, perhaps now being directly addressed by Ueda. When you look at the market reaction, it's quite literally the market equivalent of a shrug of the shoulders. 157.97 is where we are on dollar yen. As we get more headlines, though, we will bring them to you. But let's bring it right back to the European story. Let's go sector specific here. We've been talking a little bit this morning about what's going on in France and this kind of geopolitical volatility. How does that show up in the stock market outside of the banking sector?
So what do we find is that the elections in France tend to be more volatile for equity markets than other developed markets. So that's number one takeaway, that perhaps this volatility could continue for a bit longer around French stocks, right? It doesn't change the underlying story of recovering EPS and recovering GDP in Europe. You have to put this in context. But of course, volatility could continue, right? So into the election, we've been neutral. France, it actually has underperformed already before the election announcement. In terms of stock, the sector-specific stocks that are very heavy in France, but these are allocations for the stock 600. We are now neutral. Luxury goods, we are neutral in banks. We are underweight construction materials, and we are underweight autos, overweight industrials.
That's interesting. Some people might suggest that what we're seeing in the banking sector, sure, there's uncertainty in the short term, could end up being a buying opportunity.
Yeah. Absolutely.
How does that fit with your thinking?
Absolutely. They've gone down a lot, right? And they are definitely very cheap, but the news flow continues to be negative for now. So it's, of course, evolving story. We're watching it very carefully. But the major change in the allocation from being very pro-cyclical and with a mixture of value and growth cyclicality in the overweight, with the exception of autos that have been an underweight, we now have more of a growth tilt.
Yeah, and before we were talking about political risk on French banks, we were talking about the possibility of M&A. That could still be a theme that resurfaces. Is M&A a theme that you're investing around on European equities, Beata?
That's a theme that could be a tailwind when it properly kicks off, right? There are signs it's starting, but it's really very early signs. So, of course, the European election could mean that the banking union could go ahead. That could spur some M&A activity in the European banks. But look, what is happening right now is short-term volatility. But what we are noticing is that the analysts keep upgrading. The sector that is most upgraded from the EPS standpoint is the European banks. Let's see if that stalls for now. But over longer term, just coming back to what the central banks are doing right now, the high for longer is actually an upgrade for banks, for European banks that, of course, have been under pressure throughout the post-GFC world with no rates, no inflation environment.
Well, one of the kind of macro themes that we've been talking about has been a lot about debt sustainability and fiscal spend, and specifically when it comes to the potential of a more right-wing government in France. But you're seeing examples of it in Spain and even in Italy, where two different governments, but still very steadfast when it comes to things like government stakes, when it comes to fiscal spend, which has shown up in outperformance on the periphery. Are you expecting some sort of fiscal spend to drive the equity story in the rest of Europe?
So the assumption from our economists has been at the start of the year that in Europe we do not have too much fiscal room to spend, right? So, of course, France is telling us otherwise, but it's still unfunded. So that's something that could worry the market. And, of course, this is why the French banks have been selling off as well, right? When it comes to the periphery, actually there is still quite a bit of unspent fiscal stimulus from the post-pandemic fund. So that's still ongoing, and there is the old fiscal to still be spent without the commitment to the new fiscal.
So that's a fiscal theme that we continue to watch and still plays out in Europe. Back to something you said at the start, Beata, which I thought was interesting. We started with your target for mid-2025 around the stock 600, and you were contrasting what the bottom-up analysts are saying with what your top-down macro view is saying. Now, when those two things disconnect, what does that usually actually mean, Beata? Because, of course, each analyst sits there with their own models, works out what each of their companies might do. But then you add on your macro perspective top down. What does it tell us when they disagree?
So it is macro versus micro, right? So my top down doesn't disagree too much with the analysts. It's almost in line. And what I would add to that, we also have another, so there are three ways of looking at EPS expectations: analysts, top down, macro driven. But also very important, what are the market expectations for what the EPS can achieve, right? So we have this proprietary model on what's priced in for the market. 6 months ago, it was telling me that European equities were priced for EPS contraction this year. Now it tells me that they are fairly priced. Right? And that, to do with the valuations, which are just below their long-term averages, tells me that it could be still constructive story for Europe. Now, on the disconnect between the analysts, we've had the biggest disconnect in this post-GFC world of low rates, no inflation, when analysts tended to be more bullish. We've seen downgrades and downgrades years after years, right? But that was not necessarily fatal for the stock market performance. So
okay.
That's something to add.
Yeah, interesting then, the sort of the psychology of the analyst community in focus. And so you're tilting then your European sector strategy towards growth. And let's go back to the big picture. How does that sit with an ECB that is, now has changed direction on rates and is cutting rates, but at a time when the growth story is turning more positive? Is that why we're going to pause for quite a long time at these levels on the ECB, if that is your expectation?
So, look, one thing is the cut. We think that's fairly priced in, right? But another issue is what I've mentioned before, high for longer, and what that means for equities. We've been arguing that that's an upgrade for cyclical equities, not only European equities, excuse me. So for equities outside the US, where they have higher weight in cyclicality. And that could be good both for cyclicals, which are driven by inflation break-evens, and for banks as well. So again, a mixture of value and cyclicals. Of course, that contrasts my pro-growth tilt right now. What I worry about that this narrowing into mega-cap tech out of the US is going to come back to Europe short-term term. You've mentioned at the beginning of the program what kind of stocks our European Super 7 are starting to do well again, right?
The sensational six.
Absolutely. So that's something that's on my mind, perhaps short-term narrowing, and narrowing happens into growth. But also, I just worry in the short term about the outlook for the individual sectors within value. So I worry about autos. On energy, I'm neutral. What I know, it could be volatile, right? I've just downgraded basic resources, and the last part of value, big part of value, is banks, that because of what is happening now in France could be under pressure in the short term.
Okay, volatile again. Thank you very much, Beata. Thanks for joining us. Beata Manthy, Head of European Equity Strategy at Citigroup. Let us now check in with Joe Easton. If you thought he wasn't on the show today, here's a nice surprise for you. We didn't get to you last hour, which was a shame, Joe, but you're here now. Tell us what's happening on these markets.
That's all right. I like to build up anticipation. It makes it more satisfying. So we're starting with home builders. More excitement in this space because we've got yet more M&A news. Now, Crest Nicholson announcing that it's rejected 2 bids from Bellway this morning in a statement confirming some reports that were floating around yesterday. They say the bid undervalues them. It's at $253 a share, but the stock coming up around 8% this morning, and Bellway actually declining. Now, as a reminder, we've already seen Barratt doing a deal to buy Redrow, and recently we saw reports that Persimmon could buy privately held Carla. So 3 deals in this space. The sector is consolidating following a massive decline in the stocks due to rising mortgage rates. Then we're also going to look at the car makers. This is a focus. Reports overnight that Germany is looking to water down some of the tariffs from the European Union on Chinese EVs because they're worried that China's going to retaliate and slap tariffs on the cars that they sell to China. So we are seeing a bit of movement, not too much though in the likes of Porsche, BMW, VW and Mercedes. Keep an eye on this sector. That is an ongoing situation. Tariffs are really in focus at the moment. Then in terms of your France stocks, you have been discussing that already on the show. The CAC 40 on track for its worst week since the mini banking crisis we saw last year, and we're seeing more weakness now in these stocks. They're coming down as I speak. BNP Paribas down 1.6%, AXA, and also Saint-Gobain, the building company, Vinci, the airport operator, all of these stocks hammered by the worries around these legislative elections that are coming up. Then in terms of software, the latest US company soaring after earnings was Adobe. Yesterday we had Oracle, Adobe, another winner of the AI boom. So we're keeping an eye on the software firms here. SAP, Sage, Dassault Systems, all of those in focus. Capgemini, of course, those French shares can't catch a break, but keep an eye on software at the moment. Wanted to check in on a couple of UK oil and gas stocks. Critty was mentioning earlier that Labour manifesto point. Labour saying they're going to stick another £1.2 billion worth of windfall taxes on the North Sea oil sector, and also will not renew licences for companies to do deals in that space. And we saw massive drops in Enquest and Serica, two mid-cap oil companies in the UK yesterday. They were down more than 10% following the Labour manifesto release, and they both are ticking lower once again in the UK mid-cap space. Finally, one morning call to bring you over in the clothing space. Get down to the shops, get down to H&M. UBS recommends buying this one. That was the best performing stock on the stock 600 at the open of trading. UBS likes the margin outlook at H&M. According to a note today, they go buy, and that stock is up 2.5% over in Stockholm this morning.
All right, Joe Easton from our equities team, giving us a little bit of roundup of everything we need to know. We thank you so much as we're about 15 minutes into the European market open. Coming up on the program, we go to one of the big companies we all like to watch, and maybe with a little bit of popcorn. Tesla shareholders approving Elon Musk's $56 billion pay package and his plans for a move to my home state, the good old Texas. We'll bring you the details next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Was going to keep reading World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back. It's Friday. This is Markets Today. We're 18 minutes into a European trading session that's a little bit weaker, not by much. The CAC 40, though, is substantially weaker, down by more than 1%. Overall, then, modest weakness, but the French assets certainly weighing on the European equity space this morning, and banks once again to the fore. Let's talk about what's going on in the auto sector, another sector that has been weak in recent sessions. Tesla investors have backed CEO Elon Musk's pay package and the decision to move the company to Texas. The shareholder vote was seen as a referendum on Musk's leadership after slumping sales and a drop in the stock price. Musk spoke shortly after the result was announced, where he touted Tesla's AI capabilities.
And Tesla's also the leader in real-world AI. So there's really, this is a big deal. Like Tesla is ahead of Google, Meta, OpenAI, anyone on real-world software, actually taking in video and making decisions based on video. No one is even close, and it's getting better.
Okay, standing in front of a map, the new home of Tesla then, a map of Texas, I should say. Let's get the thoughts of Craig Trudell, who joins us now, who is our car czar. Is that the correct title for you, Craig? I mean, you cover all things auto here.
The king of cars.
Bloomberg, yeah, the king of cars, certainly here. Now, yes, the shareholders voted in favor of this $56 billion package, this pay deal, and the move to Texas. This is a huge vote of confidence in a man who runs 6 companies, I think, and they don't mind that. Not only do they not mind, they cheer him. They chant his name as he walks into these. This is a shareholder meeting like nothing we see here in Europe.
Yeah, the standing ovation, there was actually at one point a shareholder who stood up and referred to the idea that he was trembling in Elon's presence. I mean, it sounds a little bit much, but that was
not so much on the FTSE 100. That doesn't happen so many times at the AGM.
But it was very over the top, and Musk himself was in quite a mood where, for him to get this endorsement from his shareholder base, despite the fact that he has had some real challenges in the years since he hit all of the targets that were laid out for him by his board. He created a ton of value. He's subsequently done away with a fair amount of value, and so his emphasis here was on kind of, at least to my ear, saying, look, you just made me rich, or you tried to make me richer. Here are all the things I'm going to do to try and build your wealth, you shareholders. Here are all the sort of pie in the sky views that I have on AI, on robots, and talking about multi-trillion-dollar valuations. It was really he was really in sales mode last night.
It's fascinating that we're talking about Elon Musk in Texas, because I think so many people look at Austin and Texas as a cost of living story as well, but there's this question of Texas and its relationship with the rest of the U.S. as well that I think dominates in Elon Musk's kind of narrative there. It's a similar story with how it's playing out in the broader EV space between Germany and China, the story of kind of how insulated do we want our markets to be. Broaden this out for us when it comes to that dynamic.
Yeah, it's very interesting. I think the news of the week here in Europe being that the EU is going to raise tariffs on Chinese EVs. Tesla would be affected by that to a significant degree. They rely on their Shanghai plant for Model 3s. They make Model Ys in Germany, but that's the extent of their local production on the block. So this would have a big effect on them. It would have an effect on the Germans in that they're very concerned about this turning into more of a trade war, about retaliatory tariffs on some of the cars that they still make in Germany and ship into China.
Yes.
And China, I think, is concerned as well about kind of quantifying how they respond to this, because Europe is the one place in the world that buys a lot of electric vehicles and is willing to pay for them. China is growing in lots of parts of the world that don't pay as much for vehicles as the European consumer is willing to.
Right, and it's interesting because China, we've got some reporting out this morning that suggests, to your point, that China is going to go very carefully when it comes to retaliation for the reasons you set out, but also from a broader trade perspective, not wanting to push Europe even faster towards the US view on trade policy.
Yeah, that's exactly right, and I do think that I would imagine that there is some recognition in Beijing to this idea that there was more of a process here, right? There was a months-long investigation put into, what would be fair or what would be appropriate on the basis of, how much subsidy over decades, was put into this industry. Whereas in Washington, it did not feel as though this was much of a process. It was kind of a, let's put as big a number as we possibly can to make sure that these cars never come into our market.
All right, Bloomberg's Craig Trudell, our car czar, our king of cars, whatever you want to call him. We appreciate his reporting this morning. We stick with the transportation theme and go from on land to in the air. Lufthansa said to win the European Union's approval to buy Italy's ITA Airways, the move paving the way for Prime Minister Giorgia Meloni's government to offload a loss-making asset as she bids to improve her nation's finances, a major theme we've been covering throughout the morning. Joining us now to break it all down, Bloomberg's global head of aviation. We'll call him the king of air, the king of airplanes maybe. Benedict Campbell joins the program this morning. Benny, walk us through this dynamic. We've been watching an eye on this deal and the pushback it's getting in the broader context of wanting these kind of cross-border transactions among politicians. What's the news here? Why did this get the nod?
So this is a story that the colleagues broke late yesterday. We don't have official confirmation yet, but it's looking good that indeed the European Commission will wave this deal through. You have to look at it really in two dimensions. One is sort of the corporate side, Lufthansa buying an Italian company, and the other is arguably the more interesting one is the political side. How can Italy rid itself of this asset that's been bleeding money for decades, really? It's sort of one of these sort of perennially unprofitable assets. And the Italian government really didn't have a plan B, so Lufthansa was the only bidder remaining, and had the deal fallen through, that would have left the Italian government with that asset. So there was huge political pressure to get this through. I was talking to somebody last week who said, had this only been a corporate event, they probably wouldn't have agreed to it because of the hurdles, but because of the political implications, ultimately they won Brussels over.
Yes, and Benny, you talk about this bleeding money for decades in a past life, being an aviation analyst. I remember back in the early 2020s, back in the late 1990s, we were talking about, what on earth is going to happen to Alitalia? Are we finally at the end of this story? Because the attractiveness of this asset has always been access to that northern Italian market where the wealth sits in Italy.
You're absolutely right. So, Italy's a big market. It's almost 60 million inhabitants. It's also a very competitive market. The low-costers, the Ryanairs and EasyJets of this world, they've really pushed into that market, particularly the more sort of southern flank of the country, Bari and so on. That's where a lot of the tourists go. But you're right, the northern part of Italy, Milan, Rome, those areas are tough-fought markets and ones that Lufthansa will seek to protect. It's sort of their southern flank. And Lufthansa knows a thing or two about how to reintegrate or integrate these regional assets. They have Swiss, they have Austrian, they have a company in Belgium, and now Italy. So they know how to turn these businesses around. So it'll be interesting to see what they do, and frankly, how painful the concessions might have to be. We don't know about them yet.
Okay. Yeah, interesting to see how the Italian government's thinking on this asset has changed over the years. Benny, thank you very much. Head of Aviation here at Bloomberg, Benny Campbell, joining us there from Berlin. Coming up, we'll be discussing Barclays' mid-year outlook for 2024. That conversation coming up shortly. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day. Look, kind of starting to look at what the carnage of this week has really been. France, of course, very much in focus, from the stock market to the bond market, even to the currency market, and what the read-through is here in terms of the euro. And you look at the kind of red on the screen that you've seen in the last 5 trading days, you can see that there's been a real beating. The French index, of course, down about 4.4%. We call that, in my world, a mini correction. You're also seeing, of course, the banks driving a good chunk of that. BNP Paribas under a lot of pressure, not only this week, but in today's session as well.
Absolutely. Some of those banks being technically decimated by those moves over the course of this week. French assets still under pressure this morning. As you say, Kriti, the banking sector in focus, and that's why we put a couple of those banking names there. But interesting that another sector that has been weak this week is autos and parts, and that also falls, yes, on Germany, but also in France. And so you see the likes of Renault and Valeo and Michelin all trading down, and that's not necessarily to do with the French politics, to do to other themes, but all of these themes uniting to weigh on the French equity market.
Yeah, it's really interesting that we're talking about, and I'm channeling my guy Johnson here, I have to, but the fact that geopolitics are having a very direct read-through into the market, which is kind of taking us maybe a little bit of a step away from what's the Fed doing, what's the ECB doing, the traditional growth story that we always talk about when it comes to driving the market. Slightly on the back foot this week as we digest what some of these political changes actually means. That doesn't mean they're out of the narrative, though. Lower growth, lower inflation, lower rates, at least that's what Barclays Private Bank says, will dominate the rest of the year as those central banks normalize policy. Let's bring in one of the authors of that report, Valerie Genin, head of investments Monaco at Barclays Private Bank, joins us this morning. Valerie, a pleasure to have you on the program. Square the two for us here. From where you're sitting, from your positioning, how are you thinking about the political risk versus the monetary policy risk? How do they work together? How do they work at odds?
Yeah, well, it's exactly what you said. We foresee for the rest of the year the 3 L's, so lower growth, lower inflation, and lower rates. Let me start with the lower growth. So gradual slowdown in terms of GDP. And if you look at what we had last year, we were 3.2% in terms of global GDP growth. We foresee 3.1% at the end of this year and potentially 3% at the end of next year. However, behind that, what's really interesting is the story of convergence between the US on one hand and Europe and the UK on the other hand. So Europe and the UK are expected to come out of a technical recession, right, the stagflation. and they are expected to pick up some steam now going forward over the next few months. On the other hand, you've got the US that have been really strong so far, and that we expect to decline a little bit in terms of GDP for the next few months. In terms of inflation,
Valerie,
really good news. Yeah, sure.
No, go for it. Go for it. Sorry, I thought you were done. Keep going.
In terms of inflation, so it's really good news. It's trending downwards. Global CPI was at 3.9%. We see it at 2.6% at the end of this year and 2.4% next year. Clearly, Europe and the UK are ahead of the US in terms of disinflation, even though they came from a higher base and even though we had the conflict in Ukraine that impacted much more Europe versus the US, as we know.
Interesting. Valerie, then talk to us about, I think where you stand in terms of the private bank is really interesting, given that I imagine your time horizon isn't going to be as volatile as, say, again, the corners that we started off this segment with in terms of the week. But I'm curious how you're viewing what's going on in the public markets. Are you viewing this as the volatility of an election year? Are you viewing this as simply monetary policy? How does that translate to, say, a longer time horizon when we're talking about consumer resilience? We're talking about looking for cracks. Where does the private bank stand on the cracks that could emerge in the longer time frame?
Well, volatility happens all the time, right? Every year, pretty much, we've got a 10% retracement on equities. So it hasn't happened really yet so far. We have a little downwards retracements in April, but it hasn't happened that much, and it retraced back higher really quickly. But when you position a portfolio for the long term, and this is the kind of discussion we're engaging with our clients, you really want to have a well-diversified portfolio that is resilient for whatever can happen in the future, right? So volatility, and clearly it's going to be impacted by monetary policy shifts. And in the context of what I said earlier about lower growth and lower inflation, now we have central bankers that will move the rates. And Christine Lagarde has started that. She kicked off at the start of June. It's actually historical that the ECB goes before the Fed. That's quite extraordinary. We expect 2 more cuts for the ECB for the rest of this year and potentially 2 more for next year. While on the Fed, and we've seen what Powell has said this year, the dots are about 1 cut for this year and 4 potentially. That's what we expect for next year. So this will clearly move the market and create volatilities.
Let me ask you about sectors and thematic investing a little bit here, Valerie, because a couple of the things that you mentioned in your media outlook are often quoted, you know, investing around security themes, certainly dominant in Europe, investing around AI, dominating over in the United States. I wonder where investments in transition, energy transition are in your mind, Valerie, as we head into the second half of this year. And I ask this in the context of some of the political developments that we've seen over the last week or so.
Yeah, indeed. So first of all, in terms of equities, they've done really well over the last few months. We're about 25 to 30% higher than the October low. So this is really strong, and it's been supported by corporate earnings, macro fundamentals, and the anticipation of monetary policy shifts, right? And if you wind back at the start of the year, we were actually still fearing a hard landing. And this moved really quickly to a potential soft landing, and pretty much the market is pricing today a no landing, right? Now, coming back to selecting equities and going on to your sectorial bias, on the one hand, you have structural growth thematics that always play kind of well for very long-term investments. And in fact, you have AI, and there's still being lots of discussions about AI. The reality is that we have a lot of companies currently disclosing into their reports that they are investing money and that they plan in the future to integrate AI into the products and services. But currently, only 5% of this company yield the fruits of those investments. So this is just a tip. This is just the start of the revolution. Another thematic which is interesting is security, and this can be food security or cyber security, for example.
Okay, so those are a couple of the things that you are investing around. And what about geographically then? You may have nodded to this a little bit already, Valerie. Your thoughts on the UK and Europe versus the United States in terms of investment strategy?
So geographically, UK stocks could be interesting. Valuations are attractive. Dividend yield, historically, they're quite high. And most stocks from the FTSE 100, as you know, are exporting companies. So therefore, potential outcome from the 4th of July election might not impact as much some of these exporters. So this is something to bear in mind. Also, I would point out to European stocks that are interesting as well in terms of valuation. So currently they trade at about 36% versus US peers on a forward PE basis. So usually European stocks trade at a discount to US stocks, but this discount is at about 20% if you look at the last 20 years. So currently we're at 36%, which points potentially to an upside potential.
Valerie, talk to us again very quickly about the currency story. From where you're sitting, you're obviously physically very close to France and the kind of turmoil that you're seeing there. From the clients you're speaking to, how are they viewing it?
In terms of currency, well, first of all, and coming back to your previous point about, long-term investment, what you want to be as an investor is really diversified as well in terms of currencies and be kind of hedged to potential adverse movements versus your best currency, right? So this is the long-term view. Now, in terms of short-term view, there's been a lot of volatility, whether it's euro-dollar, whether it's the cable, and we've seen that this week, especially with the CPI and the PPI numbers that affected very much the currencies. Our view is that there might be a retracement in terms of euro, and there might be a retracement as well in terms of cable. But really the most important for an investor is to plan for the medium to long term and to have a resilience in terms of currency exposure.
Valerie, when you speak to private banking clients, how are they thinking about the latest political developments within Europe? So away from what assets are doing, what's the nature of the conversations with those sort of high net worth individuals when they look at all the political developments in Europe of late?
We're having quite a lot of discussions around that topic, obviously, and people are not necessarily worried, but questioning the impact on their portfolios. So it wouldn't be my place really to comment on potential elections outcome or what it could create. However, clearly, the snap elections that Macron called will create volatility and have created volatility, especially in the French market already. Now, putting back this again into an historical context, politics and geopolitics don't have that much of an impact necessarily onto what your portfolios are doing. And we've seen that as well from the start of the year, right? When you look at how equities move, we have the feeling that investors are paying much more attention to micro news, so at the company level news, instead of the macro and geopolitical news. So we'll see what happens with Europe and with the elections and with the US, of course, in November. But again, positioning for the portfolio for resilience, for diversification, for the medium to long term is really key.
All right, Valerie Chenine, Head of Investments, Monaco at Barclays Private Bank, we thank you so much for giving us a little bit of a roundup of what we're seeing in the markets. Coming up on the program, there's plenty of that geopolitical risk we were just discussing. We're going to talk about Reform UK leader Nigel Farage declaring his party, the opposition to Labour, in the latest surprising twist ahead of the upcoming election. Stick with us. This is Bloomberg.
In recent years,
you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Back in 2022, 2 days after Russia's invasion, members of the G7 and the European Union worked together to freeze $280 billion in Russian central bank funds outside of Russia. I'm very pleased to share that this week, the G7 signed a plan to finalize and unlock $50 billion from the proceeds of those frozen assets. Put that money to work for Ukraine.
U.S. President Joe Biden, they're speaking at the G7 for continuing support in Ukraine. Of course, this has been the subject in Bari, Italy, where we go now. Bloomberg's Oliver Crook on the ground covering every twist and turn. Ollie, walk us through just the significance of this move to use frozen Russian assets in aid for Ukraine.
Yeah, the G7 have been trying to nail this down for some weeks now. Now we have basically the structure of what that would look like, which would be bilateral loans that would be proportionate within the G7 to the size of the economies, loans that would be made to Ukraine and then repaid over time by the proceeds of those Russian assets that stand frozen. The problem is, as ever, there's always still this question of the technicalities and the actual architecture within it of how this is going to work. And frankly speaking, they have not figured that out. There is a political agreement at the top with the leaders, but there are major questions that remain still unresolved. One principle among them is how do you make sure that you insulate the taxpayers of all of these countries that are front-loading this money in the case that Russia, these assets thaw, for example. The other thing is that this is all dependent on the fact that the EU will continue to have those assets frozen, which is a decision that needs to be made unanimously at the EU level every 6 months. And you heard Biden speaking there saying that basically we'll be there to the bitter end. Another part of the conversation here is all of these leaders may not be there till the bitter end of the war. So part of this is to sort of insulate those funds and to make sure that the funding for Ukraine is on the solid ground going forward. And for the G7, it's really trying to show that sense of unity. I mean, there was sort of these spectacular displays, very theatrical yesterday, of these sort of skydivers jumping out of helicopters with each of the G7 flags trailing behind them. And then we had sort of press conferences, the breakout after that. I went to Macron's, and you can imagine that what the journalists there were focused on was not the G7 topics, but the skydive that he took politically, and that is really sort of detracting and distracting from some of the global issues here for a number of these leaders.
Okay, so a number of these leaders are under pressure at home, and that plays out on this global stage. For the G7 as a whole, though, and I know they often invite other countries to participate in these events for this reason, Ollie, a lot of questions about the influence that this global grouping has beyond the Ukraine story.
Completely, and that's why you see sort of so many having been invited. I mean, I think we're closer, I've lost track now, to G14. You have the sort of leaders of Turkey, of India, Argentina, Brazil, and this is also brought into the sort of context of this sort of fragmenting world order where the United States, the West, the G7 are very conscious of the influence that China has. Yes, trade policy is a big conversation here, but it's also a question of sort of infrastructure and the kind of influence that China bears on the sort of global South. So I spoke with Charles Michel yesterday, the sort of the council president here at the EU, asking him basically, has the G7 neglected the global South to the benefit of China, and will that change now? Have a listen.
Engage with the so-called global South. We have to listen to their concerns. We have to explain what are our priorities, and we have to build strong partnerships with them in a spirit of mutual respect, in a spirit of mutual confidence.
And to that end, Anna, they sort of declared a fund of $4 billion that's going to be backed by Brookfield Asset Management and BlackRock, which is all going to be sort of focused on developing nations and getting the infrastructure up there, really in that competition for sort of the hearts and minds of the sort of the global South and really the world that the G7 are trying to put forward here.
Oliver, thanks very much. Bloomberg's Oliver Crook with the latest from the G7 in Italy, which continues in coming days, of course. He was referencing their political turmoil, pressure, the political skydive that Emmanuel Macron has taken. Let's go to France now, where left-leaning political parties have sealed an alliance for the upcoming legislative elections. Polls suggest the bloc could become the second biggest in parliament behind Le Pen's national rally, dealing a further blow to President Macron, who would be pushed then into third place, at least in terms of this parliamentary representation of his party. Let's get more from Bloomberg's Caroline Conan, who joins us from Paris. So, Caroline, what does the union of the left then mean for the election?
You know, it's actually a big change because it could change the outcome of those legislative elections. We saw some white smoke last night with the socialists who actually did a very good score in these European elections with 14% behind Raphael Glucksmann, joining forces with the far left of France Unbowed, but also the Greens and the Communists. And as you were mentioning, this could actually create the second bloc in the National Assembly. If you look at the latest polls that we have, this so-called Popular Front of the left wing would get about 25% of the votes in the first round versus 35% for the national rally of Jordan Bardella. This could translate for between 200 and 270 seats for the far right, just short of a majority. And then second group would become this union of the left between 150 and 190 seats if we look at the current poll. So clearly, this would become the really only alternative for Emmanuel Macron to look for alliances if he doesn't want to end up with Jordan Bardella as a prime minister. Now, we heard from Raphael Glucksmann, the socialist leader, this morning on the radio, and he was still saying that this was a huge mistake from Emmanuel Macron to call these snap elections and that history will judge him.
Well, Caroline, talk to us about how the markets will judge him. When it comes to just the carnage you've seen in the last week, you've seen it in the stock market, the bond market, even the euro, far more reactive to what French assets are doing relative to their German peers. Walk us through the possibilities in the markets.
Yeah, I mean, you saw yesterday the yields of a German bonds actually reaching the widest since 2017. 2017, interesting year, because this was when the markets were worried about a face-off between Jean-Luc Mélenchon, the far-left candidate at the time, and Marine Le Pen, the far-right candidate, in the 2017 presidential elections, which saw Macron being elected for the first time. And at the time, clearly, there was even more pressure on the bond market. There was even more pressure than we're seeing currently on the CAC 40. So we can see what this could actually mean if the far left joins and is the second forces in the National Assembly on July 7, because obviously the far left also has some very costly policies. For example, they want to reduce the retirement age at 60 years old. They want to totally abolish the current fiscal rules. They want the ECB to abandon their pledge to fight inflation and instead inject directly money into government. So, you can see a lot of changes, of course, in terms of economic policies. We heard from the Finance Minister Bruno Le Maire this morning as well in French media saying that the left program is total delirium and would lead to a catastrophe in terms of the French economy. So really, we're not out of the woods yet in terms of the anxiety on the French markets and this union of the left. If the far left is a majority among this group in the National Assembly as a second bloc on July 7, this is not going to help to reassure the markets.
Bloomberg's Caroline Conan there walking us through, again, the possibilities and the tensions you're seeing in the political space that are then directly translating into the market space as well. And speaking of that, let's get a quick check on those French assets because, again, the carnage does continue. This morning, BNP Paribas is one of your biggest weights on the stock 600 and, of course, on the French index as well. In the span of an entire week, you can just look at the carnage on your screen. We are seeing yields, as Caroline was mentioning, against the German Bund to its highest since 2017. The French index getting a little bit of a mini correction there as well, down almost 5% in just 5 days. And of course, the banking story taking a pretty big of a hit as well. To me, it's euro sterling. We had a great FX guest yesterday as well, talking about the dynamics between, in the context of this dollar positioning, euro versus the pound. What's it doing?
Okay, so the rise of the right in focus in France.
Yeah.
Let's think about the right of UK politics and take us there, Chrissy, because we've had some important developments overnight. Reform UK leader Nigel Farage has declared his party the opposition to Labour after an opinion poll showed it had overtaken the Conservatives for the first time in terms of percentage of votes. The right-wing Reform Party was on 19% in the survey published by YouGov last night. That's 1 point ahead of Sunak's Conservatives. Speaking at a televised debate after the poll was published, Farage told Tory MP Penny Mordaunt, quote, "We are now ahead of you in the national polls. A vote for you is actually a vote for Labour." So he's kind of turning the tables on the accusation that's usually levelled at his party. Meanwhile, of course, the day also belonged to the Labour Party with their manifesto launch. Opposition leader Keir Starmer, who tops the polls, of course, he had 37% in that YouGov poll, had this to say on taxes.
So let me spell it out. We will not raise income tax. We will not raise national insurance. We will not raise VAT. That is a manifesto commitment. There may be some people here today who say, where's the surprise? Where's the rabbit out of the hat? To which I say, if you want politics as pantomime, I hear Clapton is nice this time of year.
Okay, and just to explain to the international audience, the Clacton reference is the constituency in the UK that Nigel Farage of the Reform Party is standing in. So he wants to become an MP there, and he's known for his theatrics, of course, and that's why Keir Starmer was trying to draw that contrast. But back to this crossover moment, as it's been dubbed in UK politics, where we see the Reform Party overtaking the Conservatives only in one poll, but it's telling a story of something that we might see in other polls as well. It's only in the percentage of seats, Critty, so this doesn't reflect percentage of the vote. Is not the percentage of seats, so it doesn't tell us about who's going to be the official opposition in the UK. But it would be a really interesting dynamic if this played out at the ballot box. It would increase pressure for electoral reform, which is not something that people normally get very excited about talking about. But if you saw a party like Reform getting such a high share of the vote and then not really being represented much in the House, that would obviously be something that we've much discussed.
Does it pressure policy in any way, though? Does it shift any sort of policy expectations one way or the other?
Well, I mean, it divides the right, doesn't it? So you get the Tory. That's what's happening here. The Tories are losing ground in terms of that battle for the right of politics to the Reform Party. I suppose in terms of where the policy shift goes, we should actually focus on what the Labour Party is doing, because they are very much ahead in the polls, of course, with 37% of the popular vote, and seat breakdowns certainly suggest that they will be victorious. But of course, we have to wait and see what happens on the day.
Yeah, we're still keeping an eye. But as Joe Easton pointed out earlier, you're already seeing some early initiations of where that shows up in various sectors in terms of how they're approaching it. Plenty to watch ahead, though. We've got consumer sentiment data. We've got the G7. We've got Oliver Crook and Anne-Marie Hordern live on the ground. Plenty of central bank speak as well on both sides of the Atlantic. Plus, of course, the Euros. If you are already checked out, you're ready for the football, that is for you. Plenty more coming up today. Tom McKenzie will be taking you through the next hour. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie, stepping in for Francine. Here's what's coming up on today's programme. BOJ Governor Kazuo Ueda sees the possibility of a rate hike in July, depending on the data, and says the cut to bond buying may be substantial after delaying its decision. European stocks slip and the French bond rout is in focus. But over on Wall Street, the S&P 500 notches up yet another record high after PPI, producer prices, come in lower than expected. Plus, Joe Biden vows Ukraine's allies will stand with it until they prevail in the war with Russia and praises the latest G7 support plan. We are live on the ground in Italy with the latest. Let's check in on the markets then, and you are getting a divergent picture this week in terms of the performance of US markets. We've talked about that fourth consecutive record for the S&P, and the picture for Europe. Europe currently set to end the week lower. We'll see how it transpires in the session today, but you can see red on the screen once again. The French markets continue to be in focus as we got more details in terms of the political splits in France on the left and the right. The CAC aren't in focus, the banks and luxury under pressure on reports as well that some of the big French names exposed to China having to cut their prices, and pretty significantly. So you can see the red on the screen there as we flip the board and look at what's happening in the currency space and reflect as well on the benchmark US 10-year, given another successful auction of 30-year debt Treasuries yesterday in the US, 22 billion, well absorbed by the markets, the highest bid to cover ratio that we've seen year to date, suggesting the market is able to absorb that issuance, and maybe investors as well wanting to lock in yields before those cuts come through with the Fed, with markets now expecting up to 48 basis points of cuts potentially from the Fed this year. S&P futures then currently pointing lower by just 0.1%, again with the context that you've seen 4 straight days of record highs, led as well, powered once again by IT and tech, with the likes of Broadcom, Tesla in focus. The 10-year then at 4.22, comfortably below that 4.30 level, a yield move just 1 basis point so far in the session. The Japanese yen down 0.4%, but pairing some of the heavier losses of the session after we heard from Ueda pointing to the possibility of July in terms of the next hike, and saying that the moves and adjustments around bond purchases will be significant. Euro-dollar, single currency, it's been a choppy week, of course, given the politics of France. 107 down 0.3%. Let's get the details then on what we've been hearing from the Japanese Bank of Japan Governor Kazuo Ueda, saying that rates could rise in July. He opened that door, depending on data, of course, and what comes through, what transpires between now and then. At a press conference, the central bank chief also said the size of a cut in bond purchases will be substantial. The yen then pairing some of its losses, as I mentioned, on the back of those comments from the BOJ governor. Let's get the context and bring in Bloomberg's Brian Fowler, who's been watching all of this for us out of Tokyo. Brian, where does this leave us then, in your estimation, in terms of what to expect from the BOJ over the next month? To what extent can we be assured that July is next for this BOJ?
Well, one thing is clear. July is going to be a very exciting meeting for us to watch. For one thing we know for sure, we're going to get the details on those plans to reduce bond buying. After that announcement came out today, of course, we saw the yen sell off, and I think there was a broad disappointment in this very vague decision to cut bond buying but not really talk about what we're going to do. And I think a lot of people thought that that might mean, well, there's consensus on the board to do it, but there's not any consensus on how much to do. Maybe they won't do much. So that was an important point in Ueda's press conference when he came out and said, well, I can't tell you exactly what the number's going to be, but it's going to be substantial. So that's important. The other question you alluded to, a lot of economists had expected in advance of today's meeting that the BOJ would hike rates in July. And then when we saw that they hadn't really gone all the way with the bond buy cut plan, you know, they were keeping those details waiting till next month. A lot of people thought, well, they probably can't do both of those big things in 1 month. So he was asked directly during the press conference, is it possible for you to do both things at one time? He was speaking very much in a kind of theoretical point of view, but he definitely said it is possible if economic conditions warrant it. It is possible, of course, for us to go ahead and hike rates in addition to disclosing our bond buying reduction plans.
Okay, interesting. Even though only phrased within that theoretical kind of framework, given his academic background, interesting that he was able to combine the two, at least in terms of that thought process. In terms of the yen, then, as we've been discussing, it's paired some of the heavier losses of the session, currently at 157.59. Is he under pressure, the Bank of Japan governor, to provide some support? Did you get a sense from the presser that that was part of the rationale for some of these details coming through?
Yeah, that's definitely the case. So, of course, 2 months ago, in the previous press conference, Ueda came out and he sounded very sanguine about the yen. He really didn't convey much urgency, and we subsequently saw the yen sell off to a 34-year low, and that, of course, prompted Japanese authorities to enter the market with the biggest ever currency intervention. So we know that Ueda was aware of that. He got scolded by the prime minister not too many days after that happened. So this time around, we were watching very closely to see how he would talk about currencies. And he didn't say a lot, but one thing he did say was that recent currency moves could definitely be seen as a potential factor that's pushing up inflation. That, of course, is a hint that, okay, I'm watching, and this could be one more reason to go ahead and hike interest rates sooner rather than later, and that we would expect to help support the yen if and when it happens.
Okay, Brian Fowler, thank you very much indeed with the details and analysis out of Tokyo on the back of the press conference, of course, from the Bank of Japan governor and the decision, unexpected, or not unexpected, of course, to hold rates, but the details around the bond purchases and a potential additional hike coming through in July. Let's bring in Hugh Gimber at this point, Global Market Strategist at JP Morgan Asset Management. Hugh, welcome. Thanks for joining us in the studio this Friday. You've got your half-yearly outlook, and we'll get to that. But before we do, and you can tie this in, how much clarity do you think you come away with at the end of this week when it comes to central banks, given the adjustments around the dot plot from the Fed, some of the data suggesting that prices are cooling in the US, and then what we've been hearing from the BOJ?
Yeah, let's start with the BOJ first of all. I think it paints a very clear picture of the dilemma that they're facing here, which is that inflation has picked up, and for a long time that's been exactly what the BOJ has been looking for, but now you're starting to see the wrong type of inflation. This is imported inflation due to currency weakness, and that's hurting consumer sentiment and ultimately hurting growth. So this is where the BOJ know they need to act to try and stabilize the currency, but at the same time, they don't want to go too far and cut off the recovery which is in train and squeeze interest payments as rates move higher. So they are stuck, quite frankly. The Ministry of Finance trying to intervene when the BOJ is buying lots of bonds, the two don't tie together. So I think what we're hearing from this morning is that they are waiting for the Fed to move, and it's really the US economy which needs to cool further in order to take some pressure off Japan.
Well, to that point, if the BOJ is stuck and looking to some extent, to a large extent, to what's happening to the Fed, is the Fed less hemmed in than it was at the start of the week, given the data that we've seen?
Yes, categorically. I think they've been waiting for several months for a softer inflation print, and finally we've not just had one, but we've had two when you include the PPI data yesterday as well. Now, for me, the Fed meeting on Wednesday evening was an interesting one, because the headlines that came out were dot plots go from 3 cuts to 1 cut in 2024. But ultimately, in the dot plot, you've got a chunk of policymakers saying we think 2 cuts, you've got a slightly larger chunk saying 1 cut, and it's clear the Fed isn't totally sure about the path of inflation, and neither is the market. But one of the big themes in the outlook that we're talking about is that markets are comfortable, the next move is lower, and rightly so. That is what's anchoring risk assets here and providing investors with comfort to keep holding equity exposure, because the risk of a further hike through the lens that the Fed is viewing this data is still low.
Okay, so you fade the risk of a hike, and that for now is enough for these markets. You've got the AI play as well. Is there a fragility to the records that we're seeing across US stocks at this point, or is it well-founded?
So the US growth rally has been anchored on very strong foundations, but we think when you look at some of the shifting economic momentum around the world, this is now the time to start thinking about fading some of that US strength and looking to other pockets of growth elsewhere. So take Europe as an example. A tricky week, obviously, in the context of politics, but you now have European consumers finding their feet, getting back spending, consumer confidence picking up as real wage growth turns positive at a time where US consumers are just showing some signs of fatigue. So I think we could well end the year with global economy sort of regionally in roughly a similar spot. But one of the big focuses for us at the moment is you've got Europe and the UK coming from a weaker base and seeing stronger momentum, and the US economy just now cooling off back towards trend-type levels of growth.
And you don't think the political uncertainty, whether it's here in the UK, arguably less pronounced, or in the Eurozone, is going to derail that shift and the proximity now as Europe catches up to some extent with the US? You still want to be adding exposure to European equities?
So there are two sides of that argument. The first on Europe is to think about what was not mentioned in the parliamentary election, right? No mention of exiting the EU, no mention of exiting the euro from all of the right-wing parties that 5-10 years ago would have had that as front and centre. So yes, this is a tricky political time. Markets have said we'll sell first, we'll think second this week, but ultimately this is a very different policy stance from the right-leaning parties than we've seen in the past. At the same time, don't forget US political risk. A 6% fiscal deficit is a key part behind the growth exceptionalism that we've had over the past 12, 18 months. You spoke about the bond demand being smooth this week and investors looking to take down yields at these levels. But let's just bear in mind, you've got both sides of the aisle talking about cutting taxes in the second half of this year, as you see those tax cuts being continued and not allowed to roll off.
What we're seeing in Europe could be a forewarning of the political risk in November out of the US, and then positioning around that notoriously difficult. What is your advice on that front?
Of course. So another core message for us at the moment is that while the US election has to reduce your confidence effectively in any big macro view, we still feel more comfortable owning duration risk in the UK and in Europe relative to the US, given the wider range of outcomes that we see around US Treasuries. This exorbitant privilege that people talk about for the US economy, right? They can get away with running higher levels of debt than any other economy in the world. But that being said, 420 on a US Treasury, to me, is not offering you that much compensation in the context of a bond market in the second half of this year that we think will start to pay more attention to the fiscal trajectory.
Can emerging markets, can EM outperform if China isn't that catalyst within that space?
I think that's harder, frankly. When we're looking for value around the world, the core theme of our outlook is finding value, avoiding traps. We find better value in Europe than we do in Asia at the moment. Japan facing difficulties, as we've described. China, I'd say the headline here is more policy support than expected versus the start of the year, but still not enough to get that economy onto a sustainably stronger growth path. And then you look at places like India, which, yes, they have the macro backdrop, but also now looking pretty expensive. So when you're looking for value within equity markets, we tend to focus more towards Europe today relative to Asia.
Okay, Hugh Gimber, always smart. Thank you very much indeed. Global market strategist at JP Morgan Asset Management, making the case for Europe on a challenging week, of course, when it comes to the politics and the equity market story. We'll see how that unfolds in the weeks and months ahead. Hugh, thank you very much indeed. Let's check in on one corporate story that is again benefiting from the AI embed, and that's Adobe, of course, provides all of these software tools within the creative space and coming out with details that suggest it is benefiting in terms of its forecast for growth from embedding some of those AI components into its software products and the uptake that they are seeing from customers. And that stock pre-market up 15%. Another winner in terms of the AI space, at least for now, for Adobe. We continue to keep across that story for you. There's plenty more. We'll get back to the geopolitics with Joe Biden. US President, of course, vowing that Ukraine's allies will stand with it until they prevail in that conflict with Russia. We've got the latest from the G7 summit next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back. Happy Friday. Checking on one stock for you within the defence space, Rheinmetall, and that stock taking a hit, currently down 5.3%, as you can see. Details on this coming through in terms of their need for staffing and employment. Continental and Rheinmetall signing a letter of intent to cooperate in workforce recruitment, with Continental partly covering Rheinmetall's increasing need for personnel. So the concern seems to be coming through for investors that this is a company that, despite the demand, is still stressed by that need to get employees and staff into their businesses to help meet that demand. So the stock currently down 5.3%. We'll keep across that story for you. Partly linked, of course, to the geopolitics and what is transpiring over at the G7. Of course, that support, international support for Ukraine as the conflict continues. President Joe Biden vowing that the US and its allies will, quote, be with Ukraine until they prevail in this war. Leaders at the G7 summit agreeing to a breakthrough deal that will use profits generated by frozen Russian sovereign assets to provide an upfront loan to Ukraine. The $50 billion of fresh aid expected to start flowing to Kyiv by the end of this year.
Another reminder that to Putin, we're not backing down. In fact, we're standing together against this illegal aggression. The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war. In three major steps at the G7 that collectively show Putin we cannot wait us out.
Okay, for more, let's go to Bloomberg's Oliver Crook, who is in Italy covering this event for us. The G7 summit has been on the ground throughout, following all the twists and turns. Ollie, there is an agreement, but it may not be that simple. Talk us through the detail.
Yeah, Tom, so really it was very important for the G7 leaders to come here and really get something concrete, or at least apparently concrete, in terms of how to monetize those Russian assets. And so what that looks like is a front loan of $50 billion repaid in the future by the profits of those Russian assets. Now, there are a number of questions, though, technically speaking, that have not been resolved, and that, frankly, Tom, until they are, this money is not going to flow. One of them is, how do you insulate taxpayers of all of these countries from being on the hook? If these Russian assets at some point say thaw, who is going to pay those future payments on that? That is a very open question. The other question is, every 6 months, the EU needs to unanimously agree to continue to freeze those Russian assets. You have members of the EU, like Hungary, that are maybe a little bit more reticent to do that, right? And so these are all questions that still need to be resolved. So they keep saying that we need to work out the technical details. They'd like to disperse this money before the end of the year, but that hasn't been figured out yet. And Biden says, hey, listen, and so too the G7 leaders that are here now, we're going to be there till the bitter end. But they may not be there to the bitter end in terms of the fact that their mandates may expire. Biden is up for election later this year. We have all this sort of difficulty with a number of G7 countries, and you had all this sort of show of force. We had this sort of spectacular display yesterday of these parachutes coming down with sort of each of the G7 flags being streamed out. And then afterwards, we had press conferences from the leaders. I attended the one from Macron. You can imagine that the journalists were not particularly interested in what he had to say about G7 lofty global issues. The real questions for them was this sort of skydive of his political career and what that means for France and the kind of authority he has now on the global stage.
Okay, Oliver Crook, fantastic work out in Italy covering the G7 for us. Ollie, thank you. Coming up, Tesla shareholders approve Elon Musk's $56 billion pay packet and his plans for a move to Texas. We bring you the details on that story, the implications for the company. That's next. This is Bloomberg.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. Now, Tesla investors have backed CEO Elon Musk's pay package. They've given it their approval and the moving of the company to Texas. The shareholder vote was seen as a referendum of degrees on Musk's leadership after, of course, slumping sales and a drop in the stock price. Musk spoke shortly after the result was announced, where he touted Tesla's AI capabilities.
And Tesla is also the leader in real-world AI. So there's really, this is a big deal. Like Tesla is ahead of Google, Meta, OpenAI, anyone on real-world software, actually taking in video and making decisions based on video. No one is even close. And it's getting better.
No one else is close in terms of real-world AI. That, the take from Elon Musk, of course, the CEO of Tesla. Let's bring in at this point Bloomberg's Craig Trudell. Our cards are, Craig, is he right?
You know, it was interesting listening back to that audio again because, he name-checked Google and Meta during the meeting. He also, I think, Airbnb, Uber, it was like any tech company.
OpenAI, who he's not particularly close with anymore.
All sorts of companies that he name-checked last night. In terms of, the real-world AI, I do think it's fascinating because, he pointed again to this robo-taxi model that he's been flogging for years now. It absolutely is the case that they have succeeded in selling people on the ideas and the concepts, but in terms of actual execution, he does not have the self-driving car to sell anybody at this.
Is he going to get his $58 billion?
He will not get his $56 billion package as a result of last night. I think, what happens next here, he's going to, in all likelihood, appeal. He can't do that until a sort of procedural development happens in the next few weeks. Whether or not he's able to ever get this is going to be dependent on whether or not he can steer this toward the Texas courts.
Okay, I upgraded his pay by $2 billion. Thank you for correcting me on that. $56 billion. Craig Trudell, thank you very much indeed on the take there in terms of the fortunes of Elon Musk and AI. Plenty more coming up. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do.
that brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back. Happy Friday. BOJ Governor Kazuo Ueda sees the possibility of a rate hike in July, depending on the data, and says the cut to bond buying may be substantial after delaying that decision. European stocks slip and the French bond focus rout is and remains in focus. But over on Wall Street, the S&P 500 notches up yet another record high. That's after producer prices came in lower than expected. Plus, Joe Biden vows Ukraine's allies will stand with it until they prevail in the war with Russia. He praises the latest G7 support plan in Italy. Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. And again, a very happy Friday to you all. Let's check in on Adobe because pre-market, the stock is getting a healthy bump on the back of its outlook and demand from customers. And it's the AI story at play for Adobe. We're getting more color now in terms of how some of these companies are incorporating some of these AI products and services and the demand outlook, and they are expecting that to pick up. It's giving a lift to the shares, and again, it's another indicator that the AI theme has not run its course, at least not yet. Adobe getting a lift pre-market up close to 15%. Let's switch focus now to a broader space, tying into AI as well to some extent, the plumbing behind a lot of what's going on. Bullish investors are betting that the lucrative push by Goodman Group from industrial warehouses into data centers and AI has further to run. Shares in the Australia-based firm have raised more than 40%, rallied more than 40% this year, making it the top performer on Bloomberg's World Index of Real Estate Investment Trusts. My next guest is also confident about the play for digital infrastructure. Andrew Lee is TMT Group Head at Goldman Sachs Global Investment Research, with a focus particularly on the telcos space and possibly a turnaround there. Andrew, thanks for joining us. Happy Friday. Thanks for joining us in the studio. Let me just run through what's been happening with a few of the big names in this space. BT is up 9% year to date, but over a 5-year period, the stock is down 20%. Vodafone down 20% over 5 years. Telia down about 11% in the Nordics. You think there's a change happening, that this is a pivot moment for some of these telcos? Why?
Yes, so our stocks are having an exciting moment. They're starting to really ramp their growth and returns, and that follows almost 2 decades in the doldrums. What's basically happened is we've seen a deregulation in the fibre broadband space to try and incentivize investment, and this follows 2 decades of regulators only aiming about lowering consumer prices, over-regulating the sector and driving down the returns that telcos can make. That's led to underinvestment, it's led to no growth, and it's led to the telcos losing money and investors losing money. What changed is the regulators realised they need to try and incentivise investment for fibre. It was clear that the copper broadband network was not good enough, and they've done that. And what we're seeing now is the benefits of that. So telcos are starting to raise prices for higher speeds, drive their growth higher, and drive higher profits.
And they have the scope to raise those prices because margins have always been a question for these telcos. Heavy costs on the capex, squeezed in terms of the pricing, but that is trying to change, or that is starting to change.
What we've been left with after this heavy regulation is pricing across Europe in terms of broadband way below the US and Asia. And so the raising in pricing even if it's 5 to 10%, is the equivalent of a cup of coffee. So there's consumer affordability and there's consumer demand. So when we look at incumbents roll out fibre, say in the UK, within 18 months of rolling out a fibre product past your home, you're 50% likely to take that product up for a higher price. People really want faster speeds.
Some of those products, though, are coming through alternative networks, backed by private equity. There's dozens of these that are taking place, building out cables and fibre here in the UK and elsewhere as well. Is that story still a challenge for the incumbents?
Yeah, it's a classic case of private investors having longer-term time horizons for their investments and backing this early. And so private altnet companies did roll out sooner and have had some success in that. And they had that success because they had cheap rates, so cheap financing, but also first-mover advantage. What that's done, along with this regulatory change, is really kick the incumbents to roll out fibre fast. And that's what's happening now. What that's doing is taking away the opportunity for the altnets. So we're starting to see those altnets struggle, and we think that's going to lead to a wave of consolidation in that space.
What does that consolidation look like, and how accretive could that be then?
So what it should lead to, what we think it will lead to across a number of markets, the UK, Germany, Netherlands, is it will cement a duopoly in those markets. That's a market structure that can support market returns and compares to what we see in the mobile space, which is a four-player market, commoditized and doesn't generate high returns. So we think that this whole wave of consolidation will basically drive high visibility on returns for the future.
Where are we on cost savings? There's a focus in the note on it. It's an ugly word, frankly. Softwareization. Maybe you can say it better than I can, Andrew. But this is around cost savings, and this is around some upside in terms of the software capabilities of some of these telcos.
Yeah, so this is where AI comes into our sector. So telcos are really headcount dependent. They've been really dependent on customer services in the past, and they've started to replace that with AI, with mixed success. But the networks are really headcount dependent as well. And as we upgrade to fibre and as we upgrade to 5G, those networks need less headcount, but AI can help you identify problems and actually fix those problems without the need of an engineer. And by reducing headcount, that basically leads to high profits.
Do you expect that reduction in headcount to continue for some of these big names? Because they've already cut. Some of the big names have already cut thousands of workers. Does that trend continue for them?
Yeah, this is going to be meaningful. I mean, if we compare an incumbent in Spain versus an incumbent in the UK, for example, there's a fivefold difference in the headcount. Some incumbents have moved much faster, for example, in Spain to reduce headcount, but we're starting to see that followed.
There's a fivefold difference?
Yeah, huge.
Right,
yeah,
okay.
Huge.
So bad news for employees, but good news maybe for investors in some of these companies.
The headcount is shifting to other areas of the market, so into AI and into the overlaying services. So
where are we on a story about telcos railing at some of the service providers, the Netflixes of the world, in terms of running free riding on their infrastructure?
Yeah.
Have they managed to persuade? This would be a boost to revenues? They basically want these services to pay for some of this infrastructure.
Yeah.
Are we any closer to that? Is that meaningful? Does that need to happen?
We think that's a bit of a red herring as a concept. What the telcos are really railing against is not having the ability to make money in the past 20 years. And they're trying to highlight to regulators, governments, other authorities that they need to be able to make a return on their investment to incentivize them to invest in those networks and give you better 5G and bigger fibre. And so complaining about the Netflix's hyperscalers is really a way of saying we're not making money right now. That's already started to shift sentiment across the authorities and across regulators. As we said, the regulators have allowed for them to monetize fibre, and we think that sentiment could shift into mobile as well, potentially in leading to authorities allowing mobile consolidation.
Yeah, and you talked about the role of AI in terms of the software play for these companies and cost efficiencies. Is there anything else that you're looking at in terms of how AI is being layered on top of these services if not this year, then in the years ahead?
Yeah, so AI is just another extreme of this data usage. It's going to drive massive usage of our networks. And 10 years ago, more usage wouldn't lead to more money for the telcos because they weren't able to monetize it because of regulation, both in fibre and in mobile. Now we've seen this deregulation. We expect operators to be able to monetize that greater usage through charging for it in fibre. We think there's a chance that could be possible in mobile networks, and we're definitely seeing that in towercos as well. So the people that actually own the towers that support the mobile antennae, they're unregulated and they're making money from this too.
So at this point, the AI catalyst is real for these telcos?
Yeah.
Yeah, really interesting. Andrew Lee, breaking it down for us in terms of the telco space and a potential pivot moment then. TMT, Group Head at Goldman Sachs Global Investment Research. Andrew, thank you. Coming up to UK politics, and Reform UK leader Nigel Farage declares his party, quote, the opposition to Labour in the latest surprising twist ahead of the upcoming election. We bring you the details. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let's check in on the sovereign debt of France. It's been a challenging week with a sell-off pronounced, of course, on the surprise announcement from the French president that he was calling that parliamentary vote, and then what we've been seeing in terms of the alignment on the right and left of the political landscape in France. And of course, that has led to shudders in the debt markets of France with a sell-off in OATs or OATs. Here's the spread then currently, France versus the German Bund 10-year. And that spread currently at around 70 basis points. It's about the highest level, in fact, since 2017. On that concern around the fiscal expansion, potentially, if you get a Le Pen-style prime minister in France. That remains a big if, but clearly there is a concern around the fiscal situation of France, given the politics. Here's what's happening right now. There's a modest bid for French debt right now, with yields coming in. But again, given the context that we've seen this week, it is only modest. The 10-year then, currently sitting at 3.12 in France, yields down 4 basis points. Staying in France, left-leaning political parties there have sealed an alliance for the upcoming parliamentary elections. Polls suggest the bloc could become the second biggest in Parliament behind Le Pen's national rally, doing just another blow to President Macron. It's coming from the left, coming from the right. Let's get more details now with Bloomberg's Caroline Connor in terms of how things are shaping up. Caroline, what does this union then, do you think, your assessment, mean for this election as things stand?
Well, clearly this is not going to help to reassure the markets, because if you look at the program of the far left, who is part of this Popular Front alliance of the left, it includes some proposals such as lowering the retirement age to 60, such as abolishing fiscal rules, and possibly, according to Bruno Le Maire, at least an exit longer term down the road from the Eurozone. So, of course, we have to take this very carefully because we don't have yet the details of this popular front of the left wing, the details of the program, the policies. They are just at the moment saying they have an alliance. We saw some white smoke last night after their meetings between the socialists of Raphael Glucksmann, who got 14%, quite a good score in these European elections, being allied with the Greens, the far left, and the communists. So, of course, this could change the outcome of these elections. At the moment, the polls are showing that the National Rally would get between 200 and 270 seats in the next National Assembly. That's just short of a majority. And this union of the left would be the second bloc in the National Assembly. So clearly, the only alternative for Emmanuel Macron, if he doesn't want to end up with a far-right prime minister in the name of Jordan Bardella. But now, if you look at Bruno Le Maire, the current French finance minister, he's mentioning just now, this morning on the radio, that the program of the far left would also mean an economic collapse of France. So it's hard to tell what the market reaction is going to be over the next 3 weeks. If this becomes a battle between the far left and the far right, we heard from Marine Le Pen just now speaking in the north of France, saying that she promises a government of national union, because this is becoming, according to her, a fight against the radical far left.
Really fascinating on how things are shaping up there politically for France. You've got echoes of Project Fear, it seems, in terms of, there's lots of echoes with what's happened in the UK, but Project Fear is the line that's being taken by the party of Macron. It didn't play so well for the Reform Party, or at least the Remain group here in the UK leading up to Brexit. We'll see if it adjusts things on the ground in France. Caroline Connor, thank you very much indeed. And we will go to the UK right now, because Reform UK leader Nigel Farage has declared his party the opposition to Labour. That's after an opinion poll showed it had overtaken the Conservatives for the first time. Just one poll, but nonetheless striking fear, you would imagine, into the hearts of many of those Tory candidates. Meanwhile, after unveiling the Labour Party manifesto, opposition leader Keir Starmer, who tops the polls, had this to say on the question of taxes.
So let me spell it out. We will not raise income tax. We will not raise national insurance. We will not raise VAT. That is a manifesto commitment. There may be some people here today who say, where's the surprise? Where's the rabbit out of the hat? To which I say, if you want politics as pantomime, I hear Clapton is nice this time of year.
Okay, joining us now for more is Bloomberg's Adam Blenford. Adam, we have both manifestos then from the two main parties, Labour and the Conservatives. Where does that leave us, and what was the appeal coming through from Labour to voters at this point?
The appeal coming through from Labour to voters was really along the lines of, you can trust us, we're going to be sensible, we're not going to play fast and loose with your finances and by implication with the country. Starmer was making at great pains yesterday to try and stress that his party's project would be a long-term, multi-year effort to try and re-engineer and fix the UK, which has had some difficult times of late. But there were very few specifics on exactly how that might be done. And, of course, by saying very, very clearly that, you know, as you saw in the clip there, that Labour will not raise those three key taxes that are closely watched by working people and households around the country, that will tie their hands in terms of revenue-raising possibilities. You know, it's worth remembering that the UK, as Bloomberg reporters calculated before this campaign, paid something like £60 billion a year in debt interest payments alone. Labour's manifesto was setting out something in the region of £8 billion of tax-raising revenue yesterday.
Well, that's a really interesting size of scope.
So there's a lot of public services are going to remain under strain, whichever party comes into power. Which, of course, is looking like Labour.
And the former Shadow Chancellor for Labour, Ed Balls, saying on his podcast that this boxes them in, the manifesto boxes Labour in. In terms of there was a debate again last night. We're getting a lot of them in terms of some of the lead candidates. What came through from that? Where do things stand this morning, Adam?
Well, that debate happened just after the release of the poll that you mentioned there in your intro. And so, you know, really one of the headlines there was that Nigel Farage of the Reform Party, the, you know, very well-known leader of that grouping, said outright to Penny Mordaunt of the Conservatives, we are the opposition now, Reform are the opposition now. Now, of course, he's well known for making hay with these kind of moments, and he was always going to capitalise on this. But it's symbolically damaging for the Conservatives to see the idea that a vote for the Conservatives might no longer be seen as a meaningful way to cast your ballot. You know, the electoral system in this country will not favour an upsurgent party like Reform. They won't win many seats, no matter unless they get significantly higher returns. And the Conservatives will win some significant, but they could have the effect of really siphoning away Conservative voters, and that could vastly increase any potential Labour majority. So the Conservatives do have to watch out for what's happening on the Reform side, and at the moment they don't seem to have an answer to losing that support.
Yeah, the right flank just becoming ever more of a danger, it seems, for this incumbent Conservative Party. Adam, thank you very much indeed. Adam Blenford with the latest on the run-up, of course, to the UK vote, July the 4th. Talking of elections, South Africa now, let's switch focus, where the parliament there in that country is meeting despite ongoing talks on forming a new government in that nation. President Cyril Ramaphosa is seeking to be re-elected as head of the state at this sitting. According to the ANC Secretary-General, the centrist Democratic Alliance, the Inkatha Freedom Party and the smaller Patriotic Alliance have opted to join a proposed government of national unity. The ANC was forced to seek an alliance after it lost its parliamentary majority last month. Coming up, the clouds are starting to clear on a major investment in Italy's ITA Airways. Details on that next. We focus in on the airline space. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back. Now, Lufthansa is set to win the European Union's approval to buy Italy's ITA Airways. The move paves the way for Prime Minister Giorgia Meloni's government to offload a loss-making asset as she bids to improve her nation's finances. Joining us now is Bloomberg's Global Head of Aviation, Benedict Carmel. Benny, what are the corporate then and political, because the two come together in this, implications of this deal?
Yeah, hi, Tom. You almost have to see this deal in a sort of split-screen kind of perspective. There is the corporate side, and that's Lufthansa getting this asset, and it's not a very big asset by aviation standards or any standards. You know, they're paying $325 million for initial stake, and then over time want to buy the rest. The more interesting and potentially more complex part of this deal has always been the political side. You know, this is an asset that's owned by the Italian state, and it's been a real millstone around the Italian government for a long, long time. It's bleeding money, has done so for decades. It's sort of a historically unprofitable asset, well known, the predecessor Alitalia, but nonetheless unprofitable. So really there was an incentive, as you said, for Meloni to get rid of this, and they finally seem to have come to an agreement with Lufthansa and Brussels, so that sort of triangulation has finally worked out. We're still waiting for the final contours of the deal, how they actually came to an agreement, and what kind of incentives and concessions are involved. It seems like the long-haul part of the operation, sort of cross transatlantic, that was one of the sticking points. So at this point, what we have is white smoke that the deal is going through, but we're waiting for the official confirmation.
Which of the two sides, I mean, this has been long in terms of how this has unfolded. They finally got across the line. Which of the two sides made this more complicated? How did it transpire?
Well, Lufthansa always said this is an asset that we'd like to have, but we don't have to have it. I mean, Carsten Spohr, the CEO, went as far as saying, we can live without ITA, and he's probably right. But can ITA live without us? And can the Italian afford to not offload this asset? So there was a lot, you know, there was quite a lot of brinkmanship involved in this and a lot of hard bargaining. So Lufthansa always sort of said, we're willing to meet you somewhere, but you know, there is a red line for us, and probably that red line came down to how much of their lucrative transatlantic collaboration that they have with United, were they willing to cede, what kind of landing slots in Rome and Milan were they willing to cede. You know, the Italian market is a complicated market, it's lucrative, but it's also it's very crowded. You have the low costers there with Ryanair, with EasyJet, and making money, particularly on the domestic routes, is very difficult. So there's a lot riding on Lufthansa, but they had a really tough bargaining position, and given the Italian government didn't really have an alternative, ultimately they didn't have too much wiggle room.
Benny, very quickly, the Euros kicking off in Germany, not in Berlin where you are, but in Munich. What's the mood like on the ground?
You know, the mood is actually pretty good. Germany hosted the World Cup almost 2 decades ago, and back then it was sort of the summer fairy tale, as it was came to known. Whether we have a fairy tale again now, unclear. But you know, generally the mood is quite good. People are buoyant and are looking for a good time.
Okay. Bloomberg's Global Head of Aviation and temporary football correspondent, Benny Carmel, joining us in Berlin. Benny, have a great weekend watching those games. Plenty more coming up. Bloomberg Brief is ahead with Danny Berger. Stay with us. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York. and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning and happy Friday from our global headquarters in New York. I'm Danny Berger. Manis is out again this morning on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Kicking the can, the yen slumps as the BOJ makes investors wait another month for details on paring its bond buying. A win for Elon Musk. Tesla investors vote their CEO's $56 billion pay package and the firm's move to Texas into a deal. And meme stock investor Keith Gill makes GameStop moves, appearing to chuck out all of his options while loading up on shares. Well, it is a record every single day of the close for U.S. stocks. Fourth consecutive record highs for U.S. equities is today another one. We do pair some of those gains this morning down 0.2%. It has been narrow gains. It has been led by tech. But it is clear this morning that we did see some clear pairing of the bets, rather adding to bets for cuts. We're down by nearly 2 basis points yet again this morning. 422 is where you stand on your 10-year yield. We are down nearly 19 basis points for the entirety of the week. It was PPI and higher jobless claims that led to adding fuel to that, with the Fed have made a different decision if they had had that data in hand. European equities, the divergence is in. You see the CAC 40 at the bottom of your screen, down 1.5%. European equities down 1/3%, while the U.S. makes all-time highs. This is not American exceptionalism. This is European exasperation. That is the trade that is in play. And then the yen. Let's take a look at that. It is trading at its weakest level since May. A BOJ decision. Governor Ueda just moments ago wrapping up his presser. Ueda kicked the can and will only specify the BOJ's plan to wind down the bond buying at the next meeting. Joining me to break down the details is Noor Al-Ali from Bloomberg's Market Lives team. So Noor, what did we hear?
Good morning, Danny. Well, look, that yen is continuing to weaken, and there are a lot of risks now of intervention because there's still not enough clarity for traders to see on what that, what the scope or that pace of bond buying is going to be from the Bank of Japan. Now, Ueda was asked, is there a scenario where they would also raise rates and cut down their purchases? And he said, well, yeah, it's possible. But you saw the reaction in the yen afterwards. It's still hovering near the lows in quite some time. And reminder as well, Danny, that officials in Japan did step in to prop the currency last month in the biggest operation ever on record. And so that renewed risk of intervention comes as the yen hovers near a 3-decade low. Is not looking good. And also a reminder that weakening of the yen is inflating those price pressures in a way that's quite unfavorable and hard to tame, also denting consumer sentiment. So the Bank of Japan has a lot to consider for its July meeting, and that's quite interesting for traders in the run-up to that as the yen continues to slump.
Okay, Noor, thank you very much. Noor Al-Ali there from our MLive team. Yeah, the yen this morning currently trading at, let me just pull it up, 157. So we're getting closer to that 160 level that we last saw intervention. Let's get over to Mark Dowding of RBC Blue Bay Asset Management. Mark, let me just get your first take of what you thought of the BOJ decision and what we heard from Ueda.
I think in many respects today was a disappointment. We had hoped that you would actually see more decisive action to reduce the bond buying. I think that bluntly, at a time where every other central bank is delivering quantitative tightening, we've still got easing of balance sheet in Japan, and that QE continues to be the driver of a weak yen. It's almost as if Ueda doesn't really care about the level of the yen, which must be something that's exasperating his other political counterparts.
Mark, if I can just jump in on that point, because we've heard different Uedas. Last BOJ meeting, he also didn't really care about it. But then last month, I pulled up some of what he said. He said, we'll closely monitor how weak yen will affect prices. That abrupt one-sided weak yen is negative for the economy. And then, as you say, we get this press conference where not only does he not say that, he refuses to actually comment on the yen when asked a question. So which Ueda should we be listening to?
Well, I think bluntly, actions speak louder than words, don't they? And the fact is that although in the press conference today, some of his comments were maybe designed to be a little bit more hawkish sounding, the reality is that the inaction today is a relatively dovish signal. And I would infer that if it weren't for the fact that we're seeing a risk-off trade across European assets first thing this morning, and that's creating a bit of a flight to quality bid for safe havens, and that's actually something that's actually a factor that's benefiting the yen. If it weren't for that, I think that we would be north of 158 and really talking about setting up a test of 160 on dollar yen and speculating about when we might be needing to see a further round of intervention.
Do you think that played into Ueda's mind, looking at what's happening not just in Europe and a weaker euro, but also in the U.S. with inflation data coming in and perhaps the weakness to the dollar that will bring? Is Ueda just saying, hey, I can play for time here, there is no rush?
Yeah, well, so one of the things that sometimes surprised me in my dialogue with the Bank of Japan, it sometimes seems they spend more time trying to analyse the US economy and US data than they do their own domestic data. For a long time, they've been trying to predict a recession that's never come in the US. And one of the reasons, bluntly, why I think the Japanese authorities have been caught out and the yen has been as weak as it has been is because the BOJ have wanted to believe that the US would start cutting interest rates already. And I think that in some respects, they should be paying a bit more attention closer to home, because there's no doubt that the policy setup is currently more stimulative than it was at a time when deflation was a much bigger threat back in 2016. We continue to see inflation running ahead of target. And actually, this is stoking inflationary pressures. And there's a danger, the more the BOJ gets behind the curve here, the more the danger is they're going to have to overreact and tighten policy more aggressively, say at some point in 2025.
Well, just to play devil's advocate, I'm sure part of what's going into it is thinking of taking his time is some of the growth figures we've seen. GDP shrank 1.8% in the first quarter. Sure, wages were higher, Mark, but it's not necessarily clear that that's translated into consumer sentiment. Why isn't that not right? Why doesn't that say that they should have patience, that they shouldn't be rushing into dwindling the bond buying program and to be raising rates?
Yeah, well, I think the just on GDP data, there were some special one-off factors, right? There was the Kansai earthquake at the start of the year that impacted GDP figures on the back of a auto shutdown. So we've had some disruptions to GDP, but underlying economic data is strong. It is robust. The trend is there. In terms of underlying sentiment in Japan, it feels as if there's almost this narrative of a lost generation rising up as Japanese citizens are becoming a little bit more confident in terms of the outlook for their country on a forward-looking basis. The reflation trade is on in Japan would be the message, we're not arguing about sort of the BOJ moving to a restrictive policy stance. It's just the fact that this overtly accommodative position that they find themselves in, where they're not just running 0% interest rates when inflation is running 2.5%, 3.5%. They're also delivering QE by continuing to grow the balance sheet. Again, this is a factor that's only contributing to yen weakness and is stoking those inflationary pressures further.
So do I take it you don't really buy it when Ueda says, as he said many times during his press conference, we don't use the reduction of JGB purchases as an active monetary tool, something he's continued to say since March, since he kind of let go of the reins in their control of government debt yields. Do you just not buy that?
Yeah, I think plainly speaking, that's a wrong thing to be saying. I mean, when you're delivering QE, this is being done to deliver policy easing. QT is delivered to conduct monetary policy tightening. I'm sure that this is very clear to Ueda, so maybe he's trying to dance around and be careful about what he's saying. And I think there's almost this sense in which they want to move on a very conservative path. But bluntly, controlling both the supply as well as the level of interest rates, these are key monetary policy tools used in conjunction, and it is overtly the monetary policy of the BOJ which is responsible for the weakness of the yen at this point, because we can all see otherwise the yen's a really cheap currency. It's a currency I'd like to own, but the BOJ are making it impossible for me to buy it.
Yeah, I know you've said this before, that you really cannot buy the yen or go long in the kind of chatter that we've heard because of the back and forth of the BOJ. I mean, Mark, this is pretty scathing criticism of Ueda. Is there anything he's doing right?
Look, the country is in a good position. I'm just fearing that actually by being too far behind the curve, you're setting up a real problem for times to come. Because if the BOJ gets too far behind the curve and they end up needing to over-tighten, then that's going to be something that ends up choking off the Japanese economy in a future point in time. So yes, I feel somewhat frustrated that the BOJ, not just Ueda, but the entirety of the BOJ doesn't really sort of see the narrative that actually they are responsible for driving yen weakness. And they should be sort of turning to actually adjust policy here. But otherwise, look, time will tell whether he's the smart guy or not. But I do think that the reflation trade is there for all to see. And I think that the BOJ at this point are behind the curve, and the FX is showing that that is overtly the case.
Well, to that point, Mark, when you last spoke to Bloomberg in April, you said that you were maxed out on JGB shorts and all the relevant funds, that you could do that. Do you still have that position?
Yeah, absolutely. I still am very convinced that policy is going to be normalizing in Japan. I mean, we've heard today that we're going to see a substantial reduction in JGB purchases after the July meeting. If you compare where the 10-year JGB is compared to the 30-year JGB, it's a very wide spread. It kind of shows you how artificially rich 10-year JGBs currently are. We think that those yields should be north of 125. And so with that being the case, with the reflation trade on, with the yen remaining weak, with inflation moving higher, you can be confident that JGB yields are only going in one direction. So we're very happy to
Mark,
sit with that
just quickly,
position,
because we have to wrap this up soon. Do you think that they can hike in July or no, now that we don't have the bond buying details?
So given how Ueda's been behaving, I think that that's unlikely that they'll be doing both things at the same time. September is probably the earliest now.
All right, Mark, we really appreciate your time this morning. Mark Dowding of RBC Blue Bay Asset Management with some clear words for you, Ada, there. Okay, let's get to some of the other top stories trending on the terminal this morning. Wells Fargo has fired over a dozen employees last month after investigating claims that they were faking work. A review found that they were simulating keyboard activity, creating an impression of active work, another thing where we kind of toggle the mouse. Wells Fargo started requiring employees to return to the office 2 years ago under a hybrid flexible model. A judge looks set to reject a $30 billion settlement between Visa, MasterCard, and retailers, which would have had capped credit card swipe fees. The federal judge suggested that she would not sign off on that deal. Retailers have long fought against fees for processing card payments, most of which go to banks that issue the cards. And some luxury labels are discounting their products like never before to woo Chinese buyers. Balenciaga, Versace, and several other premium brands have slashed prices, some by more than half. This price war would have been unthinkable just a few years ago for the labels whose growth stems from an image of exclusivity. Okay, coming up, Tesla shareholders back Elon Musk's pay package and the proposal to move the company's legal home to Texas. And Manish Kabra, head of U.S. equity strategy at SocGen, joins us to look back on a divergent week of fortunes between the U.S. and European equity markets. We'll give you the context here on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The leader in real-world AI. So there's really, this is a big deal. Like Tesla is ahead of Google, Meta, OpenAI, anyone on real-world software, actually taking in video and making decisions based on video. No one is even close. And it's getting better.
Bold claims about Tesla's AI leadership at the company's annual meeting yesterday. And Elon Musk, it's perhaps a more relaxed Elon Musk after his leadership and his pay package was voted in by shareholders. That was the $56 billion pay package. And then at the same time, moving their company's legal headquarters to Texas. Dan Ives writing in after it that the proposal passes and overhang is removed, now putting the price target at $350. Let's get over to Bloomberg's Craig Trudell on this. Greg, okay, so shares rally yesterday when Elon Musk tweeted out that it would pass. It passes. Tesla continues to rally. The question is when we hear Elon Musk, who's more emboldened, talking about their AI bets, talking about being a robotics company, talking about $25 trillion market cap, is this actually something that the market is going to like, an emboldened Elon Musk?
I guess, you know, there will be a contingent of people who will, you know, respond to this with color me skeptical. And I think back to, you know, past events when Musk, you know, talked about within a year having, you know, millions of robo-taxis on the road. You know, at the time that he was making those predictions, you know, he was offering autopilot and you know, these driver assistance systems. That's really still where they're at, you know, 5 years later. The sort of narrative now is you know, taking robots, which, you know, he has all of 2 operating at Tesla's California car plant, and sort of, you know, extrapolating that out into, you know, trillions of dollars in earnings sometime out in the future, despite the fact that, you know, this robot he's saying is not going to be in limited production until next year. And so, you know, I think there's going to be a lot of, you know, proof in the pudding required to really sort of start to factor that into valuations, at least among some investors.
Yeah, I'm just looking at what he said yesterday, Craig. While autonomous vehicle is a $5 to $7 trillion market cap situation, Optimus is a $25 trillion market cap situation, which again is the robots. But isn't this exactly the thing that upset shareholders last time, that it was a Musk who was concentrating on the bots and instead not on cheaper vehicles?
I do think that was one of the interesting things last night was, you know, when he did talk about the car business, which, you know, was only in little spurts, he talked about the notion that, you know, it's tough sledding out there. And so, you know, I do think we're going to find out in the coming weeks that, you know, Tesla has not necessarily, you know, bounced back in a significant way in terms of the number of cars that they're selling. They had a really disastrous first quarter, and we've not gotten indications that things have gotten better, you know, maybe incrementally, and you would expect that just from a sort of seasonal perspective. The first quarter is always, you know, the toughest for the industry. But, you know, this is a company that, you know, is still highly reliant on just a couple of models that are still, you know, fairly costly. And, you know, this plan to bring a $25,000 Tesla to market is very much up in the air and seems to have been, you know, completely set aside in pursuit of this robo-taxi business, which, you know, Musk, again, has been promising for years but not been able to deliver.
Okay, Craig, thank you very much for that. That is Bloomberg's Craig Trudell on the continuing drama of Elon Musk and Tesla. Okay, let's switch gears a little bit here and talk about GameStop. Meme stock cult hero Keith Gill, better known by some as Roaring Kitty, appears to have exited his entire options position in the video game retailer. His $20 calls were traded nearly 142,000 times over the past 2 days. Joining us now for more is Bloomberg's Tom McKenzie. Tom, every time he tweets, Reddits, whatever it's called, posts a screenshot of his position, something happens with GameStop. Everyone gets excited. What's happened this time?
Don't pretend you don't know what happens in the world of social media and meme stocks, Danny. You're all over this. Yeah, Roaring Kitty, deep F -- value, whatever term you want to go with Keith Gill. Look, every time he moves, this stock moves, right? So the details are, again, we haven't confirmed what his exact holdings are, but again, this is on the screen grab that we've seen that he's posted. 120,000 call options that he bought, and they expired January the 21st. It seems like he's sold out of those. He bought them for just over $5, $5.60. He's selling them, it looks like a range of between 6 to 8, so he's still making money on this. And it looks like he's getting a clearer and a cleaner exposure to this stock, because again, according to this picture and the photo that he posted of his holdings, it seems like he's increased his holdings to about 9 million shares now, which would in theory put him at potentially the 4th largest shareholder in this company. But you're absolutely right. Look, there was a lot of volume at play in terms of the options trade and a lot of volatility.
The irony of this is that it was ahead of GameStop shareholders meeting, which apparently they had to postpone because of technical glitches. So you have the situation where the stock is rallying more than 14%. They can't even hold their investor meeting because there are technical glitches. But I guess for the stock itself, Tom, I mean, this thing is continuously volatile. It maybe calmed down before the return of Keith Gill. So what does it mean for the reignition of the meme trade, of the GameStop trade, that we have this out there in the ether yet again? Yeah.
I mean, frankly, we do not know. But what we do know is that the stock was at $45 earlier this month. It's now, as you can see, $28.85. They did take advantage of this, the company, with that share sale of a little over $2 billion US. You're absolutely right. It was like a scene out of the TV series Silicon Valley. They weren't able to hold that shareholder meeting because the tech wasn't working. So we'll wait to see what happens on that front. I'll let you know that the short interest has gone from 20% of the float to 15%. So the short interest, they pulled their heads in a little bit on this stock.
Another bad day to be a believer in the efficient market hypothesis. Tom, thank you so much. Bloomberg's Tom McKenzie. Okay, coming up, we'll take a look at your headlines around the world here on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the Let's get you some of your front page news. First up on the Bloomberg this morning, President Biden has signed a bilateral security agreement to aid Ukraine long term. He's also warning China and their aiding of Russia's war effort. Next up on the FT, France's left-leaning parties have made an alliance for the upcoming elections. However, it shows that the new alliance could be bigger than Macron's in Parliament. And then finally, Donald Trump said that he has told U.S. CEOs he will cut the corporate tax rate to 20% if he wins in November. This from the New York Times. He was in Washington to meet with around 100 CEOs, including Jamie Dimon and Tim Cook.
my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Authorities.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our global headquarters in New York, I'm Danny Berger. Manish Cranny is on assignment. Let's set your agenda. Kicking the can, the yen slumps as the BOJ makes investors wait another month for details on paring its bond buying. It's a win for Elon Musk. Tesla investors vote for their CEO's $56 billion pay package and the move to Texas. And meme stock investor Keith Gill makes moves on GameStop, appearing to chuck out all of his options while loading up on shares. 4 consecutive records for this equity market. That's what we've seen this week. A little bit of weakness coming for U.S. equities this morning. So that's what we're seeing. There we go. S&P 500 futures down about 1/3 of 1%. The rally yesterday, yes, it had been fueled by a softer PPI, higher jobless claims, yet it was tech that really prevailed. This morning, it is Adobe shares, which are moving higher, some 14% pre-market. U.S. 10-year yields drop another 2.5 basis points this morning. 421 is where you stand on your U.S. 10-year yield. They have fallen 19 basis points so far this week. Meanwhile, the yen continues to weaken, 157, weaker by about 1/3% versus the dollar. We're just speaking with Mark Dowding of RBC Blue Bay, who is extremely critical of UATA, saying that he should not have waited to give the details of the bond buying program, and that means that we won't get a hike until September. He is still max short JGBs. Now, even though U.S. futures are down this morning, they are up for the week, and it is a diverging fortune of both U.S. and European stocks. Now, while American equities, as I mentioned, have notched a 4th consecutive all-time high, the Stoxx 600 has had its worst performance since April. French stocks absolutely pummeled. Look at that, down more than 5%. Their worst since July of last year. All of this has been spurred by political uncertainty after parliamentary defeats that question the fortunes of France's Emmanuel Macron and other left and centrist leaders in Europe. Let's get to Manish Kabra, head of equity strategy at Societe Generale. Manish, thank you so much for joining us this morning. Look, part of the hope for this year was a broadening out of the stock market, was that maybe it wasn't just U.S. tech, that not even just U.S. stocks, but European stocks. Does the volatility in Europe and the volatility of politics in Europe make that trade untenable now?
I would say the European politics is always, as in it does flare up time to time. We have seen, even for European equities, predominant, of their exposure is outside Europe. Even for, CAC 40, 80% exposure is outside France. So I think volatility is definitely, the talking point. But as in usually whenever you have any volatility around the world, most global investors, they switch to the U.S. and I think S&P keeps benefiting on that.
Yeah, but to be fair, Manish, we do have elections coming up in the U.S. Is this not just maybe a taste of what's to come in November?
As in, it's a very close poll. As in, you look at the probabilities of different parties. Both the parties, I would say, broadly, they have very different agenda, very different elements, and a lot of different, ways to invest for both Biden versus Trump. But what's not changing under both is literally the fiscal plan. There's no fiscal prudence in the U.S. and hence, I think equities, nominal earnings, they keep getting supported. So I think the overarching theme is literally profits are the glue. Profits are very sticky. Profits are broadening, as in market is not liking that broadening of profits. Market is getting concentrated in certain parts. But, at the same time, I would say one of our biggest call has been, buy NASDAQ equal weighted, even if you don't want to buy S&P equal weighted. There are ways to position on the broadening within certain themes.
Well, to that point, your target is 5,500. Are you preparing to up that target?
Good question. I have already upgraded.
Oh, you have?
I think three. No. I've upgraded 3 times in last 12 months. It's a. We got bullish U.S. stocks. In June last year, we have been upgrading ever since. At this point, it feels like to really upgrade, more from here, we have to expect at least 4 Fed rate cuts. And it's not very clear where those 4 Fed rate cuts are coming. As in we have seen even from the ECB, they waited for 6 months of inflation below 3% before they would go out and cut rates. Same thing happened in Canada, and I think those are the places where I think there has been a lot of to and fro moving parts, a lot of things moving around, but ultimately U.S. bond yields are between 4 and 5. And hence, profits really stays the story, for the equity market. So if I have to sum it down, the 5,500 target to really raise from here, you have to upgrade phenomenally, from already bullish earnings expectations, which can happen, but we need at least 4 Fed rate cuts. We are not expecting any rate cuts this year.
Right. That's the thing, though. Okay, so profits look good, but if you look at what this market is really rewarding, it continues to be those tech stocks, and especially those with an AI bend. Adobe, for example, those shares up 14.5%, I believe, in the pre-market trade, just because they are adapting to the AI environment. Well, Manish, that's not necessarily profit. It's a very specific type of profit in consideration around margins about one specific program and type of offering, that is AI offering. When does it broaden out?
So let's think, right, where, we have seen 2 elements, right? As in one, NASDAQ 100, the benchmark index where we have all the tech companies, its profit growth is going to show 35% earnings growth, for the second quarter reporting, which will, happen in the month of July. So as in market is thinking, where is it? I have got the level of earnings growth. And currently, I'm just watching, top 4 tech stock, apart from NVIDIA, but top 4 tech stocks, they're all customers of NVIDIA, and, watching the revenue trends of those companies, they have mid-teen revenue growth. And I think that's what fueling the earnings excitement. And that has been the story, that has been the key call, which is if you're going for level of growth, it's in NASDAQ 100. If you're watching direction of growth, then it's outside NASDAQ 100.
Okay. So if it is the direction of growth, I mean, small caps have not done well. It's a lot of head fakes, a lot of optimism for them. They still haven't. I mean, these are companies that have a lot of floating rate debt that don't do well in a high rate environment. Manish, my question to you is, even if we get 1, 2, 3 rate cuts, is that really enough to solve the issue that small caps are facing, that they do have to face this refinancing wall, maturity wall that's going to be coming in 2025 and 26?
Yeah. So profits for small caps, it's flat, flat for 2 years, despite very strong nominal growth backdrop. And you're absolutely spot on. There's, phenomenal pressure, for small companies on refinancing on the level of rates. What really solves here, as in typically, when does it small cap earnings outperform large caps? When does it, small caps outperform large cap? Usually for those things, we need, yield curve of at least 100 basis points. And we are far away from that. And hence for, almost 3 years, the trade we have pushed, long S&P, short Russell, there's no rush to change that. But, at the same time, I think it's so much still hinges on to what degree, Fed will cut rates. If I look at mid-90s backdrop, non-recessionary rate cuts, Fed had maximum 3 to 4 rate cuts, and they stopped it. But at the same time, we had 6 years of outperformance of S&P versus Russell. As in currently, I would say we are only 2/3 of the way into that outperformance trade. So I think small caps are stuck, but ultimately, when do you buy it? Whenever you get conviction, yield curve is at least 100 basis points.
All right, Manish, we're going to have to leave it there. Thank you so much for joining this morning, Manish Kabra of Societe Generale. Okay, coming up, I mentioned it, Adobe shares set for their biggest gain in about 4 years. We'll break down the earnings for you next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief on this Friday morning. I'm Danny Berger in New York. President Biden has hailed a 10-year security agreement he signed with Ukraine. It's a sign that Washington and his allies are not backing down from their support.
Another reminder that to Putin, we're not backing down. In fact, we're standing together against this illegal aggression. The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war. In 3 major steps at the G7 that collectively show Putin we cannot wait us out.
The G7 yesterday had agreed to use profits from frozen Russian assets to provide $50 billion in aid to Ukraine. For more, let's go live to Puglia, Italy, where Bloomberg's Oliver Crook is there for the summit. Oliver, we had this agreement. I mean, I guess it was this elegant way of not actually using the funds themselves, but instead using the interest earned on the fund. So this agreement, how straightforward is it? How easily will it be implemented?
Right, so the idea, Danny, is to cut a check basically today for the future profits, right? And that's about a $50 billion check, and that is what the political leaders here in Puglia have agreed to of the G7, and that'll really take the form of a loan to Ukraine that will then eventually be repaid by the future profits on these Russian assets. Now, that sounds maybe simple. That doesn't even sound that simple, but it's even more complicated than that, because you have to sort of make sure that, for example, if these Russian assets were to thaw, let's say that there's a peace agreement at some point in the future, who is going to make that whole, right? This cannot touch the taxpayers of the G7, because this will only fuel a lot of the pressure that some of these G7 leaders are feeling at home. Let's add another complication here, Danny. These EU sanctions that actually freeze the assets need to be renewed every 6 months by the EU unanimously by every country in the EU. Hungary, for example, doesn't often like to play ball with these sorts of things. Could that block? So these are the sort of technical aspects that really need to be worked out, Danny, if they want to move forward with this, and they really want to move forward with this and get the disbursement by the end of this year, Danny, because the other thing is many of these leaders, though they say they'll be there till the bitter end, they may not, because they may just simply not be reelected. So really they need to future-proof this sort of effort on their part, and that is what the G7 wanted to sort of unify and do here.
To that point, Oliver, I mean, it is basically Maloney's show. The rest of them, France, Germany, even in the U.S., there is, as you say, a question as to whether they'll be there next year, especially after the European parliamentary election. So in this idea, as you say, to future-proof some of the aid they've given, how successful have they been at, not just in Ukraine, but really their presence in the G7 and the impact that they can have today?
Yeah, so listen, Danny, I mean, the Ukraine has sort of been the big topic and the sort of $50 billion, that was sort of the big deliverable here. But this wouldn't really be a G7 meeting, Danny, if the topic of China didn't come up. So obviously this question of overcapacity has come as a sort of center stage. But there's another one, Danny. There's also the sort of influence that China has over the world in a way, in a time when there's sort of a more fragmented bipolar world, right? That is part of the reason why they've invited leaders from other countries outside of the G7. I mean, by my calculation latest, it's closer to a sort of G14. You have Turkey, you have Brazil, Argentina, you have Kenya. And I think for many of the leaders here, they're aware not just of the trade distortions, but the influence that China has in these countries. I spoke to the European Council President, Charles Michel, about this and basically asking, has the G7 failed to sort of exert its influence in the global south to the benefit of China? Have a listen.
We have to engage with the so-called global south. We have to listen to the concerns. We have to explain what are our priorities, and we have to build strong partnerships with them in a spirit of mutual respect, in a spirit of mutual confidence.
So U.S. officials and Western officials are very cognizant of the fact that they often show up in some of these global South countries and talk a lot. When China shows up, they build things. So one of the measures that they've taken here is a sort of investment fund on sort of energy and infrastructure that's been backed by Brookfield and BlackRock. And this is a $4 billion fund that's supposed to sort of touch these things. But we need to place it always, Danny, in that geopolitical context about global influence.
Okay, Oliver, thank you very much. Enjoy the rest of your time there in Puglia. Hopefully you get some time off now to enjoy the sun. Oliver Crook reporting live from the G7 summit in Italy. Okay, let's get you a check on Adobe shares this morning, because they are set for their biggest gain in about 4 years after catching the AI wave. A nice even 15% is what they're up this morning. Let's get over to Matt Bloxham from our Bloomberg Intelligence team. Matt, I thought Adobe was supposed to be one of these companies that was threatened by AI, that AI could replace. Instead, they're using it. What exactly went on?
Yeah, it's interesting, isn't it? I mean, it's a company that investors are really struggling to kind of put in the right bucket. You know, I think going into the results, as you say, people were very worried that we were going to hear them talk about a commentary that was showing that pressure we were talking about from generative AI tools that lots of other companies who hadn't heard of a year ago are now developing. But I think they've done a very good job. Firefly is their kind of generative AI engine, if you like, integrating that into their suite of creative products, things like Photoshop, and that's landing really well with, I'd say, professional users of these products. So I think obviously a lot of consumers are taking advantage of things like Midjourney, which are free to kind of get more creative, but professionals are still trusting people like Adobe to deliver what they need. And that's to some degree because of these issues around copyright. And the Adobe systems, certainly for the image generation, are trained on a kind of copyright safe, if you like, environment, and that's giving confidence to business users that they're not going to suddenly land in some kind of legal issues further down the line. So, the products are developing, are landing well. They're really taking advantage of their own investments in generative AI. But even, I think, in the consumer space, they showed signs overnight that actually they're getting some traction against some of those newer competitors. So, I think this was definitely a surprise to the market in terms of the positive and upbeat commentary that the company provided.
Matt, if we just take a step back, because you could look at this week's earnings of Adobe talking about AI, Broadcom talking about AI, and say, okay, we're back to the era where all you need to do is mention AI in your earnings call and in your earnings report, and you rally. But let us not forget that we also had Meta this earnings season. We also had Salesforce this earnings season, who tried to do the same unsuccessfully. So what has differentiated the haves and the have-nots between the tech companies who are trying to tout their AI offering in their earnings?
Yeah, it's a good question. I think, some of these companies like Salesforce, because they're perhaps their kind of AI journey is perhaps a little kind of later in the cycle, and their revenue is much more heavily reliant on, I guess, kind of more regular mainstream IT service spend. And what we have seen is, the economic environment isn't supporting huge budgets for IT spending, so they're feeling that pressure too. And what budgets there are shifting to very much the kind of first wave of AI investment, which is kind of playing into kind of a very small group of companies like NVIDIA, for example. And some of these companies like Meta are having to increase their investments in the infrastructure that they need to actually deliver these AI services that sit on top of them. So there's a kind of mixed kind of set of messages going on there, kind of dynamics. The companies that have really benefited so far, this very small group like NVIDIA, that are very much at the first wave driving this generative AI revolution. But even though things feel like they've changed a huge amount in the last 12 months, we're still very much at the early stage of this journey. I think there's still a huge amount of change to come this year, next, and the year after in terms of how this market evolves. More products coming to market. Some of the companies that we're talking about today will probably fade. There's a bunch of companies that we don't even know about yet that are going to come into the prominence over the next year or two. So I think there's going to be a space that keeps us talking and scratching our heads for quite a while.
Yeah, Matt, I think the point that there are going to be some things that fade, some things that AI replace. We're all excited about the winners now. I don't know if we've really contemplated the other side of that. Matt, thank you so much for joining us all this week. Matt Bloxham of Bloomberg Intelligence. Okay, you might have noticed my lovely co-anchor Manus Cranny has not been here because he's been in Rio. So let's head over to there where Manus sat down with the CEO of Vale to discuss his outlook for minerals and deals in the space. He was speaking on a panel at the FII Institute conference. Take a listen.
In 2000, they were producing 100 million tons of crude still. In 2010, they were producing 600 million tons. In 2020, they're producing 1 billion tons. This is a super cycle. Where can you see that again? You can see that in nickel, you can see that in lithium, you can see that in copper, but the only commodity today that is being perceived as a no-brainer is copper. So I don't see super cycle. By the way, I see a super cycle smallish on high-quality iron ore. Canada, I think Monday just put iron ore, high-quality iron ore, as a critical mineral that we was always fight over, because it's a matter of how can you triple or double, triple demand. So that's where the super cycle comes.
But do you think that the regulation that they've introduced on the housing, sorry, I'll let you finish in a second. Do you think what they've done on housing, you've got to talk about EVs, he's got to talk about housing. Do you think the policies enacted in China will clear the surface?
No, China has definitely plateaued. I didn't listen to my CFO yesterday, but I'm sure we talk the same. We plateaued, but at a decent level. It's going to plateau for a while because China has all their means, although they really rely on real estate. They have to tame the downside of the real estate, but they're they're shifting their industry like every other economy did. So China is in a plateau for that, and it's going to consume the rest. So that's, I think, where it will go.
We saw a massive mining deal fall apart. BHP Billiton and Anglo-American. In many ways, what this says to me, there will be a race for M&A, especially in sustainable critical minerals, on a fast response. Don't you say to me 80% of my world is iron ore. I want to know whether you've got FOMO on not doing a deal in critical minerals that we talk so much about.
Very, very, very fast. We are very unique because we have a growth platform in iron ore that is 80% of our business. We can grow from 320 to 350, 360, so that's it on high quality. And we had a deal with Manara, by the way. We already did our deal. We had a partnership with Manara, that is PIF and Ma'aden, for 10% of our base metals business that we want to grow. We want to double our production of nickel and triple our copper production. So we have enough in our plates to do it. We don't need to merge with anybody. We don't need to do like the other ones that have to merge. But if anybody wants to talk to us, we are open.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Friday. We're going to get UMich Sentiment Survey. That comes out at 10 a.m. Eastern. And then don't miss this one. Bloomberg's Mike McKee will be sitting down with the Cleveland Fed President Loretta Mester. That's at 1 p.m. Plus, we're going to hear from ECB President Christine Lagarde. She will be speaking at 1:30. Okay, some individual movers for you. Tesla, investors backing Elon Musk's pay package, $56 billion. It moved higher yesterday, up another 1% this morning. Pinterest, that is extending declines. Piper Sandler noted weaker growth in Amazon traffic, down more than 4.5%. I want to leave you with this, though. The Cacaron down very much so this morning. It's down 5% for the entirety of the week. It has now erased its entire gains for the year. That is political volatility, plain and simple. It's not American exceptionalism. It's European exasperation. That's it for Brief. Surveillance up ahead.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The theme is still patience, and the Fed just wants to see more data to make sure that inflation is convincingly moving lower.
There's no clear indication that they're going to need to rush into cuts. They're trying to tell us that they're keeping all optionality open.
Even if there was a shift in the pace to get there, it seems like their direction of travel is still towards a rate-cutting cycle.
It is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It's our favorite time of the week. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now with equity futures down about 0.5% on the S&P 500. We have had a record-breaking week. 4 consecutive all-time highs on the S&P 500. Can we make it 5 for 5? Let's go through the week. CPI, downside surprise. PPI, downside surprise. Jobless claims, the wrong kind of upside surprise. If you took a step back and looked at the equity market this week, you'd have no idea that very confused Federal Reserve meeting even took place.
Because what's going on is the same thing that's been going on all year. The macro-related stocks kind of wavering around, but the AI driver is just powering ahead. And so when you look at the index level and you see a 29th record high this year, yet another one, you have to wonder, is this reflecting broad strength or is this just reflecting the dominance of U.S. tech?
We've had quite a move in the bond market too. Double-digit moves Across the curve, the 2-year and the 10-year, something like 20 basis points plus on a 2-year and a 10-year. The 10-year this morning down 4 to 420. The 2-year down 2 to about 467. And some news coming out of Washington, D.C. that we need to talk about throughout the program. Let's start with this. The former president, Donald Trump, on Capitol Hill yesterday, reportedly promising to cut the corporate tax rate to 20% from 21%, vowing to make the 2017 tax cuts permanent. We know that. We've already heard he wants to exempt tips from federal taxes as well. He's going to promise to slash regulations, as you might expect. How's he going to pay for this? This is a story we came up with in the last 24 hours. According to people familiar with the matter, he floated the idea of using tariffs and the revenue that you get from that to offset some of the tax cuts they're going to make permanent maybe next year.
And even get rid of the income tax in the process. And basically, this is going to be an all-tariff-funded kind of deal. I kept thinking to myself, Adam Posen, come on over. Let's hear what you have to say, whether that's feasible, what that does to trade, what that does to revenues, what that does to a national dominance in certain industries. A lot of questions here about the details of this. I'm very curious to hear what some of those CEOs had to say, because they've come out and talked about the importance of global trade and the importance of recognizing our global trade partners. Well, do they say to him, that sounds great, Mr. Former President? Or do they say, you know, maybe rethink that a little bit. It might not work as cleanly as you think.
My guess is I would say I'd love that 20. I'm not sure about those tariffs.
Yeah.
So I imagine behind the scenes, just like, yes, give us that 20. And then sort of on the record, it's like, we need to make sure that we still work with our global trade partners, obviously.
It's difficult right now to understand exactly what the dynamic is like in that meeting. Because as you said yesterday, and I think it was a really astute point, these are pragmatic leaders. They are ostensibly the diplomats, the new diplomats of the United States. They go to different countries and they want to do business across borders. So how do they deal with highly protectionist policies? And what was said in that meeting, how similar was it to what was said verbally in a way to try to assuage worries about the debt, but not actually answer a lot of questions?
How business-friendly is this Republican Party going to be under a second term of Donald Trump if he wins in November? It's going to be a big part of the discussion for the next year or so. For the next month or so, we need to be talking about French politics as well. So the latest news on that front is the parties on the left are coming together to form a little bit of an alliance. The finance minister, Bruno Le Maire, with quite a big warning about the left-wing alliance. If they do win, it would mean an EU exit could be on the table, which is kind of bizarre. We've got the euro down 0.5%. The CAC 40 has erased all of the gains for 2024. If you look at SocGen, we're down by more than 15%, not year to date, week to date. French banks have been absolutely hammered so far this week.
So did you think that that was because of this proposal to possibly leave the EU, or did you think maybe it was because no party is going to get the debt under control in France? The country has already been downgraded once. And you have this idea that not only did Emmanuel Macron have an unforced error, according to a lot of people, to call a snap election, but if the left is coalescing around a couple of candidates and you have the right coalescing around a number of candidates, guess which party loses? That's right, Emmanuel Macron. And so people are looking at this and saying, okay, he blew it because he's going to get what he didn't really want. He thought that everyone would coalesce around him. That was my impression from some of the market action.
So the FX market is a relative game. If you look at stocks higher on the week in the US, you look at bond yields lower on the week in the United States, you might think the dollar was weaker off the back of all of this. The dollar's stronger on the week because the other side of the trade is dreadful, and that's the euro. It's been a difficult week.
Just to put this into cold relief, and I think you're absolutely right to show this divergence, because the EU-US divergence is shocking this week. What you're seeing is a 1.3% gain or 1.6% gain on the S&P 500 week to date. What you see is basically a 1.4% decline on the stock 600. This would be the widest divergence going back to March of last year during all of the banking turmoil. This is market. And it highlights, A, a real lack of risk appetite beyond the big tech, but also, B, American exceptionalism, all the people calling the death of it, maybe a little soon.
Back on the table, back on the table. Last week, euro dollar 109 this morning, 106.80 on that currency pair. Equity futures, session lows at the moment. I'll bring you the scores on the S&P 500, down about 0.6%. We've been spoiled all week, 4 days of gains. Looking at a morning of losses on the S&P 500. There's your moving yield to lower by 3 basis points on the 10-year. 420.93. Coming up this hour, we'll catch up with Jeff Yu of BNY as US equities continue to break records. We'll speak to Bloomberg's Sri Natarajan as Donald Trump pitches more tax cuts, and Pooja Sriram of Barclays saying the Fed will be on hold until December. We'll begin with our top story, the S&P 500 looking for 5 straight record-breaking sessions. Jeff Yu of BNY Mellon saying this: the market is now, as it was when rates were rising, more dovish, than the Fed. We still see a rate cut in September, although recognise the need for greater confidence. Jeff joins us now for more. Jeff, let's sort of step back and refresh and get your big takeaway on the week so far. Tons of data, lots of Fed speak. What stood out for you?
Well, what stood out for me is how many people are actually now looking at the OAT Bund spread and seeing, going back into history, how high that could go. So, if the scenarios are along the lines of, what some French politicians are talking about, then that could go a lot wider as well. And let me tell you, looking at our flow data, our custodial flow data in fixed income, there is a big OAT position out there that can continue to unwind. That is my concern right now.
Jeff, when you listen to the French politicians, which ones? Because clearly Bruno Le Maire, the finance minister, is trying to scare people into voting a certain way. Who are you listening to?
Well, I'm listening to both sides right now. I think one thing that markets are, well, at least the bond market, the Eurozone bond market, is catching up on the fact that it doesn't really matter in terms of if it's a left coalition or right coalition. The fiscal policies are worrying. So the comparisons, and maybe this is a thing in the UK, right, some schadenfreude here, but drawing comparisons between what could happen in France versus the mini budget crisis in the UK in 2022. I've heard a lot of questions from clients about that as well. Those are the scenarios that people are talking about. So beyond the headlines, let's have a look at the policies. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it. That's a concern for all assets.
Jeff, when you dust off some of the history books and take a look at how wide that spread could get between OATs and German Bunds, what's your big concern here? Is there a systemic risk or some kind of broader contagion, or is it just simply that it highlights the fragility of a region that still has some distress left over?
So I would say still some distress left over, this suboptimality of the euro as a currency and the Eurozone as a currency union. So those old arguments from 12 years ago, they are being dredged back right now, so to speak. We're not looking at very, very bad scenarios, anything like that. And let's be clear, the ECB has so many more facilities, all those acronyms. I think OMT is going to be mentioned very, very soon as well. Signore Draghi is going to be in demand too. But it does highlight some of the structural issues, which I think the Eurozone policymakers really need to start to address right now, because the time scale is limited. And bearing in mind, 2027, next round of presidential elections, we'll be looking at new budgetary negotiations in the European Union as well.
So I'm going to say it for you, Jeff. You said, reminiscent of things that happened in the UK. We've been calling it a Liz Truss moment. We're wondering how much we could possibly see market disruptions from unpredictable political events that are very much likely for the rest of the year, not just in Europe, but also the United States.
Well, I would say on the US's side, what you mentioned at the top of the hour at the beginning of the program, the next administration, how are they going to fund, certain fiscal commitments? That is very much, what we are focused on right now. Again, looking at our flows, especially the cross-border, the international investor community, are they going to continue to buy US treasuries? Is a fiscal premium going to be demanded there? That will come into play. But I will say, though, if the market needs to worry about Europe and the US at the same time, the US will still be a safe haven, no doubt about that.
Jeff, can you just explain to me then how you take positions in fixed income when we have all these risks around the sovereign in places like Europe and potentially here in the United States on the horizon as well?
Well, right now, I wouldn't worry about the front end, but I think, steepening across the board, that is going to be a concern. Let's bear in mind, last week, all the talk was of this hawkish cut, supposed hawkish cut by the ECB, right? So that means, long-term bond yields, they were going to move up anyway, and in real terms, cost Eurozone governments in terms of financing their liabilities. So those pressures are still going to rise, and given the amount of build-up there, not just in the French government debt market, but also in the US debt market. So I think the pressure on yields back end of the curve is still going to be to the upside.
There's a larger takeaway right now, which is why are bonds rallying? Why are yields lower? Is it because of central bank easing, or is it because of a whiff of some fear of this flight to haven kind of trade that's keeping this equity rally from broadening out more materially? How much do you sniff out some potential fear or weakness or hiding out in havens rather than something broader that's fueled by the rate cutting cycle that a lot of people are expecting?
So here we need to really explicitly define what is a haven. So bunds will be considered havens within the Eurozone. US treasuries on a global basis will be defined as havens as well. I'm looking at Swiss francs. So it started off as a funding currency beginning of the year, and then the S&P cut rates in March, and now, according to our flows, being bought back very, very aggressively. And I think we might get a quasi-hawkish cut by the S&P next week as well. So I still like Swiss franc as one of those currencies. Ticks the haven box as well. Yen, how is that going to be? Very undervalued, but can be a haven in environments like this as well. So yen yes, the market is going to search havens, but also it can make the is US tech a haven in this environment? How does European politics affect US tech innovation? Probably not much. So you could argue, would it really affect US equity markets, especially in that space? Probably not as much as in the past. So those correlations could break down as well.
Interesting. Jeff, wonderful to get your perspective, sir, out of Europe. Jeff, you there, if BNY Mellon. If you look at the French-German spread at the moment on a 10-year maturity, we've gapped out to about 75 basis points. So the wides of the year, the wides also, the widest level going all the way back to 2017, which is when, of course, we had that Macron-Le Pen presidential race. If you go all the way back to 2012, you're looking at something closer to 200 basis points. So this is the political stress of 2017 on the table at the moment. Could change, could get worse, could get better. It's certainly not the economic financial stress of where we were more than a decade ago.
Which is the reason why Jeff was saying, I look at the history and I say, well, it could go a lot further. Here's the issue. How much would that fly in the face of the ongoing consolidation of the European Union, the bringing together of some of these nations, and how much does this really just underscore that there is no alternative to the dollar, even at a time where a lot of people are saying, maybe it'll weaken in response to some of these fiscal pressures?
It makes that G7 meeting down in the south of Italy feel all the more bizarre. When things like this are happening around the world right now, and we're not really talking about them at the G7 level, we're focused on tapping Russian assets, helping the global south, all things that are really important and warrant significant conversation. But when you think about what's on the top of the path for priorities worldwide for electorates in the United States, what's happening domestically for people like Macron right now, that hasn't been part of the conversation at all between global leaders, at least not publicly.
No, and I was reading one article that was kind of wonderful about how Rishi Sunak was supposed to be the lamest duck of all. And then Emmanuel Macron said, hold my beer. And in the meantime, Giorgia Meloni is basically taking selfies and laughing and holding court as it is her G7.
She's pouring the drinks for everyone.
She's like, listen, you know what? When you're ready, come around and we can have a conversation. Other than that, just keep flailing.
AMH is going to join us in about 5 minutes' time. Look out for that conversation. Let's get you up to speed on news elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. As you mentioned earlier, Donald Trump told U.S. CEOs that he will cut the corporate tax rate to 20% if he wins a second term. That, according to people familiar with his remarks. The former president met in Washington with around 100 CEOs, including J.P. Morgan's Jamie Dimon and Apple's Tim Cook. The current corporate tax rate is 21%, and even a small reduction represents a tax cut worth billions of dollars each year for profitable U.S. companies. A check on Adobe shares for you this morning, up nearly 15% in the pre-market trade. They projected a strong sale for its suite of creative products, and it suggests that customers are adopting Adobe's new AI-based tools. Adobe has been integrating AI into some of its most popular products, including Photoshop, which the CEO said is helping the company attract a, quote, expanding universe of users. Meme stock investor Keith Gill, a.k.a. Roaring Kitty, appears to have exited his entire options position in GameStop. A screenshot on his Reddit showed that his portfolio no longer included the 120,000 call options that were set to expire next week. Now, at the same time, his screenshot also showed that he added to his heap of common shares. All of that happening on the same day that GameStop had to delay their shareholder meeting because they had technical difficulties with their live stream. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the G7 facing a world of unrest.
The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war.
Anne-Marie on the ground, live from the G7, up next, alongside the World Bank president, a conversation you don't want to miss. Live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Session lows this morning in the equity market. On the S&P 500, we're down by 0.5%, pulling back from all-time highs. Yield to lower 2 by another 3 or 4 basis points on a 10-year. 420.74, a 20 basis point move lower over the week so far. Quite a move, quite a move. Under surveillance this morning, the G7 facing a world of unrest.
The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace. A peace rooted in the UN Charter and the principles of sovereignty and territorial integrity. A peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war.
So here's the latest this morning. World leaders continuing discussions in Italy today, looking to boost investment to the global south and ease migration in Europe and the United States. The talks coming after the G7 came to an agreement on providing aid to Ukraine by tapping frozen Russian assets. Joining us now live from Italy is Anne-Marie, alongside the World Bank President, AJ Banga. AMH, good morning to you.
Good morning, John. That's right. What we saw yesterday is a boost from private investment from the likes of Larry Frank of BlackRock. He was here at the G7. And what these private investment funds are trying to do is boost money going to the global south, middle-income countries. And part of this is made possible by programs at the World Bank. And I'm pleased to be joined by Ajay Banga. Thank you so much for joining us. John there was talking about a big emphasis, especially on Africa. This is to try, one, to counter China from the U.S. point of view, but also European leaders are trying to stem the flow of migration. How are you seeing this public-private partnership play out?
Yes, I think Africa, the real situation is that Africa is going to be 1.5 billion people going to 2. And frankly, how can you not have a continent of that type contributing to future economic growth? That's the other way of looking at why Africa. And so what I'm trying to talk about there is what creates jobs for those young people. It's got a demographic dividend coming through it. But if you don't give them clean air, clean water, healthcare and education when they're growing up and jobs when they're older, you have a problem with that demographic dividend becoming a liability. Can't do that only with government money and multilateral money. That's why people like what Larry did yesterday or Satya was talking about. These are all the ways to get private sector money as well to come in at scale to help create the jobs in that continent.
How difficult are these conversations on the sideline of the G7 when you see leaders here coming up wounded by recent elections, battered, because what their electorate is focused on is rising prices at home and immigration coming into their country. And meanwhile, you have leaders talking about investments in other parts of the world and also what's going on, of course, with the war in Ukraine.
Yeah, but remember, if you're discussing private sector investing, this is actually good for these leaders because it's a way to enhance every dollar that governments and multilateral institutions put in to add a little more. And that's very, very helpful to them. So it just depends how you approach this discussion. My way of approaching it is it's not all about the money you give one-on-one bilaterally. It's about the leverage you get. So, for example, if you give the World Bank money into what we call IDA, which is the institution that provides grants and concessional financing to the poorer countries, a lot of which are currently in Africa, unfortunately, that gets the leverage. Every dollar you give me as a country, as capital, I can make it 4 times. So leaders know that too. And then if you bring in the private sector, that 4 can become 8 and 10. So people are thinking about how to get a dollar to go to 10, not just a dollar for a dollar. And I think that makes for a good conversation.
But is multilateralism harder, which I know you're a big believer in, when you see the rise of nationalism?
Oh, yeah, sure. Listen, I've been saying for years when I was in my old job in the private sector that one of the biggest things that worries me is chauvinistic nationalism because it tends to create the absence of connectivity. But I think if you look at the last few months itself, we've managed to get capital and hybrid capital and portfolio guarantees into our institution, and we are the one that's working with this multilateralism. So let me give you an example. People keep asking me about the debt crisis in Africa, right? And if you think about the 4 countries from Africa that entered the G20 common framework, Zambia, Chad, Ethiopia, and Ghana, from the time they entered, we in the bank have given them $16 billion of money. Nobody else has given them money. Of that 16, 8 was concessional and 8 was pure grants. Of that 16, 9 was net positive. So that's all multilateralism at work. People just talk about one part of it, but multilateralism does work with the leverage that institutions like the bank provide.
We, of course, have a U.S. election coming up, and part of what you've wanted to expand in your approach to the World Bank is not just poverty, but also climate. Do you think that would be at risk if we were to see a Trump presidency?
Not really. I remember that during his prior presidency, he was one of those who actually gave the capital increase to the World Bank. He sees the value of this leverage and the value of this kind of institution. Just to be clear, when I talked about a livable planet, I want to make sure you know it's not just climate. It's fragility, conflict, violence. It's things like pandemics and healthcare. Because the whole idea of livable planet allows you to expand the aperture depending on what's relevant in that country, that region. In some cases, it is climate. In some cases, it's fragility, conflict that is driving things. In others, it is climate that is driving the fragility and conflict. You have to get to the root cause and try and go at it.
Will there be more pressure, you think, whether or not it's Trump or Biden, potentially to figure out what's going on with China? They're the biggest bilateral creditor, and many say that what they are doing in a lot of these countries is called a debt trap.
Yeah, interesting. So I think where they are today is quite different from what it probably was some years ago. All the conversations we've had, the G20 Common Framework and the IMF and the World Bank run something called this Global Debt Sustainability Roundtable. And in that, everybody comes. The multilaterals who are there, us, the bilateral creditors, the private sector creditors, of which there is a very large amount, and then the so-called earlier ones, the Paris Club. What's really changed is it's not just bilateral credit that's an issue, it's also the private sector that is involved in lending. So today, if you want to do a debt restructuring for these countries, you have to first know who's put what money on the table, what's it cost, what's the covenants of its repayment, what's the whole thing in it. Get that data on a sheet. Without that, it's very hard to know how to adjust that money in. So that took time. But as you see it getting done, and you can begin to see countries moving through the framework, I still think it's too slow. I think it should be faster, because if you make it faster, more countries will feel emboldened to enter into the framework. And I think we need to work our way through this.
What you're offering, do you see as a viable path for these countries instead of, say, turning to China?
Oh, yes. I think it's not an either-or. Why just China? People are borrowing money from India. They're borrowing money from the United States. They're borrowing money from the UK. Remember, this bilateral creditors have been around for a long time. It may be called ODA in some cases, maybe actual lending through some countries. There are countries borrowing bilaterally as well. I don't think it's an either-or, that it has to be either multilateral or bilateral. I just think it has to be done in a fair way, a transparent way, in a way that we can all understand what's going on, and then do it in a way that the countries who are borrowing also don't use only the borrowing as the resource, but also spend efforts on domestic resource mobilization, doing other things that enable them to free up the resources to do the right thing with development.
Ajay Banga, thank you so much for your time. John, that was the World Bank President, Ajay Banga, on the sidelines here of the G7. He's part of a lot of these discussions when it comes to investment in the global south, John, and those developing and middle-income countries.
MH, great work, as always. Anne-Marie on the ground in Italy. We'll catch up with Anne-Marie a little bit later this morning. A phrase I've used a million times already this week, squaring the circle. Federal Reserve trying to square the circle. G7 trying to square the circle. Anne-Marie had a decent go at it just then.
Yeah, trying to figure out exactly how we deal with the fact that a lot of these countries are becoming increasingly nationalist. You can call it whatever you want. He called it chauvinistic nationalism.
I've never heard that before.
I have never heard that either. I wrote it down. I looked up the actual definition of chauvinistic to try to understand. I knew what it meant, but you know what I'm saying. Like, what does the actual sort of nuances of it mean? I'm still a little befuddled.
Is Le Pen a chauvinist? I'd never heard that phrase before.
Is it the idea of just national superiority? Does it have a male-female connotation?
Don't know. We'll ask him one day.
We'll ask him.
I'm trying to figure that out. From New York City this morning, beautiful morning. Good morning to you.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Four-day winning streak on the S&P. Can we make it day 5? This morning's a struggle. We're negative by 0.6% on the S&P 500. Quite a run so far, though. Record highs every single day this week. Monday, Tuesday, Wednesday, Thursday. On the Nasdaq, we're down about 1/3 of 1%. On a Russell, the small caps down by 1.4. We said on the day of the Fed, they had a day. Was it anything more than a day? We'll find out. The small caps suffering this morning, Bramo.
I have to say, the fact that they've been suffering is really interesting to me, because every gain that you've seen, the 29th record high that we got yesterday, was kind of a tired one. Under the hood, a lot of the stocks not participating, equal weight, small caps. You just wonder whether this is people sniffing out weakness in a flight to havens, or whether this is actually an immaculate disinflation that they're really rallying around.
We were looking for 5 days of gains in the equity market on the S&P 500. We're getting 5 days of gains in the bond market. The 2-year yield is dropping once again. We're down by 2 basis points to 467. We're in the 420s and just about to drop to 419, 420.93 on a 10-year. We're down 3 basis points. This is a move of more than 20 basis points over the week so far, and there's a lot of data behind it as well, from CPI to PPI to jobless claims as well.
Basically, when you take a look at the flows, it follows this. People are looking out and saying, now is the time to lock in duration. You can see the flows into medium and long-term bond funds outpacing those in short-term funds by something like 9-to-1, as people try to get in on what they see as the beginning of some sort of shift in the trend. Question I have is, what does that mean for the rest of the economy? Is this still the immaculate disinflation, or was the jobs report yesterday, or the jobless claims, really a shot across the bow? This isn't going to be just an easy kind of wonderful panacea that a lot of people would like.
So claims at 9-month highs. The problem with claims is that we've had a little bit of a head fake a couple of times over the last 9 months, and then they've come back down again. But I'm with you. That is always the concern, that the Fed is caught offsides. And this is what Neil Dutta of Renmark's been talking about now for a while.
Look, I don't want to be subject to narrative ping pong, although I've been doing it for the better part of the past 12 months. But I am curious about how much this starts to actually gain speed, where you start to get ongoing highs, but the air is getting really thin up here. You have Broadcom leading the rally. You have others leading the rally, Adobe. This is not a rally driven by consumer cyclicals in the sense that suddenly the economy is going to be rip-roaring ahead.
Give yourself some credit. You're pretty consistent. Sort of like
bearish.
Bearish, and that's it. Pretty consistent.
Thanks.
I want to turn to the FX market. Push this through the FX market. You might expect a weaker dollar. That's not what we've had this week. We've had a stronger one, a weaker euro. This has been about the single currency. Last Thursday through 109. This morning, just about holding on to 106 at one point. 106.88 is where we are on the screen right now, and this is why. Under surveillance this morning, French President Emmanuel Macron suffering another political blow. Parties to Macron's left vowing to unite in a bid to challenge him and Conservative leader Marine Le Pen. Macron is calling a 2-round election for June 30th and July 7th. And the French Finance Minister Bruno Le Maire is warning that if they're successful, run the path towards leaving the EU.
It's sort of curious timing that they have this sort of fiery rhetoric and the potential to leave the EU just weeks before the annual meeting of the North Atlantic Treaty Organization of NATO. It was interesting. There was an article on the Bloomberg this morning, just basically off-the-record discussions with leaders of the G7 saying, what was he thinking? This is terrible timing, totally unnecessary faux pas. It just seems like right now it's undermining an already fragile international order. And that seems to be sort of the moment that we're in it at G7, where suddenly Giorgia Meloni very much is at the front.
And that's where the strength is, big time. If you want to see the weakness, we can pick out a couple of things. Let's take the French-German 10-year spread right now. That's gapped out to about 75 basis points wide to the year, the widest since 2017, which incidentally is when Macron had the presidential election many years ago. The other point of tension as well is the single name level. The banks, BNP Paribas down 13% this week. SocGen's down by 16%. We're talking about some of the worst weeks for French bank stocks, going back to the US bank stress of more than a year ago.
And the answer, the question really is why? Is it because of the potential for more regulations? Is this because this is not going to necessarily be the haven in France, in Paris, that a lot of people were arguing it would be versus, say, London and Brexit? I mean, there's a lot that kind of rhymes here in terms of some of the more populist trends. You wonder, at what point are we talking about absolute levels, absolute populism, and at what point is it who's more populous than someone else? Who has a bigger deficit than someone else? Who's going to have a harder time raising money?
Who has a bigger balance sheet than someone else? Let's talk about the Japanese yen sliding after the BOJ told investors to wait until July. The BOJ surprising traders today who thought more details on bond buying cuts would be given at the meeting. Governor Ueda also pushing back against the idea that a hike is no longer possible next month. So we've got a hike kind of on the table, and at the same time what we were really looking for was clarity on the balance sheet on bond buying.
Yeah, and potentially the signaling of a rate hike now. Now people are pushing back their expectations for a September rate hike by the Bank of Japan. The fact that they're going to be buying fewer long-term JGBs really raises a question why we're not seeing more of a sell-off in the Japanese bond market. Oxford Economics coming out this morning and saying, ultimately, this does raise the prospect of stagflation, because what you're going to see is a much weaker yen that it seems like the Bank of Japan is willing to tolerate at the same time that growth is slowing. And that's some of the concerns that are sort of percolating.
The yen recovering just a little bit, 157, that currency pair at the moment, so just about unchanged. Earlier on, though, tons of weakness. That currency pair had gapped out to about 158, 158.26 is the high of the session. Let's wrap up the news down in D.C. Former President Donald Trump pitching tax cuts during a return trip to Washington. Trump telling Republican lawmakers he may use tariffs to help pay for income tax cuts. And according to people familiar with the discussions, Trump also floating a cut to the corporate tax rate to U.S. CEOs in remarks just hours later. Bloomberg's Sri Natarajan joins us now for more. Sri, good morning to you.
Morning.
A long list of bank CEOs meeting with Donald Trump yesterday. Can you give us a flavour of what that meeting went like?
There is a significant symbolism attached to the moment, right? We are exactly 2 weeks removed from the Trump verdict, when the former president was, quote unquote, became a convicted felon. And yet 2 weeks later, here in Washington, he has an audience of some of the most prominent business leaders in the country. That's important. Clearly, not a lot of them were out there saying we'll stage a walkout because he's there. So the verdict clearly did not impact their decision to attend it or not. Not everyone attended, but that was not because they were outraged by Trump's presence. There might have been other reasons. Now, let's look at what was discussed inside the room. Trump is out there pitching tax cuts. Remember Trump 1.0? Tax cuts were a big reason the business community loved him. Gary Cohn went into that White House, took forward that tax proposal, made sure that that was carried out. And the corporate community loved him and that administration for that particular measure. Now Trump is talking about cutting that rate further from 21% to 20%. His reasoning is it's a nice round number for the business community. Even a 1% tax rate cut is an important move. It moves the needle for sure for them.
Do you think it makes a big difference? Can you just explain for us all the difference between 21 and 20? And I said this yesterday, not 100 basis points. Just tell me the big difference for the bottom line of some of these banks.
Did you not like Trump's explanation? A nice round number. Look, a 1% tax rate could be the equivalent of what a lot of these companies are carrying out in terms of a review of their AI processes, seeing what cost savings they can extract out of their companies. That could amount to the same savings as you get from a 1% tax cut. So it is a significant number, but more importantly, it's an indication that we will be business friendly. This is an easy way to sell it, but this is sort of a key stool around which we will try and bring forth 4 more years where corporations don't have to worry about anything from the Trump administration. That's his pitch. That's important because under the Biden administration, one of the frustrations for the business community has been the regulatory pecking. It's clear in Trump's remarks, everyone's focusing on the tax cuts, but he also made a pitch for deregulation. And that you cannot underestimate or even underscore enough how important that has been, especially for the financial services community, where they have felt that you're living in an era of over-regulation, and they've been very frustrated by it. Couple that with the fact that they feel that they don't have a seat at the table with the Biden administration, that their voice is not respected enough, that automatically sends some of them gravitating towards Trump.
Are tariffs business friendly for banks?
No. It's more... Actually, let me take that back. More than tariffs being business-friendly for banks or not, what the banks and the broader business community wants is predictability. Whether there are tariffs, or you can't have tariffs one day and no tariffs the next. You can't have tariffs at this rate and a much different level the next day. And that's also important because before Trump spoke with the same group yesterday, there was a White House Chief of Staff addressing them. He talked about upholding the rule of law, maintaining U.S. reputation, but he also maintained the point of predictability. And perhaps a lot of people have forgotten that the 2016 to 2020 period, a lot of things happened. Most of those were not predictable. And the business community should be a little wary of that. And that was Jeff Zient's pitch to this group.
You started talking about how it's sort of surprising, or was surprising to some people, that a number of these CEOs went, even though there had been this conviction. It didn't seem to put them off at all. We've been talking extensively how they're essentially diplomats, modern-day diplomats, and frankly are pragmatists and care about their businesses. How much do you still see an appetite to work with and in the administration by some of the top executives at big banks, regardless of who ends up as president, at a time when a lot of people have been floating names? We've heard about Jamie Dimon, we've heard about Brian Moynihan potentially wanting to join the crowd. How much do you still hear about that?
There will be some of these names that you will never see in a Trump administration. Right? At least Jamie Dimon so far has been very clear in private conversations and public conversation that he's not very keen on joining the Trump administration. One assumes that he will stick to it. There are a few other business leaders I can think of who would never join a Trump administration. But broadly speaking, is there appetite in the business community to go and join the administration? Yes. I mean, the same reason why Gary Cohn joined the first Trump administration. He wasn't even a Republican, but he thought he could affect change. He had a very clear agenda in mind. He knew what he wanted to accomplish. He went there, did that, spent a couple of years, or not even a couple of years, and came out of that administration. So I think that appetite doesn't go away. If you're told that you could be in an influential role, where you could make the changes that you want, and it would be seen as something that will be advancing what you have practiced through your life, which is whatever enhances corporate success, you would do that.
It's one dimension missing here, and I just want to pick up on something you talked about when it came to regulation. It's not just about financial regulation. When Lisa and I have caught up with some bank CEOs over the last 6 months, one concern they have had has been about mergers and acquisitions. Their clients just don't know what deal would go through this White House and what deal wouldn't. I mean, we don't even know if we can close a deal with an entry-level luxury handbag maker. That's kind of where we're at in this country. Do we have a decent idea of how the Trump administration would be? Because one person that's on board with the Democrats and Elizabeth Warren is J.D. Vance. And J.D. Vance is in line to be the VP. Have we got any clarity on that at all?
Again, it goes back to the whole predictability idea, right? While yes, they can talk about the business-friendly practices, but it is very hard to believe that a Trump 2.0 will come in guaranteeing predictability. On January 1, 2021, if it is going to be another Trump White House, another Trump administration, I don't see a world where business leaders can sit back and rejoice and know at least the path is clear for the next 4 years for us.
Final question. If I spend $20 and get something to shake my mouse repeatedly just to keep the Bloomberg terminal on and the green dot next to my name on throughout the day, what's that about at Wells Fargo?
Don't do that, John. It's not worth it. It's a $20 hack.
What is that about?
So let's tell our audience what we're talking about. Mouse jigglers is what they're called.
Oh my God.
They became popular in the post-pandemic
I'd never heard
era.
of this. I hadn't heard of this before.
Neither.
Mouse movers, mouse jigglers,
neither,
workers went back home, banks wanted to track productivity. They actually wanted to make sure that their employees were actually working. So they started tracking keyboard strokes and mouse movements, which is why technology came to the aid of a lot of workers who decided that a $20 hack on Amazon, buying a gadget like that, would actually help. It's not worked out that well. Wells Fargo, we reported yesterday, has fired a number of employees, and we continue to see more filings pop up for the same activity, this simulation of keyboard activity. It's not really clear to us whether it was still faking work from home or this was actually happening in the office. Let's assume it was probably from home. Not a good idea, but at the same time, as bad as it sounds, I would also look at the other side of the coin. Do we really think that the best way to track productivity is making sure you're green dotted on the terminal?
Judge their output. I'm completely with you. I find this story bizarre. You either know what they're producing or you don't. And if they've been able to sit at home and just shake their mouse for 12 months, what job did they have at Wells Fargo? Okay. That's kind of what I want to know this morning.
I have a theory. When I read this story, I was thinking, okay, there are probably a couple people who had no productivity whatsoever, and their bosses said, we're going to find out whether it's the jiggler. And they went in and they saw that the mouse movement was like this, and then they went in, they raided their homes, and they found the mouse jigglers.
Oh, it's like FBI raid.
And then it was FBI raid, and then that was justified cause for the firing. That's what I think.
I don't know if I buy Wells Fargo's FBI level sophistication, but let's assume some version of that. But the bigger point is, would you rather John Farrow's green dotted or he's red dotted on TV? That's when he's most productive. And that's my point about any sort of role. It's not how much time you're spending in front of the monitor and on your keyboard. It's what you ultimately produce. That matters.
Is he your lobbyist?
He is. It's my agent.
Okay, good to know.
If anyone's watching, Sri Natarajan of Bloomberg Street, thank you. Appreciate it, mate. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Tesla investors have backed CEO Elon Musk's $56 billion pay package and his plan to move the company's headquarters to Texas. The company announced the results at its annual meeting Thursday in Austin, and this morning said that 72% of the votes cast had approved the award. The shareholder vote was seen as a referendum on Musk's leadership after slumping sales and a drop in the stock price. The Defense Department has selected SpaceX, Blue Origin, and the United Launch Alliance to compete for as much as $5.6 billion in contracts for defense launches. The Pentagon said the companies would be able to compete for contracts through June 2029, with a possible option to extend the period to another 5 years. Previously, only SpaceX and ULA were eligible to bid for national security missions. Rory McIlroy is in a strong position after the opening round of golf's U.S. Open at Pinehurst. McIlroy's first round, 65, leaves him in a tie for the lead, with the four-time major champion sharing the lead with Patrick Cantlay. World number one Scottie Scheffler shot his worst opening round of a major in 2 years to sit at 1 over par, while Tiger Woods shot a 4 over par opening round. And that's your brief, John.
Just imagine what a beautiful love story this could be. And Danny, thank you. McIlroy wins on Sunday. Wife standing there on the 18th green.
Stop.
Beautiful.
Yeah.
Right? Sort of reunite. No?
No.
Not down with that at all?
Do you actually think that this is a happy reunion?
I think this is a happy Rory McIlroy.
This is correct.
Like,
this is true.
He's dialed in.
Yeah.
Focused.
Yeah.
I think he's got this
so
this
he did
weekend.
have a good job, and then he said, actually, come back. It's horrible.
You're not on board with this, are you, Bramwell?
No,
You've got thoughts.
Okay.
I haven't got thoughts about people's private lives.
You don't have thoughts?
No, absolutely none at all.
You have no thoughts?
Don't want to get involved at all. Just
Okay.
very happy
This
to see.
is recorded.
Very happy to see Rory happy.
Oh, I'm so glad. That's so sweet and genuine.
That's all I care about. Up next on the program, a divided Fed starts to talk.
The fact that they are having this internal discussion and this uncertainty, I think the market should know about. It is a very tenuous period. No one knows for sure, and this kind of reflects that.
That conversation up next, live from New York City. You're watching Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching the China Show.
This is Bloomberg Technology. This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Four days of gains on the S&P 500 so far this week. Another record high at the close Thursday afternoon. Friday morning, we're down by 0.5%, and bonds are still rallying. We're negative 4 basis points on the session. The 10-year 4.2016. Under surveillance this morning, a divided Fed begins to talk.
The fact that they are having this internal discussion and this uncertainty, I think the market should know about. It is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad. On the downside, it's just a matter of when. Are we going to be there sooner or later? And okay, I know that, but I know which side the bias is on. They're going to ease eventually.
That's the consensus view for sure. Here's the latest. Fed speak picking up following a week of cooler inflation data and a Fed dialing back rate cut expectations. Chicago Fed President Austin Goolsbee and Fed Governor Lisa Cook on deck, as well as Cleveland Fed President Loretta Mester sitting down with Bloomberg's Mike McKee a little bit later this afternoon. Pooja Sriram and the team over at Barclays maintaining their call for one cut this year, writing, quote, "We continue to think the cut to take place at the earliest in September. Our baseline is predicated on inflation gradually moderating in the coming months on a sequential basis and the economy gradually slowing." Pooja joins us now for more. Pooja, great to have you with us on the program. I just want to summarize the data we've had so far this week. CPI, cooler than expected. PPI, downside surprise. Then jobless claims happened. Wrong kind of upside surprise. What did you make of the claims print yesterday, and how concerned should we all be?
Oh, thanks and good morning. I think, we really didn't take too much signal from the claims data. The fact that it did tick up for the week, I think if that trend continues, it would be in line with, some continued moderation in labor market conditions, which, really is a welcome sign. I think we should all remember labor market conditions are very strong. Whether you look at, the 3-month moving average of payroll gains or even the latest payroll report, I think some moderation is welcome, particularly from an inflation standpoint.
Jeff Yu earlier this morning from BNY said the market is more dovish than the Fed. It certainly seems that way based on the bond market rally that John was just talking about, and you could see that into some of the implied cuts. Do you think the market is wrong to be so? Or do you see that the Fed basically is trying to have a hawkish tilt just so they don't get it wrong, to reverse some of what happened at the end of last year when they indicated that they would be cutting rates?
I think, I think the markets don't necessarily price just the baseline. They've got to price, risks around that. So, the pricing is what it is. And as far as, what the Fed signaled, I think was a very balanced sort of a message. You're right. They have been burnt once, the end of last year, when there was a dovish tilt in December after a run of, weak inflation prints. And then look what happened in the first quarter of this year. So I think just, they don't want to make too much of one data point. And the totality of the data that they keep talking about, whether it's activity or labor markets, those haven't really shown a material easing. And so, what they signaled in their SEP on Wednesday was very much a tone of patience, of caution, being cautious, and they want to gain confidence that things are moving in the right direction.
What do you make then of people who say, well, if you put it all together, core PCE, which is one of the key inflation metrics that the Federal Reserve looks at, is something that is very predictable if you have the inputs of PPI and CPI and some of the other data that's already come out. People are now mapping out something akin to a 0.1% increase in core PCE, which would be very much in line with the Fed's goals, bringing year-over-year inflation to something like 2.6%. How much do you see that as actually giving a green light to the Fed as early as September, even though that's not your base case?
So, look, I think we agree with that translation. Our own forecast for core PCE in May is a 0.13%. So to your point, a very benign, very soft-looking core PCE inflation print. That said, you know, we like to say that the Fed is not data point dependent. And it came across quite clearly in Chair Powell's press conference as well, that they didn't want to make too much of one data point. He did say that, you know, he welcomed the May inflation outcome, and that's the step in the right direction. So, you know, like we've written, should inflation outcomes continue to, you know, move in the right direction, i.e. come in soft, I think that will open the door to a rate cut. But is the May PCE alone enough? Clearly not.
Pooja, some personal bias here. I have to say, I wonder how many people agree with me. I'm far more interested in how we end the year on unemployment than I am on inflation. I sense from a lot of people that come on this program, they have far less confidence about where this labour market will be by year end than they do on how inflation's going to track. And the reason I ask this question is because the Federal Reserve has come out and said, basically, we will end the year with unemployment where it is right now. And I'm trying to work out how much confidence you have that unemployment does actually stabilise at these levels through the next 12 months plus.
You know, it's that's a hard one to forecast. You know, we work with the indicators that we have, and clearly we haven't seen much by the way of a move up in the unemployment rate. Of course, you know, we were at 3.4 at some point in time. You know, we've definitely ticked higher, but a 4.1% is clearly not something that is, you know, weak by any standards. And I think this is a labor market that is still running strong. You know, we look at the data as closely as we can. Of course, you know, we're cognizant a lot of the gains are concentrated in the private sector, particularly services, particularly, you know, education and healthcare, some from leisure and hospitality. So we've heard those arguments that the gains are all, you know, pretty narrow, but the fact that they continue, you know, month on month is one thing. And second is, you know, we're looking at the JOLTS data. Job openings, sure, you know, have come down a bit, but still quite elevated. You know, if anything, it looks like, you know, that momentum is still there. So, you know, we're looking for any signs of cracks. We haven't seen so much. So, you know, we're sort of with the Fed that we don't see a big spike in the unemployment rate by the end of the year.
Pooja, appreciate it. Pooja Sriram of Barclays on the unemployment rate. More on that in just a moment. Here's your lineup for the second hour of Bloomberg Surveillance. Tom Kennedy of JP Morgan, Tobin Marcus of Wolfe Research, Tasha Keening of ARK Investment Management, and Michael Zezas of Morgan Stanley from New York City. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transaction strategy, and the technology.
Awareness is going to grow, and these things grow the overall industry. And crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The U.S. exceptionalism story probably comes through most clearly in this AI boom that we're seeing.
We can see investors moving out of cash. Again, we think to high-quality equities.
If you look at the comprehensive look at the economy, it's still relatively strong. It begs the question, why even project rate cuts at all?
The markets effectively have priced in a permanence of this higher growth, higher inflation, and higher rate world.
Where we're headed just looks like there are more positives to offset the challenges and the negatives that appear.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Can we make this 5 for 5? 4 consecutive all-time highs on the S&P 500 coming into Friday at a record. The S&P slightly negative and pulling back by 0.6%. One theme continues. It's the rally in the bond market across the curve. 2s out to 30s. The 2-year and 10-year down on the week now by about 20 basis points. There's a good reason for it. It's the data and not the dots.
And what it has to do also is U.S. exceptionalism. I keep going back to that because this is not a bond rally that's lifting all boats, quite the opposite. And I think that's interesting given the fact that a lot of people thought that the Fed would have a put on markets. Sure, maybe it's influenced the fact that people want to still buy NVIDIA. Okay, sure, you can make that argument. I'd like to hear it. But ultimately, this is not lifting all boats. This is not lifting all bonds. This is in the U.S. and this is in U.S. tech.
Well, here's the argument from Neil Dutta. Bonds over stocks. Over at Renmac, this is what he says. The Fed dots will look increasingly offsides relative to the incoming inflation data. The hope is that the Fed's rhetoric shifts quickly. The risk is that it doesn't.
You know, Neil is actually onto something. And Neil, you're welcome.
You're on the same page for once.
Well, no, but I don't know. I'm not going to go that far. But I will say this. You know, he has been highlighting how this is not a good kind of trend. It might be good for the Fed to cut, but if they don't cut, he thinks they'll be making a mistake because he doesn't see a lot of this weakness as historically being linear. So typically, if you get a weakening like this, it's a lagging indicator and there's a lot more coming down the pike. I would argue that stock markets are sniffing that out because under the hood, things are looking a little weak. It's not this rip-roaring kind of excitement. Let's get to the party. Jay Powell's there with a keg. This is not the same kind of market that we were talking about, say, 6 months ago.
So I said it was the data, not the dots. That was a direct quote from Andrew Honhorst of Citi, and you built on that in the newsletter yesterday. This is what Andrew has to say about the labour market. Labour market data and survey anecdotes point to businesses trying to reduce labour costs. I want to come back to a point we discussed in the previous hour. I sense from the people we speak to, they have more confidence about where inflation's going to be by year end. But when you ask them about the labour market, that's when they're a little bit spooked by things like jobless claims yesterday. And we've had a series of head fakes on that data point. I'll repeat that, I know. But that's where they're a bit spooked. When the Federal Reserve is still forecasting unemployment year end, for where it is right now, and basically only a little bit higher for year-end 2025 as well. That's where there's some real doubts, I think.
Especially given the fact the Fed chair came out and doubted their own data that came out in terms of
Overstated.
payrolls. It was possibly overstated. People said, can you make sense of the fact that these two surveys were completely different in terms of their conclusion? And he said, no, I can't. Sorry. You know, this is a reason why we're not, what is it, data point driven? We're not data point dependent, we're data dependent. Look, I think that there is a lot of confusion. Right now in markets, it seems like there is a bigger risk on the margins tilting toward maybe we are underestimating how much weakness there is in an economy that so far has held up, but is showing some signs, I don't know, slowing down just a touch.
That's just 2024. Got to talk about 2025. The former president on Capitol Hill talking up tax cuts, reportedly, talking about the corporate tax rate coming down from 21 to 20, talking about paying for income tax cuts with the income from tariffs, which is an interesting report we've heard in the last day or so as well.
So what actually is he going to go through with? And you asked this question earlier of Sri, which is this going to be a business-friendly Republican Party? Is this going to be a business-friendly Donald Trump? Well, tax cuts might be. Less regulation might be. Tariffs, absolutely not. Some of the increasing tensions geopolitically, fewer immigrants, given the fact that a lot of companies, we heard Marriott in particular, saying that they kind of need them in order to keep growing, especially at the pace they have been. This is a soup. And when we start talking about what's happening over in France, you have to wonder if the U.S. is 6 months behind with respect to policy uncertainty and the ultimate realization there are no plans to pay down the deficit. Zero. So the question is, what kind of room is there to do additional kind of stimulus?
France teaching us once again that in Europe, deficits matter. Here are the scores right now on the S&P 500. Equity futures negative by 0.6%. In the FX market, there's your euro weakness, 106.97. Recovering just a little bit. That currency pair is down by 0.4%. On my screen at the moment, sort of tracking this, the French 10-year, German 10-year spread, gapping out to 20, or rather gapping out to 76 basis points. We were close to 20 not so long ago, Bramo. That's the week so far. That's the widest level going back to 2017.
And the gapping out that we've seen so far this week in that spread is the biggest move that we've seen going back to late 2011 during the height of the European debt crisis. There's a whiff of that underpinning some of this, just the idea that maybe there's a threat to the EU and maybe there's a threat to this idea that these nations are going to pay back their debt and be okay with that.
That misplaced sense of French superiority in the bond market getting smoked so far.
Really? First the food, then their misplaced sense of superiority, their chauvinistic nationality. What was that?
Hey, that wasn't my phrase. That wasn't my phrase.
No, that wasn't.
That was the World Bank president.
That was.
Hey, don't associate that with
all
me.
right. You don't want to be a chauvinistic nationalist?
No, I'm not even sure what one is.
I don't know what it is
I don't know what he was talking about.
I actually really want to have him back on and say, what is chauvinistic nationalism?
That was the World Bank president with Anne-Marie, by the way, if you're just tuning in. I've never heard of chauvinistic nationalism.
I kind of like it.
Yeah.
I mean, it's like, you know, having dinner, you know. Why do you want the potatoes?
I'm not sure I want to be associated with
nationalism.
That. All right, okay. Coming up, Tom Kennedy of JP Morgan Private Bank and why this is a strong economy in a fragile world. Tobin Marcus of Wolf Research as Trump pitches lowering the corporate tax rate. And we'll catch up with ARC's Tasha Keeney as Tesla shareholders approve Elon Musk's pay package. We begin with our top story. 4 days of gains, 4 days of all-time highs. Growing optimism for Fed rate cuts this year, driving stocks higher and bond yields lower. Tom Kennedy of JP Morgan Private Bank writing the following. While our market and economic outlook is constructive, we acknowledge two main sources of uncertainty: geopolitical risk and the US election. Tom's with us for more. Tom, good morning.
Good morning.
And don't worry, some of those subjects we just discussed, we will not be throwing your way. Let's talk about US politics first of all. Why is that such a big uncertainty to you? Why does that matter so much?
I think you can look back in history and see that elections don't have lasting impacts on equity markets. But I think we'd all be forgiven if this time might be a little bit different. And you can look towards some of the things you guys are talking about here this morning. What's going to happen with fiscal deficits? I don't see either party showing any restrictions or any inclination that they will dial back in deficits. I think it's this kind of thing. We could have had this conversation last year and 2 years ago and 5 years ago. Maybe it's too bullish of a statement, but is it possible we'll sit here and do that the same next year? But in the meantime, it's just, for my clients, more interesting to talk about what can you do about it? What is in your control to handle?
What can you do about it?
I think you have to just simply look at the deficit. It's a simple process. Either revenues have to go up, taxes, we got to cut expenses. You guys tell me, which one do you think is more likely? So for our wealthy clients, I think it's taxes go up. At some point, you got to get tax efficient. That's the easy part. And with muni ratios normalizing rates back up, that's a place to be. I think the other risk there is just around tariffs and the decoupling from China and how it's handled. I think President Biden and President Trump are actually converging a little bit with the tariff announcements from President Biden recently. But those are symbolic, right? But it is indicative of where the U.S. needs to decouple and where supply chain security is so important. EVs, batteries, national security type of infrastructure. It's going to take a lot of CapEx. Where's that CapEx going to go? U.S., Latin America, Canada with allies. So I think you can invest alongside that. I think it's a multi-year theme.
Tom, I got to say, I love speaking to you. I talk about the potential for deficit. It's, the loss of U.S. supremacy, bond yields surging, Liz Truss moment in the United States. You're like, maybe just be a little more tax efficient in your portfolio because, taxes could go up. There is this issue of whether people are overreacting at a time when we just had a 30-year auction yesterday that was incredibly strong, following a 10-year auction on Tuesday, incredibly strong. Yeah. People seem to be buying the debt at the same time that they're saying this could be a fear at some point in the near future like they have been for the past 40 years. So are you saying it's not going to affect yields?
I think the point is to acknowledge that this is a risk that's been around for a while and it's quite possible and likely that it's going to be around for a while. As a citizen, I'm just as worried as you are. It doesn't make any sense. But from a market's perspective and focusing on what our core competency is how to invest, I don't see evidence that it matters yet. Bonds are still being driven by Fed outlook with high statistical correlation. Second is the auctions are processing. And third is that global trade is still happening in dollars for the most part. I'm just giving you the checklist of things I would look for if this was becoming a risk. If it does, we have to adjust. But in the meantime, the path that you need to insulate yourself with, the most likely path is higher taxes.
This is fascinating to me. Jeff, you started the show by saying right now the market is more dovish than the Fed. And essentially, at the same time, people are looking for havens. And what are the havens? U.S. government debt, because on a relative basis, it's better than some of the other nations, and U.S. tech companies, which kind of goes to your point about increased spending on the heels of some of this broadening out. Is that the haven trade these days?
I think the haven trades are places where earnings are happening, tech companies, where I can feel confident that those businesses can exist or that spending can still happen should interest rates stay higher for longer, again in tech and the related ecosystem. And then lastly, where are these long-term trends that are just going to persist for multiple years? I think it's around AI. And for a lot of my clients, they think they have exposure. I own the big hyperscalers in AI. But I think the next leg of that is going to be in the ecosystem that's necessary for the compute power, for the land, for the infrastructure. So there's an industrial renaissance, if you will, happening in the developed world.
French stocks on sale. Let's see if we can get a bid out of you. LVMH is down by 2.6%. We've got the likes of Total having a difficult week as well. That's down 2% on the session. The likes of Airbus down by 2.5, Immerse down by 2.3. CAC 40's wiped out the gains for the year. I bring up those names and not the banks because they're really solid companies that a lot of people like. And they're getting hammered because of French politics and election happening over the next month or so. Does all of this make sense to you?
I think it's an indication of what we're talking about here, that there is deficit worries happening there and that the market will have to reprice assets without good constructive growth.
Can I jump in? Is this sort of like the euro premium is getting priced down again at a time when everyone thought that maybe it would get priced in for good reasons?
I think it's back to what Lisa's talking about. You're just going to flock to the place where you have the most confidence and safety. Now, are these good companies? Absolutely. In the long run, do I think deficits are what going to drive asset prices? No, I don't. I actually think the fundamentals and the economics will do that. Our outlook for mid-year outlook is about a strong economy happening despite these fragilities, and we focus a lot on the fragilities, but don't look to, say, a central bank like the Fed that's saying, I hear you, we're worried about the outlook too, and if the outlook worsens, we're going to cut rates a lot. I think it's the flip side of what you're saying, what you had with Pooja in the prior segment. Wow, I'm more worried about where the unemployment rate's going to be.
Yeah.
I agree, but the Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
So there's this sort of argument that's somewhat controversial, which is that Fed rate hikes haven't had that quick or direct impact on the U.S. economy, that a lot of the decline, the disinflation really has come from year-over-year comps and supply-demand rebalancing. Yeah. What's to say that rate cuts are really going to help all that much to really save the U.S. economy if we start to see a real material slowdown?
This notion that higher interest rates are constructive for an economy and that folks are saving more so that they have more disposable income to spend doesn't hold much water for me. You can see that a 5.5% cash rate, just under, is very attractive for savers in this country. Money market fund assets are accumulating very quickly, and then at the same time, rarely do folks want to borrow. So in the last 6 months, bank borrowing is up about 1%. We have seen bank borrowing that low. Historically, it's usually in a recession. So to say that interest rates don't matter, I think is kind of missing the bigger picture of what's really happening here. Durable goods spending, housing spending is all down. Should you cut rates for average Americans, you're going to support their biggest asset. Crazy fact, fun fact.
Sure.
In the housing market in America, the average American has 70% home equity at this point, an all-time high. Now, prices could come down and erode some of that equity, or maybe rates come down and support that equity going forward. So I think the interest rate cuts will be quite powerful to support the economy should this bigger risk happen. But it happened at the Fed last year, and that's part of the reason I think why stocks have been so supportive.
Tom, this was great. It's good to see you. Thank you, buddy. Thank you. Thomas Kennedy of JP Morgan Private Bank. Equities just off session lows. We're down by 0.6% on the S&P with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The yen weaker this morning after the BOJ made investors wait yet another month before getting details on its plan to cut bond purchases, some of that weakness pairing. But Mark Dowding of Blue Bay says that the BOJ can't lay out a plan and hike at the same meeting, which means a hike won't happen until September.
There's a danger. The more the BOJ gets behind the curve here, the more the danger is they're going to have to overreact and tighten policy more aggressively, say at some point in 2025.
Dowding went on to call the BOJ's decision a disappointment. He joined me this morning on Bloomberg Brief, which you can catch weekdays at 5 a.m. Eastern. A judge looks set to reject a $30 billion settlement between Visa, MasterCard, and retailers, which would have capped credit card swipe fees. The deal, which was announced in March, would have let merchants charge consumers more for transactions involving Visa or MasterCard. Spokespeople for both firms say that they were disappointed by the developments. Wells Fargo has fired over a dozen employees last month after investigating claims that they were faking work. A review found that they were simulating keyboard activity, creating an impression of active work with methods like mouse jigglers taking off after the pandemic. A company spokesperson said, quote, Wells Fargo holds employees to the highest standards and does not tolerate unethical behavior. And that's your brief, John.
Danny, thank you. Is it unethical if you just want to sort of like leave the screen up? You know, you've done your work.
And then you want to jiggle the mouse?
Sure.
I mean...
Is that unethical?
Ethical?
I've done my job. Been productive.
Okay, do you think that the boss is really going to look? If you've been productive, somebody
who are you speaking
out
to?
there...
Who are you speaking to? Someone out there.
Are you going to be actually looking to see about jiggling the mouse? No,
I'm going to buy one. I want to see how they work.
Really?
Yeah, I've never heard of them before. Didn't know it was a thing. Didn't know it was a thing.
Really?
$20. I'm going to buy one.
I actually want to see what it looks like.
Yeah.
I think it's noisy.
All right, we'll find out. We'll buy one. Up next on the program, Trump's pitch for a second term.
I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
We'll have a serious conversation about policy and a less serious conversation about how awful Milwaukee might be or might not be.
What?
Oh, you didn't see those comments?
I mean, yeah, but that's
apparently they happened, but then apparently they didn't happen.
Yeah.
Yeah, okay.
That's not a good look.
More on that next. Beautiful morning in New York, by the way, just fantastic. Summer really getting going. From New York, this is Bloomberg.
heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges. Britain's next.
Was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Waking up to a tough session in Europe. France, CAC 40's down hard. We're down another 2.6%. The French banks, losses of more than 10% so far this week on the likes of SocGen and BNP Paribas. Some of that's following through to US equities. We're down by about 0.6% on the S&P. Just bear in mind that yesterday we did close at another all-time high on the S&P 500. But this bond market rally continues too. Lisa, yields are lower by 3 or 4 basis points, 420.74.
Yeah, right now people are looking at the potential for the Fed to cut sooner. You really raise the question, is this because of disinflation or is this because of the whiff of maybe some weakness in the labor market? Ultimately, that will become the question.
I think we've got to focus on the labour market a whole lot more. We'll continue to do that for you. Under surveillance this morning, Trump's pitch for a second term.
What's happening to our country is of great concern to the group of people standing alongside of me. We have great unity. We have great common sense. A lot of very smart people in this room and a lot of people that love our country. I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
Here's the latest. Donald Trump saying he'll lower the corporate tax rate to 20%. The former president reportedly making the comments during a meeting in Washington with around 100 US CEOs, including Jamie Dimon, Tim Cook, and Jane Fraser. Tobin Marcus of Wolf Research writing that with a Trump win in November, the good news for markets would be front-loaded and the bad news would come later in the year. Tobin joins us now for more. Tobin, I'm not going to ask you about Milwaukee, don't worry. I'm going to ask you about policy. When you say front-loaded versus back-loaded, what kind of policies are you pointing to?
Well, first of all, Jonathan, I have nothing but good things to say about the great state of Wisconsin, so ask away. In terms of the good news that we think is front-loaded for markets, largely we're thinking about deregulation there. I think the clearest set of things that Trump is proposing to do and can do, and that the entire Republican Party is aligned on, is rolling back a quite wide swath of Biden regulations that have been proposed across sectors, but particularly in financials and the traditional energy complex. So, those are the sectors that we look at as the likeliest sort of immediate winners in the near-term aftermath of a Trump win. But then, when you look at the broader set of things he's proposing, including things that people are less certain he's going to do, like his quite aggressive tariff agenda, like some of the fallout from paying for the tax cut extensions that they want to do, which could entail Inflation Reduction Act, energy tax credit rollbacks, could potentially entail some healthcare tax cuts or healthcare cuts. All that stuff I think is going to develop later in the year. I think the tariff agenda is going to take a while to come together. That's really the sort of biggest concern, and I don't think that is a sort of day one put that stuff into effect kind of agenda. I think that's something that they're going to be doing investigations and threatening and negotiating and working on that through the year, with tariffs not actually taking effect until late 2025 or later.
Tobin, in the discussion nationally, a lot of people think of immigration as more of a social issue, but actually a lot of the CEOs probably are very concerned about that, in part because of how much this has helped support a labor market without maybe commensurate wage increases. RBC put out a report that said if some of the proposals went through that have been floating out there, a 50% decline in immigration is possible. How much do you see as being factored in the discussions that you have with different executives, with different people in the industry, as a likelihood, not just a possibility?
Yeah, it's something that we've been talking about a lot. I certainly agree that there's been growing market focus over the course of the year into the extent to which immigration and some of the changes in Biden's policies at the border in terms of humanitarian parole has supported continued labor force growth, sort of raised the break-even number for what we can add in terms of payrolls without having really strong inflationary impact. So that's something we worry about. I think that is largely sort of the exception to the overall idea that we're arguing that the good news is kind of front-loaded, because we do think that in the first 100 days, we'll see a pretty expansive immigration agenda. I think the thing that is most concerning that Trump can certainly do is end the humanitarian parole programs Biden's put in place and account for about 75,000 entries into the U.S. per month on a kind of quasi-legal basis, folks who are eligible for work authorization within a month after that. So that's a very direct flow into the labor force that we think shuts off right away. The broader swath of things, including some of the policies that are going to be most concerning to corporate leaders in terms of, H-1B visas and high-skilled immigration, I think some of that stuff is more subject to litigation. And, throughout the first Trump term, there were this huge amounts of litigation over what he was attempting to do on immigration. I think we'll see that this time around also. I think we'll see a lot of proposals in the first 100 days, but other than this parole piece, I think a lot of that is going to end up tied up in courts for quite a while. And so certainly some of the most concerning stuff in terms of the promises that they're making around internal enforcement, deportation, trying to round up millions of people and deport them, that I think will prove quite operationally challenging in addition to the kind of legalities on that piece.
Tobin, I just wanted to jump in and finish on the deficit if we can. In Europe, there's a conversation that takes place that doesn't often happen in the United States. People come up with a proposal, and then places like the UK will say, well, how is it funded? How are you going to pay for it? France is going to have the same experience based on what's happening in their bond market over the last week or so. In the United States, they've always had this privilege of behaving recklessly. They don't have to worry too much about that. Something interesting, I think, happened in the news in the last 24 hours. Reportedly, the president suggested kind of the corporate tax rate, 21 to 20, talked about making the 2017 tax cut permanent, talked about exempting tips and earnings from federal taxes as well. So we understand all of that. But he also said something interesting. He talked about how to pay for it, which I think is pretty new. He talked about maybe using tariffs and the income from tariffs to do that. Can you give us an idea of how much money you could raise for ramping up tariffs on U.S. imports?
Yeah, absolutely. And I think for markets, this is a lot of what we are worried about for around the fiscal debate next year. We're talking about extending $4 trillion worth of expiring tax cuts on the individual and pass-through side. Most of that sort of high-income, marginal tax cuts is not going to be particularly relevant to markets, but we think the conversation about how to pay for it is very relevant. We do think that there need to be some offsets. I don't think that's going to be fully offset, but I think even in unified Republican governance, they probably need to get that $4 trillion down closer to 2%. I will say that Trump's floating a 20% corporate rate, I think at some level is a recognition of the challenge that they're going to have fiscally on this. Like he's talked about lower numbers in the past. A 1 percentage point cut is not particularly impressive. I think that's a way of saying, like, I want to get it directionally lower, but I know that it's going to be challenging paying for all this.
Interesting.
The tariffs on a static basis, both the two big pieces of Trump's tariff policy, the 60% tariff on Chinese imports and the 10% tariff on global imports, could each raise about $2 trillion.
Tobin, I've got to go. Tobin Marcus of Wolf Research.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures on the S&P 500 negative by 0.5%. On the Nasdaq 100, we're down about 0.25%. The Russell struggling. We're down by 1.2%. That struggle is happening even with this screen looking like this. Turn the page and switch up the board and get to the bond market. The 2 years rallying. Yields are lower. We're down by 4 basis points on a 10-year. 420, 16, and the small caps not getting a bite at all this morning.
I love that you point out the fact that the Russell 2000 isn't getting any love this morning despite the rally in bond market. There was a discussion for a long time about how the first Fed rate cut would be an absolute rallying cry to go to the small caps since they were so leveraged. It's not the case, and you have to ask why, and I think you've answered it by really saying we need to focus more on the labor market to really understand just how fragile, what's behind some of the disinflation that we've seen.
If I was going to walk away from this week with one takeaway from the news conference with Chairman Powell, it would be that he thought that payrolls was overstating the strength of the US economy. Now, to what degree, to what extent, he can share that himself, but we've all got a view on that. And then to see claims pop out to 9-month highs, just gets you a little bit more focused on what really matters here. And I think ultimately, it's the labor market.
Which is the reason why you're not seeing a broadening out. And that's the reason why the rally is still dominated by big tech that's thought of as really the safe haven in the equity market. To me, that's significant because this is getting more fragile in terms of the rally. It's held up by fewer prongs. And at what point can that continue? Well, maybe indefinitely, but are we really looking at an economy that's saying U.S. exceptional comes with exceptionally strong growth? Maybe it's U.S. exceptionalism because everyone else is flat on their backs.
And this is why we like the FX market, because it's a relative game. So take a look at the euro. 109 last week, 107 this morning, 107.03, and briefly in the 106s. And you can thank this spread right here. The French-German 10-year spread gapping out to 76 basis points, the wide of the year, and the widest since 2017. The new concern, so we have a new one. It's the parties on the left forming some kind of alliance, making it even more confusing as to what is going to happen in these elections the next month or so.
But looking more likely that Emmanuel Macron is not going to get a majority like he was hoping for. A lot of people shaking their heads about the timing of this because it's coming not only during the G7 or right ahead of the G7 where leaders have already been weakened, but ahead of a NATO meeting that's going to be really important given some of the focus on Ukraine. All of this just reminds everyone, this is not necessarily a world where the U.S. really can decline against so many other people. And, you know, we're talking to Tom Kennedy, and I said to him after our hit, I said, so basically you're seeing the dollar really strengthen. Yeah. What else is going to really counter it? And that's what we're looking at right now.
Well, Europe's struggling to counter it. I want to point out the banks as well. We're down 16% on SocGen this week. 16%. We're down something like 13% on BNP Paribas. French banks have had a really difficult week so far this week.
We should bring Jay Pulaski in. He needs a rallying cry.
He's got thoughts on Europe.
He does. He's all in on the European banks, right? Jay, call in and tell us what you think and why they are going to come rip-roaring back when everyone realizes you should not leave them for dead and that one election isn't going to necessarily shake the confidence
Jay's hiding somewhere with a tin hat this morning, pretending that that's not happening on the screen. Under surveillance this morning, President Biden's international charm offensive continuing at the G7 in Italy. Biden meeting with the Pope and Italian Prime Minister Giorgia Meloni today. The meeting's coming after he signed a new security agreement with Ukraine. At the same time, the former president is making headlines on this side of the Atlantic on what he may or may not do in the next 12 months.
Domestically, which I think has been a distinction we've been talking about. This is about foreign relations. The domestic issues are the ones that are going to get people's attention. And really, you're right to keep bringing up, okay, we're hearing these proposals. What does this do for the deficit? What does this do for the ability to spend? What does this do to the U.S.'s relation? Talking about tariffs and the potential for increasing tariffs to pay for any income tax cuts that the former President Trump just proposed. Could you even create a model for that? I mean, you don't even understand what the retaliation is going to look like, let alone what kind of trade's going to get through.
You're assuming that the imports remain consistent as well, right? And people just don't back away from those imports if they get too expensive. But there is a tell here. And I know there's always a risk in trying to read the tea leaves around reporting around the former president. But I think there is a bit of a tell here. The fact that the former president reportedly is aware enough that you need to focus on this as an issue going into November tells you everything you need to know about November. The days, I'm not going to say that the days where America can behave recklessly with its deficit are over, but I think we're getting close to the point. I know this is sort of like stating the obvious, but we're getting close to the point where that is over. It's coming to an end. And you can hear that in the way that these leaders are talking about what they want to do in the future.
I agree with you. The fact that the deficit is a campaign issue is a throwback to the past. And that in and of itself says a lot. The fact that they try to give nod to the deficit, but then give absolutely no way of paying it back, gives you a sense of where we are.
Which is why the deficit is an issue still.
Correct.
Let's get to the yen, sliding as the BOJ tells investors to wait until July for details on bond buying cuts. Many thought would come today. Governor Ueda also saying the BOJ could hike interest rates in July depending on the economic data. We did gap out to about 158 on dollar yen. We're back down to about 157.21. Talk about being dazed and confused around the Federal Reserve. You're more dazed and confused around the BOJ going into next month.
I mean, everyone was kind of expecting them to signal a more near-term move than, say, September, which is now what people are talking about. It's a likely move, the likely rate hike from the Bank of Japan. I just wonder what the pushback's like domestically. They're keeping the yen weak. There's some concerns about stagflation. Do people welcome the tourists? Not really. We've heard a lot of pushback. I mean, maybe it's good for the economy, but other than that, not great. And it raises the prospect of a bad kind of inflation. So it's kind of head-scratching why they're not more concerned and looking for moves, I'm talking about the Bank of Japan, that could offset some of that weakening that a lot of the intervention just hasn't seemed to stave off.
Well, when you started talking about foreign exchange and tourists, I was looking at the euro earlier this morning at 106 and thinking something similar.
Yeah.
Perfect timing.
Yeah, that's exactly how I feel.
Summer. I know, just right.
I want to talk to resorts in the U.S. who are losing customers to Europe.
Real thing you said earlier this week.
I actually think that's interesting and sort of how they're trying to lure them back. Is it like French night?
Let's get to Tesla. French night at a U.S. resort. Okay. Tesla shareholders voting to approve Elon Musk's $56 billion pay package and greenlight the company's move to Texas, the stock having a pretty decent 24 hours. Tasha Keeney of ARC, constructive on the name, writing this. Our confidence in Tesla's ability to launch a robo-taxi network within the next 5 years has increased considerably. I'm pleased to say that we can catch up the Tesla bull right now. Tasha, great to catch up with you. I just want to start with the shareholder votes of the last day or so. Of course, they've been going on for a number of days. Do you think we can leave this issue in the past now and move on?
Well, I'm not a legal expert, so of course, we know what investors want, and now it could be up to the courts again. But what I'll say is that I think it's positive that we saw investors considering the proxy and putting their own votes in, voting for themselves. When we look at Tesla, we certainly want Elon Musk to be at the helm, especially when you consider the transition to fully autonomous driving, which is what we think will drive the majority of the value of the company over the next 5 years.
Can you walk us through why and why you think that's the real deal and we'll see it that quickly over the next 5 years?
Yes, well, so we already have robo-taxis, right? Waymo, which is Alphabet's autonomous driving project, is driving around Phoenix. They're, starting an effort in LA. They're in San Francisco, but we don't have them at scale yet. Tesla could be one of the first companies to offer a service like this at scale, and it's because they have a massive data advantage. They're collecting information from customer cars that helps them train their models, and they have more cars on the road than any other autonomous effort that I know of in the U.S. And this is their plan. They're layering on software updates incrementally. Right now, it's the full self-driving software that's available to customers. Eventually, customers will be able to take their hands off the wheel. And then last night, we heard Elon Musk talk about extensively the robotaxi effort, where you as a customer could sign your car up when you're not using it. But more likely, I think it'll be a fleet model. So you'll have perhaps another company that owns and maintains the fleet. Tesla collects a take rate off of the per mile revenue. And, I think this could have very attractive margins, higher margins than the current business model today, which is mainly selling vehicles, right? And this will be a recurring revenue. So again, we think very attractive from an economic perspective to Tesla. But more importantly, it'll change all of our lives. I think this is one of the greatest AI projects in our time. And we are so lucky that we get to witness it.
Tasha, there's some real questions about Elon Musk's leadership and whether he is focused enough on Tesla and diverting some of the chips that have honestly reportedly have gone to some of his other companies to really get some of the robotaxi efforts fully underway. Why do you think that's not a concern?
You know, I actually think it's a positive that Elon Musk runs a number of companies. One, we've heard them talk about this. It's great for talent acquisition. We've seen employees move in between his companies. You know, if you're the top AI engineer in the world, you're not going to get bored working for Elon Musk. You know, the chip story, what I'd point out is, you know, automakers actually often negotiate on behalf of their suppliers, and they do so because of economies of scale. They have better negotiating leverage. So I think having, you know, all of these companies that, you know, many of which might use NVIDIA products is, again, actually a positive here. And we've also seen manufacturing innovations come from SpaceX that bleed into Tesla. So, you know, and I think you have to look at the Tesla results here, right? I mean, when you're talking about the pay package, the stock has risen over 1,000% over that time period.
Yeah.
So he's really delivered shareholder value. And I'm, again, so excited for the future because we're really on the cusp of autonomous driving today.
Tasha, is there absolutely anything that could happen that is a potential event in the next year that could shake your confidence right now in Tesla?
Well, you know, really what I'm looking for is for Tesla to cross that threshold into fully autonomous driving. We've seen them tease this robotaxi service or a ride-hail service, both on the past earnings call and at the event last night. So I'm looking for that launch. So we have an event coming up in August from Tesla that's going to look at the purpose-built robotaxi, the next generation car. I don't think they need that car to necessarily launch the service because their current fleet is capable of it. But I am looking for details at that event about what this business model will look like. We heard some of that last night, so we know that they're thinking through the back-end logistics of how this will work. So I think that, you know, they could cross this threshold within the next year or two, and that is the catalyst that, you know, I'm most looking forward to. It's Tesla.
$2,600 price target, which is pretty punchy, as you know, and certainly gets attention, that's for sure. Can you tell me the biggest risk factor associated with your call? What would change your mind?
Well, you know, certainly I think that solving autonomous driving is a very difficult problem. And so, you know, it's hard to time that exactly. But again, as you mentioned, you know, in our blog, which is on the ARK Invest website, we think that this could happen in the next 5 years. And our confidence has increased with all the advances in AI and Tesla's, you know, improvements that they've rolled out to customers that actually own the vehicles and the software. So, you know, that is a risk. Again, we're confident that they can do it, but it is a difficult problem to solve. I think, you know, what gives us confidence from last night is, you know, if this pay package gets totally approved, you know, we know that Elon Musk is going to be at the helm of this company for at least 5 more years. He has limits on when he can exercise his options. So I think that is another key piece that we want Elon Musk to stay. We want him to be incentivized. So I think that's ultimately a good thing.
Who do you think controls the fate of this call? Do you think it is Tesla and their ability to execute, or do you think it is the regulator, local authorities, who will ultimately have the decision to make to give this the green light or not?
Great question. You know, I was just going to touch on that. So often people are concerned about regulation. I actually think that, you know, again, the more difficult problem here is actually making the technology work and scaling this type of service. The U.S. has actually been surprisingly lenient with autonomous driving because it's been up to the states. And we've seen, you know, Tesla right now, they have over 1 billion miles cumulatively in the full self-driving software suite driven. So I think that they'll be able to statistically prove to regulators that this is safer than humans. And actually, we've done some research on this. So if you look at their full self-driving software suite, the last time they gave us a statistic, which is a little over a year ago now, it looked like it was 5 times safer than human-driven Teslas, and even safer than the average car on the road. So we're already seeing those proof points, and I think, you know, it could get even better. And in fact, Elon Musk has hinted that they have line of sight to maybe a 4x improvement on that. And that's what's going to matter to regulators here. So we're already seeing those safety points.
Tasha Keeney, great to catch up with you. Thank you. Tasha Keeney there of ARK Investment Management. Brambo, you know how this works. You can go through the stats and make the case that the technology is safer than a human being behind the steering wheel. Unfortunately, what happens when you have that one single fatal accident, it's the front page of the newspaper and it sets everything back a long time.
Yeah, people like to think that even if they can be distracted or look at their phones or texts or have an extra beer, that they are somehow better off than a robot that has a better track record but occasionally can malfunction, which is the reason why we've seen a whole host of different trials banned, particularly in the southwest of the United States.
It's quite a big call. In fact, it's a massive call coming from Mark on that particular name. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Luxury labels are discounting their products like never before in China. Concerns are growing over unsold inventory while locals have pulled back on their spending. Starting this month, Chinese shoppers can snap up a small beige crocodile pattern version of Balenciaga's iconic hourglass handbag for 35% off. Other labels are doing something similar. Versace, Givenchy, and Burberry have all slashed prices, some by more than half on Tmall and other domestic platforms. Microsoft is withdrawing a new AI feature on its Windows software for new PCs. The feature, known as Recall, creates a record of everything people do on their computers. Microsoft now says it will only be available in the Windows Insider program instead of all new computers. Researchers had criticized Recall almost immediately after it was introduced, saying that bad actors could access records that are gathered by the tool and stored locally on a user's PC. The FAA is investigating counterfeit titanium that was used for parts for Boeing and Airbus aircrafts. A report from the New York Times says the material was sold using falsified documentation that claimed to verify the material's authenticity. Those claims came from aircraft manufacturer Spirit Aerosystems. The investigation was launched after small holes were found in the material. As of now, it's unclear how many planes have parts made with the material in question. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, it's the data, not the dots.
Inflation, which we're all focused on, has eased considerably. I certainly expect further progress to be made, especially as rents and other critical price pressures recede over time.
I don't know about these cozy fireside chats, you know.
It looked like hard-hitting.
I prefer just have it. It's a bias. I have a preference for it to be sort of like a journalist who has real hard-pressing questions to try and hold them to account.
It's what's the goal here? We could discuss.
Yeah, okay.
You put yourself up. Raise your hand for it.
Yeah, I'm not sure they want that to happen. But anyway.
I would.
Right. I know you would. From New York City this morning. It's beautiful outside. It's just fantastic. Let's wrap up this week and go home.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Equity futures staging just a little bit of a recovery this morning. We were down by about 7 or 8/10%. We're negative by about 4/10% on the S&P 500. In the bond market, the rally continues. It's a break of 420. It's 4.1997. Yields are down by 4 basis points on a US 10-year. In the FX market, the euro weaker. It's a break of 107 this morning, 106.98. We're negative by 1/3%. The concerns about France still there, very much front and center when it comes to the European story. Under surveillance this morning, it's the data, not the dots.
Inflation, which we're all focused on, has eased considerably. Headline inflation is down almost 2/3 from its peak, and core inflation has also trended down on balance, and I certainly expect further progress to be made, especially as rents and other critical price pressures recede over time.
Here's the latest. Treasury yields falling as cooling inflation data boosts optimism the Fed will be able to cut rates later this year. Michael Zezas of Morgan Stanley writing this. Our economists still see 3 cuts this year. The CPI number helped. We still see Treasury yields trending lower towards 4% into year end. Michael joins us now for more. Michael, good morning to you.
Good morning.
Inflation soft this week. Shouldn't that be the big takeaway? Downside surprises, CPI, PPI, is it that? Or is it jobless claims at 9 months high? Did that spook you at all?
No, not particularly. I think you're right. Like, inflation should be the focus. And I think much credit to the Morgan Stanley economists, who I think have been very consistent on this all year. There's a lot of noise in the data early in the year. They still had a lot of confidence that inflation would be coming down. We're starting to see that very much in the data. And it's all consistent with the idea that we're going to get a cut. We think we're going to get a cut in September, 2 more on the follow after that. And then that should keep Treasury yields moving lower. That should drive a lot of confidence for fixed income investors overall.
That word confidence, I want to play with that just a little bit more.
Yeah.
There's a lot of people that are talking to us at the moment that don't have much confidence in the forecast for unemployment over at the Federal Reserve. What's interesting about that is that actually we used to call their forecast aspirational, and they actually materialized in a very, very favorable way. So it's not to say that it can't happen, just how probable is it that we end with unemployment at the end of this year where it is right now?
Well, I think it's more likely you see it tick up, right? And that's consistent with our economics forecast. But there's a lot kind of undergirding that number, right, in terms of the size of labor force. Obviously, we've seen the size of labor force go up quite a bit with immigration numbers. But as long as inflation is coming down, again, then I think the broader narrative for fixed income investors is going to be, we feel more confident that the next move from the Fed isn't rates higher, is probably going to be rates lower. And whether or not it's 1 cut, 3 cuts, but we think it's going to be 3 cuts this year, total return tailwinds are pretty substantial in that environment. And it's not even just about government bonds. We really like actually corporate credit in that environment as a way. You're cutting not because the economy is weak, you're cutting because you're getting from restrictive territory to neutral territory. That should be solid for credit fundamentals because the economic backdrop is good. So even though you've got tight spreads, you can earn that extra spread and get even better total returns.
I can get all that. I can understand the logic, and I'm sympathetic to it. But then other people will say by the end of the year, there are going to be other issues as well. And you wear a couple hats at Morgan Stanley. One of them is professional deficit warrior. And I am curious about how much that starts to really factor in to really counteract some of that 4% call on benchmark yields.
Yeah. Well, I think the deficit story, or the real potential delta in deficits, probably more a 2026 story, or at least a late 2025 story. And that's because the main conduit for deficit expansion or contraction is whether or not the provisions inside the Tax Cuts and Jobs Act, which are all expiring at the end of 2025, whether or not those get extended. A lot of that's going to be a function of the election outcome. Now, we think it's kind of pretty base case, even with investors, we talk about that there's going to be an extension of a lot of those provisions, so it shouldn't be surprising that the deficit will look higher than what the government is projecting right now. But again, that's something that comes into play 12 months from now, after we've collected a lot of other economic data that's going to interact with markets.
So just to sort of sum up what we're seeing right now in markets and a lot of the conversations we're having today, it's sort of like U.S. exceptionalism is being reinforced by dysfunction in France. I mean, is that essentially what we're seeing, that all of the worries are sort of, put to bed by everybody else being a lot worse? And so basically we're looking at a scenario where the U.S. will be just fine?
I mean, I don't know that I would go that far, right? I do think that we've got a broad story where the economic fundamentals look good, right? The growth story is pretty good. Inflation is coming down. And we've got a major variable of our political variable of our own to deal with, which is the U.S. election at the end of this year. And that could change the perception in terms of the economic trajectory in 2025. But beyond that, the story through the end of the year, which is a more reliable one, is kind of the internals of the economy are broadly supportive of the fixed income market.
Need your thoughts on the tax proposals that have been floated in the last 24 hours. I know it's all sort of like in newspapers and reports, and it's difficult to sit there as an analyst and put some numbers together. But if the former president came out and said, you know what, I think we can fund some of these income tax cuts with tariffs and the revenue from tariffs, how would you be thinking about the numbers around that issue?
Well, listen, some of the third-party estimates here are that if you do a broad 10% tariff, you get something like $350 billion of revenue. But that's making a very big assumption that the actual price level of imports wouldn't change, which I think most economists would tell you is a bad assumption to make, right? So you don't know how much money you would actually generate from that. Could you use it as an offset? So in a situation where Republicans win the presidency and they're looking to extend most provisions of the TCJA, I think in the court of public opinion, they'll probably make the argument that there's some offset there. When we would actually look at what it does to the deficit on an official score basis, it's probably going to be less of an offset. So the way we have it sized up, Republican outcome scenarios, particularly a Republican sweep, probably lead to bigger deficit outcomes in 2026 and beyond. And the more you skew towards a Democratic sweep, the smaller the deficit increase. But we have deficit increases across the board marked in no matter what the election outcome is.
It seems to be the takeaway. If you get one sweep, doesn't matter the color, not great for fixed income.
Well, but this is the thing. When won't it be great for fixed income, right? Not yet. It'll be fine. Maybe 2026.
Getting closer.
We are.
To that moment.
I just hear Steve
I don't know when
Eisman
that
in my
moment
head.
is. Or the deficit.
The deficit.
Yeah.
You've been doing it for 30 years. I mean, it's true, except how much, again, is U.S. exceptionalism being kept alive by French fragility?
See it in the FX market this week, that's for sure. Michael, thank you.
Thanks
Michael
so much.
Cesis of Morgan Stanley. Coming up, Daryl Cronk of Wells Fargo, PG&E CEO Paddy Popey, Eugenio Elman of Raymond James, Zach Griffiths of Credit Sites from New York. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The theme is still patience, and the Fed just wants to see more data to make sure that inflation is convincingly moving lower.
There's no clear indication that they're going to need to rush into cuts. They're trying to tell us that they're keeping all optionality open.
Even if there was a shift in the pace to get there, it seems like their direction of travel is still towards a rate-cutting cycle.
It is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Did you ever play like the odd one out as a kid? Is that like a game you played? You had to like spot the odd one out? Like you'd line up a list of things. You have to spot the odd one out.
Sorry, we called it something a little bit different.
What did you call it?
We called it, well, it was just like pictures, like two pictures.
Sure.
You had to figure out what was missing.
Okay.
What was different.
All right, so like thoughtful conversation, sophisticated market-based version of that. I'll read through some headlines and then you can say, you know, which one doesn't make sense here. So headline 1, jobless claims rose to the highest level in 9 months. Okay. Number 2, PPI delivered the biggest decline so far this year.
Yeah.
Number 3, CPI stepped down for a second month in May. Number 4, the Fed reduced the median dot from 3 cuts to 1. Which one stands out for you?
Okay, this is like the financial version of an SAT. Why would the Fed cut their expectations for how much they're going to reduce rates if you see disinflation, potential weakness in the labor market, et cetera? A lot of people are saying, is that correct?
I'm just saying something doesn't add up here.
Okay.
And that's the piece of it that doesn't add up.
Except that you look at what happened at the end of last year and sort of conditioned by experience and the fact that in the first quarter of this year, there was hotter inflation than many people expected. But I get your point. We seem to be at a tipping point, which is a reason why markets are in a very different place than the Fed seems to be and are looking past the hawkish tone and saying, you guys are just kidding us.
I'm going to keep going back to Neil Dutta, your friend over at RenMac.
Hi, Neil.
The Fed dots will look increasingly offside relative to the incoming inflation data. The hope is that the Fed's rhetoric shifts quickly. The risk is that it doesn't.
At this point, though, it seems like the market is moving with or without the Fed, because right now the Fed has no edge, and it's unclear exactly what's going to tip the balance. What I find interesting in this week's market move is that it is not unabated strength. It is not an unabated cheer rising up through Wall Street saying, if the Fed cuts rate, this is going to be a rip-roaring rally that ignites another wave of this recovery. This is something different, with an underperformance of a lot of the consumer-facing sectors and an outperformance of a lot of the winners to date. So it doesn't seem like this market is rallying against a sign of strength and Fed saviors. This is a market rallying around the idea that, yeah, the winners can keep winning, but the losers aren't going to win that much in a time of great uncertainty.
You've got your finger on the pulse for sure, because I don't sense the hubris this week at all. It's not one of those weeks where you have 4 consecutive days of all-time highs and everyone's punching the table, banging things and going buy, buy, buy. I think there's a real asterisk there this week, even with the encouraging inflation data we've had over the last couple of days.
If you take a look at where the performance is, equal weight on the S&P is down. If you take a look at the NASDAQ 100, it's up. You can see more broadly that the market-weighted S&P is up something like 1.6%. Why? We had a couple of big tech names that reported they were winning from AI. That drove a lot of the gains yesterday. You look under the hood, small caps underperforming yet again. These all indicate a greater sensitivity to what you've been pointing out, John, which is a weakness in the labor market, which is a Jay Powell that came out and said, perhaps what we saw last Friday overstated just how strong this U.S. labor market is.
More on that in just a moment. Equity futures, your scores right now, negative by 0.5% in the bond market. The rally continues, which speaks to some of the themes that Lisa was kind of laying out there. Yield to lower by another 5 basis points. Your 10-year, a break of 420, 419.58. Lisa also pointing out that Europe is spending a lot of time making everyone else look good. And we're seeing that in the FX market with the euro at 106.91.
Well, I happen to wonder if today is basically U.S. exceptionalism by default, because there's nobody better. And we've been talking about that extensively, and people can worry all they want about the deficit. But then you look over to France and you say, what a mess. I mean, what level of mess do you want? Whether it's, the additional threats to Emmanuel Macron, whether it's some of the deficit concerns, et cetera, all of a sudden, boop, you've got that dollar strength again, and everybody's going to Europe for vacation. So, this is some of what where we're at this morning.
Everyone's going to Europe.
Everyone around this table. Just want to make that point.
I know.
There you go.
I know. It's like there or Tokyo with the euro at 106.90 and dollar yen still very close to 160. Coming up this hour, here's your lineup. We'll catch up with Darryl Cronk of Wells Fargo with stocks on track for 5 straight days of gains. We'll catch up with the PG and E CEO, Paddy Poppy, on the impact of EVs and AI on the electric grid, and Zach Griffiths of CreditSights on why he sees a notable economic slowdown in the second half. We begin with our top story. Stocks on track for a 5th straight day of gains following a week of softer than expected inflation data. Darryl Cronk of Wells Fargo saying the following. As the S&P 500 makes news highs, it's important for investors to rebalance to avoid portfolio equity concentration risk. Trim tech and communication services to neutral weightings. Darryl joins us for more. Darryl, good morning to you.
Good morning, John.
What did you make of that opening exchange? Are you with us?
I'm with you 100%. I mean, so everybody knows the concentrated returns. I just ran the numbers yesterday. If you look at just the top 5 names, right, not the top 10, top 5, they're driving about 82% of the index, 13 to 14% year-to-date return. So strip that out, you're up maybe 2-3% year-to-date on the broad, level. But maybe what's more important is when you look at those names, the top 5, 10 names, the correlations are as high as they've been since August of 1997. Right? So what's that tell you? It tells you that people are chasing, right? They're chasing those winners and continuing to feed into it. And to Lisa's very good point, if you take the NASDAQ 100 against the Russell 2000, so tech against small cap, 5-year wides, right? I mean, we're at the widest level we've been. So small cap continues to underperform, not surprisingly. I keep getting asked every conference room I go into, every meeting, when's it time to buy small cap? When's it time to buy small cap? And I keep saying, not yet, not yet, not yet, right?
When is the time?
The Russell 2 probably needs to be somewhere in the 1800s, maybe even 1700s before I think you get a compelling risk-reward flip there that makes sense, but nowhere here above 2000.
So why do you have this argument that you should be more concerned about concentration, since that's one, and more interested in some of the others that keep lagging behind?
I think because eventually you end up with this kind of, think of it almost like it's a Teflon market, right? Nothing seems to stick to it. Every risk that we roll at it, right? Whether it's, the France risks this morning and the tails or anything like that, just seems to bounce off of it, and the same theme plays through. AI wins, tech wins, right? It's 7 months into that. If you run a marathon or a race and you sprint for 7 months, which we have sprinted, let's be honest about it, you're going to be tired. And I think the market is tired here. It's, when you look at those top concentrated names, to the point they're doing extraordinarily well, right? And I'll take it. But I get under the surface, right, whether you're pointing equal-weighted, small cap, I look at some of the other sectors, they're just not participating at the same level.
So I guess the question is, do you sell your big tech exposure, or do you buy everything else? It's a big distinction. Are you bullish on the other sectors, or are you just simply getting a little bit more skeptical of how much further tech can run?
So yes to the former, right? Which is, so I think when you get underneath, we just released our mid-year outlook this week, right? One of the things we did in the mid-year outlook was took energy to the most favorable we could possibly take it to, right? In the portfolios. Basically, we ran it up to the highs. big pullback, obviously, in oil prices. We've taken all the political risk premium out of oil prices, which kind of shocks me given the global landscape of where we are. I'm getting a lot of big, whether it's the integrated energy names or even some of the exploration companies at 12, 13, 14 times PEs with a 3.5% dividend. I will take that all day long. We also like materials. We think healthcare is a good value play here. And we would fade places like the consumer, obviously REITs, and even financials look a little bit overbought to us here.
Wait, consumers, REITs, and financials, this is very interesting at a time where the Fed ostensibly is going to be cutting rates pretty soon.
Correct.
And at one point, this was supposed to fuel the next consumer spending wave in the sense of consumer strength and ability to borrow in a new way. Why is it not playing out that way?
Because I'm not sure the consumer is as strong as people want to give it credit for, right? I mean, if everybody does including us, the top 5 quintiles of income, right? We know that the bifurcation of the high end is doing well, the low end is not. But what people are missing is kind of the creep up into the middle income levels of where people are trading down for value. They're not spending as robustly as they want to. You see, consumer confidence numbers are still in a downtrend. Small business numbers are still, pretty ugly, right, when you get below the surface. So there's just not a lot of reason to believe, to us it looks like the consumer's kind of running that last mile here, right? They've been able to stay durable and spend. I'm just not sure how much gas is left in the tank, Lisa.
So this time last week, when we read out the payrolls number of 272,000, you didn't hear 272,000, you heard something else?
So I think payrolls and the labor market in general are getting skewed heavily by some of the lag effects of what's happening with immigration in this country and everything else. So we ran the numbers again. If you take just immigration from pre-COVID levels, we're 3.3 million people higher today in the labor force than we were coming into 2020, if you will. That's having real impacts on the labor force, right, and those numbers. So the labor market is still strong. We'll take a 4% unemployment rate all day long, but I'm not sure that it's as strong as maybe the numbers might be sending a little false echoes there to us.
This is what Chairman Powell basically said in the news conference. One of my sort of biggest takeaways from the polls over the last year is this poll right here. It's from Guardian Harris poll that came out in the last month or so. And it reads as follows. I'll give you some headlines. It's stunning. 55% believe the economy is shrinking. 56% think the US is experiencing a recession. 49% believe that unemployment is at a 50-year high.
Wow.
49%. That's the poll that came from Guardian Harris in the last month or so.
It's the reason why consumer sentiment has been so low. People don't feel good. Is that wrong? Can you say that people's feelings are wrong, or are they feeling something that the numbers aren't showing in quite the same level? And people explain it by the K-shaped recovery. Stay tuned for the University of Michigan Sentiment Survey out in approximately 1 hour and 49 minutes.
Well, maybe we're just not measuring things properly.
Correct.
Household survey versus establishment survey last week was the big standout, Darryl.
I think you're spot on, right? I mean, I think you've got to really, you can't just take those headline numbers as they stand, right? You've got to dig in under the surface and kind of take the second derivative, third derivative, and understand what those numbers are telling you. I am a big, firm believer that liquidity is masking so many things around the economic element. I mean, we just went back and ran the numbers from just the 2020s. We're now in 2024, obviously. Financial markets are up about $46 trillion in AUM, right? Government debt is up $12 trillion, right? Think of just the liquidity that pushes into the engine, right? And the ability for consumers to stay longer, right? For businesses to feel better, right? All of that has had this kind of long-lasting, call it the marathon effect, right? We run hard for 7 months, but Wall Street isn't Main Street, right? And so the S&P isn't what people are feeling if you walk up and down Main Street to the point of the survey, right?
49% believe the S&P is down for the year. This is quite a poll, isn't it? It's
well,
amazing.
Yeah, that is
a lot of the companies are down. So it also speaks to the non-AI members.
Darryl, this was great. It's good to see you, sir. Thanks for sharing your thoughts. Darryl Cronk there of Wells Fargo. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. A check on Adobe this morning, shares up 14.33% in the pre-market. They projected strong sales for its suite of creative products, and that suggests that customers are adopting Adobe's new AI-based tools. They've been integrating AI into some of their most popular products. That includes things like Photoshop. The CEO said that it's helping the company attract a, quote, expanding universe of users. A judge looks set to reject a $30 billion settlement between Visa, MasterCard, and retailers, which would have capped credit card fees. The deal, which was announced in March, would have let merchants charge consumers more for transactions involving Visa or MasterCard. Spokespeople for both firms say that they were disappointed by the developments. And Germany will meet Scotland in the opening match of the European Football Championships in Munich later today. The hosts will go into the tournament as one of the favorites alongside England and France. Defending champions Italy face a tough task of winning the tournament again. They're in the so-called group of death with top rivals Spain and Croatia. Only 2 teams from each group advance to the knockout rounds. And that's your brief, John.
Danny, thank you. Try not to talk too much about that going into the weekend.
Yeah.
Good luck to everyone participating.
It's a happy weekend.
Happy weekend
Yes.
and all of that.
Yeah, that was basically for you.
Might be going on a vacation.
Yeah,
sort of
exactly.
coincides with
Are you
3
going to
games. Coincides with 3 games.
going to them?
No, I'm not. But I'm going to try and watch them. You know how that's going to work, don't you?
Yeah,
Sort of
I
at the dinner table,
Yeah,
sort of
good luck.
streaming them. And
Oh, that's going to be
looking at the
great. That's really scores. going to go well with the
Gonna work out.
fam.
Yeah, all right. Up next on the programme, the morning calls and the PG&E CEO, Paddy Poppy, joining us next from New York City. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities on the S&P 500 negative by 0.5% following 4 days of all-time highs, record after record for the whole of this week. Looking to make it 5 for 5. It's going to be a struggle, Bramo, based on this screen. We've got equities softer, we've got bonds rallying, yields are lower by 5 basis points, 419 on 10s.
And how much is this sympathy with what's going on over in Europe, and how much is this a realization of what Daryl Cronk was just saying, which is the internals look a little weak and the consumer maybe on a back foot a little bit more?
Euro weaker, breaking down to 106 today, 109 last week. French 10-year versus the German 10-year, an update on that, 77 basis points. Getting a little bit wider on the session again. Time now for some morning calls. First up, Evercore upgrading Shopify to outperform. The analyst expecting better profitability longer term and saying this is an attractive entry point on the stock. Next up, KBW upgrading Bank of America to outperform with a price target of 46. The upgrade backed by a higher forecast for net interest income. That stock is down about 1%. And finally, JP Morgan upgrading Adobe to overweight. The firm's seeing better growth in the second half of the year and new products with artificial intelligence. Of course, the rise in AI services also driving demand for electricity. Growing computing power and the rise of EVs have traders looking for ways to invest in the energy grid. I'm pleased to say that joining us now is Paddy Poppy of PG&E, joining us around the table. Paddy, good morning to you.
Good morning, John. Great to be with you.
Fantastic to catch up with you. We're going to see massive demand, potentially. EVs, data centers. Can you help frame that for us? How big is this going to be over the next few years?
Yeah, we forecast, and in fact, we shared with investors here in New York this week, a doubling of demand between now and 2040. That's a CAGR of about 4% year over year. And we think that's a great opportunity because we see ways of serving that load while reducing costs for all customers on the grid.
That's a big challenge. So help us understand how you're going to meet that challenge.
Yeah, so our grid today is underutilized. We actually, the utilization factor of the grid today is about 45%. We see that growing to 60, 70, 80% even. And so imagine more fully utilizing existing assets lowers the unit cost. That's what happens in every other business but energy. We've built the grid big. We built it big decades ago. Now we get to utilize it and make it smarter. So with modern computing, we can actually optimize how we utilize resources on the grid and use them more efficiently.
So utilities have been sort of the hotbed. It's basically been the way for people to go into AI in a new way to represent some of the power usage that's going to be necessary. I know the PG&E has lagged behind a little bit of the broader rally that we've seen in utilities. What are you telling shareholders in terms of how you're going to close that gap? What sort of pieces you're going to really lean on to catch up?
Yeah, what we share with investors is that we are on track on our turnaround. PG&E has been through some very difficult times in the last decade, and we have put the company on a new and solid footing. Over the last 4 years, we have implemented a safety and financial safety, both physical and financial safety framework for the company that has now given investors confidence to come back in. So we have both the benefit of the new demand and closing our discount all at the same time, which makes us both one of the growthiest utilities and the ability to reap some of the benefits of our turnaround.
What will be the contours of the utility companies that benefit most from the AI boom? I know that you talk to the likes of Apple, you talk to all of the California tech companies. They're in your state after all, but there's really a question of what it takes to win.
Yeah, we're proud to serve Silicon Valley. We serve the Bay Area of California. We serve Northern and Central California, so all of those great tech companies are our customers, and so we're very tightly knitted with them and helping deliver on their demands. We think that we can serve their load with mainly transmission and distribution. There will be some new generation added, but the utilities who win are those that own and operate transmission and distribution systems where there is data center demand and EV demand. It might surprise you that in Santa Clara County specifically, 43% of new vehicles sold last year were electric. That's flexible demand, the first form of flexible demand on the grid. The lights come on when it's dark. Air conditioning comes on when it's hot. EVs can charge any time. We send the right price signal. We've got excess power in the middle of the day because we have distributed solar. We can fill, as I say, the belly of the duck with EV demand, and that costs nothing. That is utilization of existing assets to the benefit of all customers, not just that EV driver, but all customers on the grid get a lower unit cost of energy.
Someone told me recently that California had the second most expensive power rates in the United States. Can you help me understand why that's the case?
Yeah, rates are a reflection of how much energy you use. We all have a grid that has to be built for a peak day. So if you have a grid, and like ours in California, doesn't get stressed but a handful of days a year versus a Southwest or a Southeast utility where they have heat every day, we have to build the grid for that peak day. That's why EVs and dynamic demand are such a benefit, especially for PG&E customers, because we have an underutilized grid. That drives a rate up, but their actual average bill is not nearly as high as much of the country.
Could we talk a little bit about power plants as well? How easy is it to build and connect new power plants in places like California?
Well, it depends what you think of when you say power plant. In California, we think of clean energy. So last year in the California Independent System Operator Zone, we added 9 gigawatts of new power supply. That surprises people. 9 gigawatts added in California last year. That serves 9 million customers. That 9 gigawatts was mainly renewables matched with storage. Storage is the game changer. In fact, April 16th, storage was the #1 resource utilized in California. Again, matched with solar. We have great solar penetration, matched with storage. That's a new kind of energy supply. 100% of the energy that PG&E delivered to our customers last year was carbon-free. We have a modern energy system in California, and PCG is so proud to serve California, where I think it's the golden era of energy for all energy providers, but particularly in the Golden State, and we get to power the Golden State, and we're proud of that.
How much time are you spending in Washington, D.C., and how much do Washington, D.C. policies really change the way you approach some of this in terms of what the different potential subsidies are for green energy or not, and also where solar panels are coming from and how much they cost, given that a majority of them are produced in China?
Yeah, I don't spend much time in Washington, D.C.
Lucky you.
I wear boots. I wear boots and a hard hat. I had to do my hair special for today to be with you. Listen, I'm boots on the ground with my team. We are building the grid of the future, and a lot of that, it depends on us. We have a saying, performance is power. When we perform, and as we perform at PG&E, we can deliver the power that people need.
But to that point, how much is your business model challenged depending on what comes out of, say, tariffs on solar panels that you will need to deploy for some of these energy purposes?
Yeah, because our grid, again, is underutilized, we have a lot of the resources we need. Well, we need to use them smarter. So I need to be with my tech companies because we're building a digital grid. We're building resources that are technical, that are small bets, not big bet asset deployments, but leveraging the grid and serving customers in a much more dynamic way. It's a smarter, faster, more affordable grid, and we don't need much help from out of state to do that.
Patty, this was fantastic. Fantastic to see you in person without the hard hat.
Yeah,
Right,
anytime, John, I'll come back.
You can bring it. It's okay.
Okay, good. Next time I'm wearing it.
I think that would be nice.
There's some people in financial markets wearing tin hats at the moment, but that's a very different reference. Patty Poppy there, the PG&E CEO. That's a very Lisa Abramowitz thing to do.
What?
To wear a tin hat? Financial markets, yeah.
I think that I should show up one day with a hard hat. It's like,
And
today's
that's
going to
your
be
hard hat.
rough.
I'll send you one, Lisa.
Thank you. I appreciate that.
Today's today.
Big
Coming up
boots.
very shortly, Donald Trump promising to lower the corporate tax rate by 20%, or to 20% from 21% if he gets a second term in office. That conversation just around the corner. Equity futures on the S&P 500, negative by 0.4% on the S&P. In the bond market, the rally continues. Yields are lower by 5 basis points. The 10-year, Lisa, about 4.19 here. The rally continues.
It's just amazing to see, despite some of the deficit worries, despite the idea of longer-term inflation going up, still very much front and center, the possibility of the Fed cutting rates and a weakening in the U.S. economy.
That conversation just around the corner, and we'll catch up with Anne-Marie on the ground in the south of Italy as we wrap up the G7 from New York. This is Bloomberg. good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The most feedback I've had so far this morning. Good luck to everyone. This is football, John. I don't believe you mean that for a second.
100%.
Just don't want the tension about football going into the weekend.
Really?
People start arguing about it. I just don't need that in my life anymore.
What are you talking about, people?
You know, like everyone.
Yeah.
It's a very international program, so people have got their own countries and...
Yeah, no one's buying it.
You know,
I'm sorry, no one's buying it.
The most diplomatic person I know is Mohammed Al-Arian.
Yes, he is.
If you notice what Mohammed does with sports, he'll be like, congratulations to everyone who participated. Every single time. Every single time.
Yeah, and then I get the messages, come on, why did the Mets suck? We're both Mets fans, so there you go.
Mets and Jets, which I've always found is like the loser combination when it comes to New York sports. What is that about? Why is it always Mets and Jets? Why is it always the two combined?
I don't know, because I'm actually more of like a Mets and Giants fan, so I don't really understand. Maybe it's just that there's like a feeling of virtue in following a losing team.
Got it. Okay. Never really understood that, but all right. Equity futures on the S&P, negative by 0.4%. We're 1 hour away from that opening bout. We're down by 0.2 on the NASDAQ 100. We've had quite a run of gains in the equity market. 4 days of gains, 4 record highs. 4 consecutive all-time highs on the S&P. Looking to do some more a little bit later, but at the moment it's a struggle. On a Russell, the small caps down by 1.2%. That move, even with this move in the bond market, 2-year, 10-year, 30-year, stacking up as follows. Here are the scores. 466.43. We're down 3 basis points on a 2-year, down another 4 on a 10-year. We had a brief break of 420 a little bit earlier in the session. 420.54 is where we are, Lisa, right now on the 10-year.
And you really raised the point. At what point do we start talking much more about the labor market and just how strong it really is at a time when the Fed might not be having any dovish speak? The market's saying, we don't believe you. We are looking at other things, and they are pointing to some sort of not only disinflation, but also a slowdown. And that's really where the focus is this week.
I've always said, you know, smartest audience on the planet, and I'm super privileged to have it. Mets and Jets played at the same stadium from the 1960s to the 80s, according to David, who just writes in. David, thank you.
David, thank you.
Apparently that's the story.
And David, thank you for correcting my completely butchering the whole thing with making up some reason.
You know, it could be another dimension to it.
Yeah, sure.
Yeah, all right, whatever. Let's get to the euro.
Thanks, please. Let's
focus on
talk
foreign
euro.
exchange, something we might know something about. 106.84, it's a breakdown of the single currency. We're down 0.5%. That's one touch point. Here's another. I want to talk about the French 10-year versus the German 10-year, briefly as wide as 77 basis points. Why does that matter? Bit of perspective, some context. 77 is the widest we've seen not only this year, but going all the way back to 2017. And from there, then you start thinking about going all the way back to the real tension of 2011, 2012.
So, you know, just to put it into perspective, it's the pace of move, too. The pace of the expansion that we have seen in terms of the spread, the gap between OATs, French bonds, bond yields, and German bond yields, has been the fastest going back to that time frame, to that 2011 European debt crisis. So one thing that Jeff Yu this morning, and I just really keep going back to that conversation, he said, keep looking at the potential to widen out more and what that signifies about the fragility of a region that at one point provided a counterpoint to the dollar and increasingly maybe less so.
The banks are picking up on that tension. We've got SocGen down on the week by something like 13%. We've got BNP Paribas down a similar amount. In fact, SocGen on my screen at the moment on the week is down 16.5%, which is a pretty rough week. That would be the biggest weekly loss on that particular name on the CAC 40. Biggest weekly loss going back to March 23, which is when we had real tension in the banking system this side of the Atlantic.
We should explore at some point just exactly why they are so vulnerable to some of the potential shifts in the government, because is this just a deficit call? Is it a bond call in terms of valuations shifting, or is this an issue of
potential regulatory uncertainty given some of the threats about the Euro region and what this could do?
You know, I joked earlier on this morning about the false sense of superiority in the French bond market.
Was that a joke?
Yeah, no, I think there's some truth to the fact that they've been grouped in with Germany for a long time. And there's real questions as to why. There was a budget deficit to GDP last year of 5.5%. You know, are they closely aligned with Germany or more closely aligned with what's been developing in Italy? And I think you could make the argument, and things could change, of course, that Giorgia Meloni's government right now in Italy is more stable than Emmanuel Macron's in France, that's for sure.
Yeah, which is the reason why you're seeing the spread widen and the reason why people could say it would go further. Arguably, this move began when the France government rating was downgraded, because that put them on risk to not be able to pay back their deficit, and that potentially could lead to this sort of existential fear that France is not Germany, and that actually credit risk does matter once again.
Deficits matter in places like France, the UK, and keep coming back to this point, will they matter here in the United States? Under surveillance this morning, a couple of stories for you. Bloomberg reporting meme stock investor Keith Gill, better known as Roaring Kitty, is exiting his entire options position in GameStop. A screenshot of his E-Trade portfolio no longer includes the calls set to expire next week. Roaring Kitty's cash position dipping to $6.3 million from nearly $30 million on Monday. Lisa, quick stock check. We're up by about 2% in the pre-market.
So he's moving out of his options. However, he has increased his stake in GameStop, his actual cash stake in shares, to become one of the biggest investors in this name, in GameStop. He is up there. There are only 3 other investors who own more than 9 million shares of GameStop as he does. That include BlackRock, Vanguard, and RC Ventures. So it sort of raises this question of just what his influence is going to be and what will Roaring Kitty do next?
Still waiting to see. Have we ever seen Vlad Tenev and Keith Gill in the same room? Has it ever happened?
You're going to start this rumor, really?
They look identical.
You think that that's going to
happen?
happen?
I'm not the only one saying that.
Okay.
They look identical.
Do you want to make some of the conspiracy theory?
Looks like the same person. No, no conspiracy theories.
Well,
I had a really weird conspiracy theory yesterday that I'll talk about another time.
Yeah, not on air.
Something like that. Yeah, not on air. Let's get to this one. A New York judge is likely to strike down a $30 billion settlement between Visa, MasterCard, and retailers. The deal would let merchants charge consumers extra in payments using Visa or MasterCard credit cards. The note coming in a court filing yesterday. An official ruling is expected in the coming days. Remember, there was all this talk about maybe retailers charging more depending on which credit card you were going to use when you paid for all your items.
So is the issue here, and this is sort of what's yet to be determined, is the issue that the fees have to be bigger? Is it that they have to charge lower fees? Is it that the convenience stores can't pass it along to the consumer? Is it that it ultimately has to be a business model thing? I mean, this raises a lot of questions about how to remedy this and whether this is more friendly to some of the charge cards or whether this is more friendly to the retailers. I read a number of different articles and couldn't get a sense of what the answer was.
I had the same questions as well. And another thing that we've brought up earlier on this morning is how different things are going to be under a different administration around issues like this. Of course, this goes through the courts and this can continue going through the courts. But I mean more about mergers and acquisitions, business-friendly regulation, who are we fighting for, the small guy or big business, and what's that's going to look like if we do have a change of administration in the next 12 months.
You raised J.D. Vance. He's been for a lot of the antitrust efforts. So it's really a black box. Good luck for 2025.
Yeah, flying blind to 25 is like the catchphrase of this program at the moment. Here's the latest on the 2025 effort. This from the former President Donald Trump, returning to Washington, floating tax cuts to lawmakers and business leaders. Trump telling CEOs he would cut the corporate tax rate to 20% from 21%. Trump also on Capitol Hill saying he would like to extend income tax cuts and use tariffs to help pay for them. Joining us now to discuss is Eugenio Alleman of Raymond James and Zach Griffiths of Credit Suisse. Zach, I want to come to you first. We've learned in the UK that deficits matter with Liz Truss. We're learning at the moment in France that deficits matter for Emmanuel Macron. How quickly before we learn that deficits matter for this bond market in the US?
We don't think it's that soon, John, and the dollar has the privilege of being the world's reserve currency, and so I think that's a big driver. Now, if we do get a red wave, let's say at the end of this year, and some of these more expansionary fiscal policies that could lead to larger deficits and higher inflation, I think that changes the calculus a bit in terms of, do deficits matter? Are we going to see it priced in? Are yields going to retest the highs of last year? So we are circling the election as a key litmus test to how much that comes into market pricing over, let's say, the next 12 months. but our base case is we have a little bit more wiggle room in the U.S. than in other nations.
Eugenio, we keep saying that we're flying blind into 2025. How much clarity, visibility do you have on next year, never mind 24?
Oh, nothing. Nothing. I don't see anything going forward, but I want to say hi to Zach. We were together at Wells Fargo, and it's very, very difficult. As you were talking before, there's a lot of signs that are pointing to a slowdown in economic activity. So the decision by the Fed was, I think, that an overkill. Because, they raised inflation to 2.6% this year from 2.4%. So 20 basis point difference between March and today. But at the same time, they took away 50 basis point decline in interest rates. So in real terms, if we are correct with inflation continuing to coming down, that means that they are tightening monetary policy because the real federal funds rate is going to continue to go higher.
Zach, we keep talking this morning about how the response in markets has been very interesting to not only concerns about the deficit, but concerns about the Fed being a bit hawkish, or if cutting rates, why that isn't just an unmitigating positive. And I've got to say, from your vantage point, given all the concerns swirling, where are you focusing in markets to understand what the risk appetite is at a time where lower yields are supposed to help risk assets? And what you saw yesterday were high-yield bond spreads widening at one of the fastest paces this year.
It's an interesting point, Lisa. When we look at what we're seeing in the market today, and something that I feel like we haven't seen in a long time is your traditional risk-off move where you have equities falling and government bond yields rallying. That's not a relationship we've observed recently. So to the extent that we see more of that, perhaps some of these geopolitical pressures, of which there has been plenty over the past even couple years, yet there's been a very calm market backdrop, I'd say that would signal to us that perhaps there is a shift in risk appetite. And during the client meetings we've done more recently, I don't think there's a lot of concerns necessarily about the U.S. economy going into recession, perhaps too few concerns. But at the same time, we are hearing more caution in the way portfolio managers are positioning. So it does seem like there's a little bit of caution around just how much markets could be priced to perfection, as the Fed has seemingly taken additional rate hikes off the table, but they've also reduced the amount of rate cuts they expect in the near term. So from our perspective, we are looking for a consumer slowdown. And I think Eugenio makes a great point about their adjustments to inflation and expectations for the nominal policy rate. We don't think we're in an environment where they need to be tightening the real policy rate. And so we are more dovish than the market, and we are more concerned about a modest repricing of credit risk in terms of spreads across investment grade and high yield.
And before we get back to Eugenio, Zach, I'm curious from your perspective, that type of repricing of risk, does that include a repricing of U.S. risk? Because that's what we're seeing right now in places like France. Or is that just simply credit risk at a time where still the U.S. has exceptionalism simply by default?
That's an important distinction, Lisa. We prefer duration risk over credit risk. So we'd say not a wholesale repricing of U.S. risk in terms of Treasury yields. So yes, we prefer being overweight duration relative to overweight credit when we look at the balance of the level of yields and the tightness of spreads even today.
Eugenio, what do you make of that? This idea that there is perhaps a little bit more caution under the hood than perhaps some people are realizing, and maybe markets are just sort of sniffing out at a time where it does seem like the economy is just beginning to soften, maybe even a bit more than some expect.
Yeah, I typically disagree with markets, but I think that markets are correct in pricing 2 rate cuts for this year. On the fiscal issue, I am not that concerned with the U.S. So, we were looking at numbers from France the other day when their risk rating was changed. And tax revenues as a percent of GDP in France is 46%, vis-a-vis the U.S., which is 18%. For us to get out of these issues with the growth in debt is very easy. I mean, some analysts, some economists are saying that a 2 percentage point either increase in taxes or decrease in expenditures or a combination of both will will stabilize the growth of the debt. So the reason why I don't think that we are exceptional. I think that the real differences between what could be done in France to bring down or to pay back versus what we have to do here is very, very different. I think that our social contract is broken. We no longer agree on how to do it, but if we can do it, if the political system can do it, then it will be very, very easy.
Gentlemen, I was very happy to be a part of the Wells Fargo reunion. Invite me next time. This was fantastic. Zach, I do have a question for you. Zach, before you go, I've got to ask, was it a thing to jiggle the mouse at Wells Fargo? Is that a thing? Is that what people were buying? Do you have any insight on that?
I never saw it, never saw anything like it in the corporate investment bank. I don't know what could have been going on in other parts of the business, so I didn't see it, John.
Great to get some insight. Thank you, Zach. Zach Griffiths of Credit Sites, alongside Eugenio Alaman of Raymond James. There you go. Just getting some, some real-time reporting, that is, Lisa, on one of the most read stories on the Bloomberg terminal.
I did some real-time reporting.
Sure, what do you got?
Looked at the reviews on mouse jigglers on Amazon.com, and there are people who put their name on mouse jigglers. And I'm thinking to myself, why would you do that? Because there's only one reason to use a mouse jiggler or a finger jiggler or whatever it is that's going to be on your thing. But people put their names down. Very effective.
I've got an idea. What we should do. It'd be a great story. Fantastic. You should apply for a job. Okay.
Anywhere else but here, is that what you're saying?
Any job. No, remote work. Remote work. Apply for the job. Go through the interview process. See if it will get cleared from management. See if you get said job. Hopefully you'll pass the interview test. You know, like we'll do some work together. I'll do some tests with you. Then when you get the job, you buy one of the mouse things, and we'll see how long you last in the job. But never do any work. See how long you last.
This is a great experiment.
Right.
Let's get rid of that.
You're always online.
Rachel, okay. I'm on it. Please.
Always online.
I expect approval.
It'll be a very cool story. See how much you can get away with working from home.
I bet we could get away with a lot.
And then we'll donate the income to charity.
Really?
Yeah.
Okay.
It's a great plan. All right. Let's get you an update on real news elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The FAA is investigating counterfeit titanium that was used in parts for Boeing and Airbus planes. It's from a report from the New York Times, and it says that the material was sold using falsified documents. Those claims came from aircraft manufacturer Spirit Aerosystems. The investigation was launched after small holes were found in the material. As of now, it's unclear how many planes have parts made with the questionable material. Let's get back to that story you were just talking about. The details here. You mentioned the mouse jigglers. Well, it is Wells Fargo firing over a dozen employees last month. The investigations led them to claims that they were faking work. A review found that they were simulating keyboard activity, creating an impression of active work. A company spokesperson said, quote, Wells Fargo holds employees to the highest standards and does not tolerate unethical behavior. Now, the newest franchise in the NHL has been given a name, even if it's only temporary. Utah Hockey Club is the name, and they will take the ice in Salt Lake City starting this fall. Team owner Ryan Smith unveiled the team's name, logo, and uniforms, which are black and white jerseys with a little bit of blue that say Utah across it, and little else. A fan vote for the official name and mascot is still ongoing. Those in contention include Mammoth, Yeti, Outlaws, Venom, and keeping it simply as the Utah Hockey Club. That's your brief, John.
Danny, thanks for this morning and for the week. Just on sport, I've had so many messages on Mets Jets.
I know. I've got a lot of corrections as well.
Thank you, David. Thank you, Gerard. Thank you, Stetson.
Thank you, Mark.
Mark. The list goes
on and on.
On and on. Up next on the program, we'll set you up for the day ahead, going into the week ahead, and we'll catch up with Anne-Marie on the ground at the G7 to give us the latest from Italy. All of that up next.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Counting it down to the opening bell, about 40 minutes away. Equities negative on the session. We're down by about 0.5%. Bit softer today, but on the week, much firmer. 4 days of gains on the S&P. Decent week of gains. Best week in about a month on the S&P 500. In the bond market, this rally just keeps continuing. Having a bit of a breather in the last 10 minutes or so, but we had a break of 420 early this morning, back up to about 421.32 on a 10-year, down 3 basis points on the session. But it's this story in Europe I think we're all focused on. This was the surprise of last weekend, how Emmanuel Macron responded to the EU elections, the called snap elections domestically. This is a big issue for France now. You've got the French equity market getting hammered, erasing all of the gains for 2024. You've got this French-German 10-year spread blowing out to the wides that we have not seen since 2017. And you've got the single currency with some real weakness in the FX market.
You underscored one of the most important points of the week, which is essentially, even as you see a flight to quality in U.S. Treasuries, you see the opposite in a lot of European bonds. And the flows verify that. Essentially, you see huge flows into U.S. government bond markets, about $6.5 billion. And you have the biggest outflow. You had 4th largest weekly outflow in the last 5 years from European government bonds. So it gives you a sense of that divergence and pretty much cold relief.
Quality. What is quality in Europe right now? And there's a question mark over French debt at the moment. Here's the trading diary for you for the rest of today and into next week. At 10 a.m., we'll get the UMich consumer sentiment data. Last big data point for you going into the weekend. At 11:30 Eastern Time, President Biden meeting with Pope Francis. Monday, Fed President Patrick Harker speaking. Tuesday, retail sales plus a host of Fed speak. Tons of it over the next week or so. Look out for that. Thursday, another round of jobless claims, and we'll find out if this week was a head fake or not. That's going to be a big data point for us next Thursday morning. Joining us now to wrap up a G7 is Bloomberg's Anne-Marie in the south of Italy. AMH, we've been talking about the domestic difficulties that the sitting president is having in the United States, that Emmanuel Macron is having in France. Just summarize what you've taken away from the meetings this week.
Well, Jonathan, they were able to get over the finish line some of these deliverables when it comes to supporting Ukraine. Today, there's going to be a focus on going after China, its economic clout, anti-dumping issues. But all of this has been overshadowed, and some of this has really played out into the forefront of these discussions, the domestic issues these leaders are facing at home, most notably when it comes to Emmanuel Macron. You have Meloni talking to local press saying that he's using this forum for electioneering purposes. Rishi Sunak has found it very hard to get a date at this G7, to have an official bilateral on the agenda with a G7 leader, because they all know that in 3 weeks' time, he is likely not going to be leading that country. And then as well as Olaf Scholz, who's dealing with really poor poll numbers and a strong showing from the far right after the European parliamentary elections. So you see this gap in what electorates want the officials to deal with and what they came to the G7 to discuss. And I asked the World Bank president about this, and has it been difficult, this really attack on multinationalism when you see a rise in nationalism? And he talked about how it's chauvinistic. Take a listen.
One of the biggest things that worries me is chauvinistic nationalism, because it tends to create the absence of
connectivity. But I think if you look at the last few months itself, we've managed to get capital and hybrid capital and portfolio guarantees into our institution, and we are the one that's working with this multilateralism.
That capital going into the global south and places like Africa is a point that the United States wants to counter China, but also individuals like the Prime Minister of Italy, Giorgia Meloni, to try to stem the flow of migration they are seeing from the continent.
Anne-Marie, as you suffer on the southern coast of Italy there, I'm just curious, can you explain to us what's chauvinistic nationalism?
I think what the point he was trying to make was that people thinking that this nationalistic approach, that only their country matters and their issues matter. I think what the World Bank president was trying to get at is the fact that he thinks it's short-sighted, because when you look at putting capital to work in places that are in need, like Africa with food security, energy security, actually it could benefit individuals at home when they're dealing with things like growing migration, because people from some parts of the global south are suffering for things like trying to get a job. I did also ask him about what potentially Trump 2.0 would mean, because this World Bank has also wanted to take a look at not just countries that are in poverty, but also making sure they're focusing on things like climate change. And would that kind of approach be difficult with the Trump presidency? And he was quick to say that it was under Trump's first term that they saw a capital injection. So he's not concerned and thinks that, the World Bank will continue with the U.S. support, whether or not it's going to be Biden or Trump 2.0.
AMH, we've got 30 seconds. What's on the menu today?
Well, the menu for me is certainly going to be a gluten-free or Biden did not attend the dinner last night, but tonight is the big G7 dinner. He will attend, and then he's wheels up. He's not going to be going to the peace forum on Ukraine in Switzerland. Instead, Biden is in full-on campaign mode. He's going to Los Angeles at a campaign fundraiser, and he'll be with the likes of George Clooney, Jimmy Kimmel, and those celebrities.
This is the important stuff, Bramo, the menu. I mean, I'm looking forward to this. I'll be away next week. Wake up, cappuccino.
Really?
Cornetto alla crema, inzupare. You get it, and you dip
I'm back
it in.
on strike. I'm not going to talk for the rest of the show. I'm done. This is ridiculous.
Fantastic.
All of you just basically
AMH,
mocking
fantastic work. I'll see you in Italy in the next week or so.
Aren't jiggling.
She's staying there. She's not coming back,
Oh, yeah?
Yeah. She's going to
jiggle her mouse?
Just jiggle the mouse on set.
Hopefully that
That's good. From New York City, have a fantastic weekend. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Katie Greifeld. Futures taking a breather after another record close. The countdown to the open starts right now. Coming up, stocks lower after closing at another all-time high. Fed speak picking back up after cooling inflation data, and investors voting in favor of Elon Musk's $56 billion pay package. We begin with the big issue, the S&P 500 notching record highs every day this week.
If you run a marathon or a race and you sprint for 7 months, which we have sprinted, let's be honest about it, you're going to be tired. And I think the market is tired here. It's, when you look at those top concentrated names to the point, they're doing extraordinarily well, right? And I'll take it. But I get under the surface, right? Whether you're pointing equal weighted, small cap, I look at some of the other sectors, they're just not participating at the same level.
Joining us now to discuss is Jay Pulaski, TPW Advisory Principal and Founder. And Jay, record high after record high. I've had about a dozen people in the past week tell me that we're due for some sort of summer pullback. And you just heard Daryl Cronk telling us that this market is tired. How are you feeling right now?
Good morning, Katie. Well, it is Friday, so, I think feeling tired is appropriate, right? But look, yeah, we've had a great run with stocks, and the U.S. has been leading the world, right? S&P up about 13% year to date. I think it's the best ever start to a presidential election year. So obviously things have been good. What I've been impressed with, though, is how well the market has been able to digest the big moves and move from overbought, to away from being overbought, as most things are, right? And now you have an opportunity. We're coming up to second quarter earnings, and earnings are what has been driving this market. It's not the Fed. It's not interest rate cuts. We switched about 6 to 9 months ago to a focus away from monetary policy to economic growth and recovery, driven in the market sense by earnings growth. And that is the story. And so to me, natural that we take a breather maybe next week or the week after, and then we're gearing up for earnings. And earnings are likely to be good. In the second half of the year, earnings estimates have continued to be revised up through the first 5 months of the year. And so that's what the market's looking at, second half of 24 and increasingly into 25, where consensus is for double-digit earnings growth in the S&P. And that's a good environment for stocks.
So that is the fuel of this rally, that double-digit earnings growth that you mentioned. But let's talk about the Fed a little bit, because it's just been striking. You think about what we came into the year with in terms of Fed cut pricing, where we are right now. It's just been dramatic. Seems like the stock market just doesn't care. I mean, is there anything that the Fed and Jerome Powell could do at this point to stand in front of that continued rally?
Well, we've been saying for quite some time that the Fed is not the focus. The focus is on the economic recovery, what we call early cycle growth, as well as the earnings growth. And I think we've seen that just play out. So, we don't really pay a lot of attention to the dot plot. The dot plot moves all the time. It's completely data dependent, really has very little signal into the future of what the Fed is likely to do. And the market is telling you it doesn't really care whether the Fed cuts 3 times or 2 times or 1 time. It's really not important. The good news is for the market, what is important is that if we show signs of slowing, the Fed has the ability and the willingness to cut. And so the market is somewhat protected. It can go higher on earnings growth, not really multiple expansion, but it knows it has the Fed, the so-called Fed put, in its back pocket should things weaken. But there's really no sign of weakness, and nor should they be, because the economy is in full employment, real wages are growing, investment is continuing, and we'll see what happens as we get closer to the election. I think there you might have some reasons for pause as we get closer to November.
So, Jay, sit tight for just a minute. Let's get some perspective from Mike McKee, because Fed speak picking back up after officials dialed back those rate cut expectations. And Mike McKee, the blackout period is officially over. What are we expecting to hear from these Fed speakers?
Well, let me go on the record, Katie, and say that I'm tired, too, after that. Darryl Crunk's right, after this long week of the Fed, but it's not going to get any easier next week. Actually, it starts today. Shameless plug with Loretta Mester, the outgoing Cleveland Fed president, who will be sitting down with me at 1:15 this afternoon. We'll get her thoughts on where things are going and what they might do in her absence. Then next week, hold on to your hats, because just about half of the Fed is speaking, and they'll give their take on what they did last Wednesday. Harker and Cook on Monday. Then we get Barkin, Collins, Logan, Kugler, Musalam, and Goolsbee on Wednesday. Barkin comes back on Thursday. We also have retail sales on Tuesday, which will be a big number. We'll see if the consumer is hanging in there. The questions about whether they continue to spend or whether the economy is slowing. And then jobless claims suddenly became interesting on Thursday with the big jump last week. Now, the big number, though, that everybody's waiting for is going to be the week after next, when we get the PCE inflation data. Now that we've had CPI, PPI, and import prices this morning, economists are figuring out what they think PCE is going to be. And as you can see, they think it's going to be very, very low for the last month. Omer Sharif just writing in from Inflation Insights, he thinks it's going to be 0.06 on a monthly change. And basically, this just means another big drop down in the year-over-year numbers and more confidence likely for the Fed. The market, as Jay was just saying, doesn't really care, though. They've gone ahead without the Fed and started marking things down. You look at one-year inflation swaps, and basically they're falling out of bed. Right now, 2.17 is what the market thinks we're going to see 12 months from now in terms of overall inflation. This is based on the CPI. So we're going to see some pretty low numbers ahead, at least that's what the market thinks, which would suggest sooner and lower for the Fed rather than higher and longer.
All right, Mike McKee, really appreciate that. Of course, Bloomberg's chief economics and policy correspondent. And as he mentioned, don't miss Mike's interview with Cleveland Fed President Loretta Mester. That's at 1:15 p.m. Eastern. We'll catch up with Mike around the top of the hour for those UMISH numbers as well. But let's go back to Jay Pulaski, of course. And I want to talk about this age of investment that you write about in your notes, a very thoughtful June investment outlook piece. And you think about all the money that's being spent on semiconductors, on the chip industry, not just by, of course, governments, which are spending hundreds of billions of dollars, but also by some of the big tech companies. You add that all together, how do you bet against semiconductors right now?
Oh, I definitely don't. We've been long and we remain long in our model portfolios. We're big believers in what we call the pick and shovel thesis of investing in the AI age, which means the pick and shovel for digital is semiconductors, right? Everything AI related requires semiconductors. And then on the physical side, pick and shovel means the miners, because what's really exciting is the fusing of the digital in the physical spaces, the digital being AI and the physical being basically the AI factories, also known as data centers, and they are very power-hungry entities. And so we have a huge combination, and this is part of the investment thesis, of the semi build-out and the power build-out, the fusing of the digital and the physical with the pick and shovel of semis and things like copper miners, uranium miners, et cetera. And we think this is a theme that's going to play out for the next 5 to 10 years, and it's going to help determine who wins the second half of the 2020s, which was the title of our most recent monthly. And I think it really gets down to governance, right? It's who can expand their workforce, namely immigration, which is interesting, and then who can best integrate, as you said, Katie, public and private capital at speed and with scale. And whoever is able to do that from a governing perspective, we think is going to win the second half of the 2020s.
So basically, who can seize this moment and actually execute? I do want to pick up on what you said about data centers and how investable is that theme. I think about the past week, 2 people have told me that the data center bullish thesis is a bit overblown because, like you said, this is going to play out over years and years. Maybe that if you go in right now, you're a little bit early. How are you thinking about the timelines there?
Yeah, no, that's a great question. And obviously, this is all happening at speed, right? And so we're believers that speed is accelerating. It's been a theme of ours for several years here at TPW Advisory, and the AI age just reinforces that. And I think it's a critical point to understand. The internet took 15 years to build out because every piece of it had to be created. AI is sitting on top of the internet age, and so it can be plug and play. And I think, and we think, therefore, it's going to accelerate much faster. And every country and every company needs to have AI. So there's the conversation about sovereign AI for different countries. And so for those types of reasons, we're actually adding to this thesis through the powering of the data centers and looking to invest in things that are beneficiaries of the electrification of this process. And the other thing that we're stepping into, talking a little bit about taking on risk, a little bit of a digression here, is we're actually starting to step into commercial real estate. If inflation is truly conquered in the U.S., if rates are coming down, we actually think it might be an interesting opportunity to step into commercial real estate here in the United States.
Well, you definitely still have to have a strong stomach to do that. But Jay, I only have about a minute left with you. We've talked, of course, about stocks. We've talked about miners. We've talked a bit about commodities. Let's talk about bonds, though. I mean, where are you when it comes to investing in fixed income right now? We've had a generational reset in yields. Is that attractive to you?
It really hasn't been, Katie. We've been overweight equities and double weighted in commodities versus our benchmark. And we're funding that through being significantly underweight fixed income and being completely out of U.S. Treasuries and developed market sovereign debt completely. And so where we've been playing is in the credit space, high yield, bank loans, emerging market debt, Asian high yield. And those are the places that we want to play because we think there's a global growth convergence, and that actually sets up opportunities in some of these segments that I mentioned that have been out of favor and therefore offering significant yields. And that's more attractive to us than Treasuries, for example. At 4.2% on the 10-year, we think growth is going to be higher than expected going forward. So we're not really all that interested.
All right, not time to take duration risk here. Jay, really enjoyed this conversation. Have a great weekend. Our thanks to Jay Pulaski, TPW Advisory Principal and Founder. Let's now take a look at the stocks moving ahead of the opening bell. We'll do that with Abigail Doolittle.
Well, Katie, we do have futures lower, but before we take a look at what's dragging, let's take a look at what is absolutely soaring, and that, of course, is Adobe. Shares are set for the best day since 2020, this after the company put up a good quarter. Importantly, though, they gave a really strong sales forecast for some of their creative products, suggesting that there is demand for their new AI products. Anything to do with AI, as you know, really creates a bit of a stir, and that is certainly happening with Adobe. As for what is dragging on futures this morning, if we take a look at both the shares of Apple and Microsoft, these big tech names are sliding a bit here in the pre-market, not for any particular reason. Apple, of course, on the week into today, up more than 8%, so a little bit of consolidation. Microsoft was down more than 1% yesterday, so that slide continuing. As for some other bigger names that are, or I should say bigger decliners, Stellantis, the company did give an update, and they are saying that it looks like at least they're losing share and struggling with an inventory pile up. As for the shares of RH, they are absolutely plunging, down 15%. the company formerly known as Restoration Hardware, a loss of 40 cents per share versus closer to a loss of 10 cents. It seems like demand is pretty weak. Investors not liking that. Again, that stock down sharply, down 15%.
All right, Abby, thank you for that update. And coming up, presumptive GOP candidate Donald Trump is on the campaign trail.
I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
We'll take a look at some of his promises next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
What's happening to our country is of great concern to the group of people standing alongside of me. We have great unity. We have great common sense. A lot of very smart people in this room and a lot of people that love our country. I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
And that, of course, was presumptive Republican presidential candidate Donald Trump making his pitch to top CEOs. He met with about 100 executives in Washington, including Jamie Dimon, Jane Fraser, Brian Moynihan, and Tim Cook. Now, part of Trump's plan would be to slash the U.S. corporate tax rate to 20%. That's down 1% from the current rate. And joining me now is Bloomberg's Sri Natarajan in studio, as well as Laura Davidson from Washington. And let's start with you, Sri. 21% to 20%. How much does 1 percentage point actually matter here?
It's a big difference in some ways, right? Because you're talking about going from 21 to 20 might just seem like 1 percentage point, but for many of these corporations, it adds up to several hundred millions of dollars. But more important than that, it is the significance and the symbolism of it. This is Trump making a pitch to these CEOs that he will be more business friendly, much more business friendly than the current administration. He's already proved it once in Trump 1.0. The most significant achievement of that administration, at least for the corporate community, was the tax cuts that were put in place, led by Gary Cohn, of course, who went into that White House, helped champion that process, spent only less than a couple of years there, but managed to pull that off. This is Trump coming back again to these same CEOs and saying he will continue down down that path. His reasoning for going from 21 to 20 is, of course, that it's a nice round number. For the CEOs in attendance, it's a nice big figure. So they're not sitting there thinking about the former president just 2 weeks out of getting a guilty verdict and therefore standing in front of them as a convicted felon. They're looking at someone who will be much better for business, possibly much better for business going forward.
It's very human, right? The focus on big round numbers. We can all relate to those figures. But tell me a little bit more about the guest list. We talked about 100 CEOs. I mentioned some of them, but who was there? Who wasn't there, Sri?
It's the Business Roundtable group, so it had some of the biggest names across the business community. You had the Apple CEO, Tim Cook. You had people like Jamie Dimon, Brian Moynihan, Jane Fraser. There were some absentees, but that wasn't like Goldman CEO David Solomon, but that wasn't necessarily